It's a pretty lovely good evening once again from here, and hope as always that each one of you are fine, happy, and of course in fine spirits. So as far as this fast track series is concerned, we are going to pick up first chapter, India's 103 business combination. I need not require to tell you that this happens to be a pretty strong, formidable chapter, very important from the examination point of view, and especially if we are going to have a look upon the past 4 attempt papers of the new syllabus, you'll find that almost in every paper we have a question from what we call this particular chapter. So one need not require to actually give you any sort of further idea regarding the importance of this particular chapter, correct? And even though it's a very fast track series, sort of revision series, no doubt about that, but it is not a run-of-the-mill revision series. Even in this particular super fast series, we will try to actually cover the entire gamut of the course, and at no point of time you would feel actually as if you are simply doing the revision. You will definitely find as if you have done the entire what we call regular course, correct? Anyway, so first thing is that first of all you need to actually pull out your pen, pencil, register and notes and kindly actually pay attention. Even though as I told you it's a fast track super quick series, yet actually we are going to pick up even the what we call minutest of the threads. So first of all, we are going to begin with some significant points, and most of you are already well aware of this, but in spite of that we are going to begin the chapter with scratches. As far as significant points are concerned, as a professional student, first of all you need to understand some basics of this particular chapter, correct? That will hold you in a very good state, not only for this particular chapter but also when you are going to enter into your practical arena. We presume that there is an entity by the name of E1, and this entity has invested in some other entity, and the name of the other entity is F1. And whenever I would say that this entity has invested in the other entity, it means the investment is in equity instruments of the other entity. Is it clear to you? For instance, in this case, I have written over here E1 has done some investment in F1 enterprise. So that means the investments are in the equity shares of F1 Limited. Now we further presume that the range of this investment is in between 1% to 19.99%. So if an entity actually invests in the other entity, then first of all, as a professional student, you need to understand that the entity which is investing the amount is known as investor entity, and the other entity in which the investment has been done is called as investee entity. Now, what I told you that the amount of the investment is in between 1% to 19.99%. If the range of my investment in the other entity is in between 1% to 19.99%, then it is simply considered as normal investment. It is simply considered as normal investment. In this case, accounting will be done by only the investor entity, which in this case happens to be the E1 entity. Is it clear to you or not? Now, as far as accounting is concerned, in this case, entity E1 will record the investment in the other entity in its individual financial statement. And how it is going to record the investment? It is going to record the investment at fair value, FV, at fair value as per Ind AS 109, because we know that Ind AS 109 deals with financial instrument, and under Ind AS 9 all the investments are generally recorded at fair value. So the first thing which you need to understand is that if your amount of investment or your range of investment is in between 1 to 19.99%, in that case, such investments are simply known as normal investment, number one. And in this case, only the investor entity will do the accounting with respect to investment in its individual financial statement, and it will record the investments in its individual financial statement at fair value in accordance with Ind AS 109. This is the first basic point. Is it clear to you? Second point is that we presume in this case the investor entity is E2, and E2 has made some investment in F2 Limited. So other entity is F2 Limited. I need to require to tell you that E2 will be known as investor entity, while the other entity F2 will be called as investee entity because we have invested. Now the investment has been done in equity instruments of what we call F2 Limited, but this time, as you can see, the range of the investment is 20% or more, but up to 50%. If my investment in the other entity happens to be 20% or more, but what we call up to 50%, in this particular case, it will be implied that E2 entity is exercising significant influence, SI, significant influence over the other entity. If my range of investment in the investee entity happens to be 20% or more, but up to 50%, In that particular case, it will be construed as if I am exercising this significant influence over the other entity. Now, what we mean by significant influence? Significant influence means we can participate in the financial and operational matters of the other entity, but what I have said, significant influence. I haven't said control. We are not exercising the control over the other entity, but the point is that we are exercising in this particular case significant influence. Is it clear to you? And significant influence suggests that we can participate in the operational and the financial matters of the other entity. Now, because this time the range of your investment is in between 20% to 50%, so that is why you are having the significant influence over the other entity. And because you are having the significant influence over the other entity, from the accounting perspective, we may say that other entity, that is F2 Limited, is your associate entity. This time the other entity will be considered as an associate of the investor entity. Indirectly, if investor entity is having an associate, in that particular case, the investor entity will have to prepare two types of financial statement. One is separate financial statement. Another one is what we call consolidated financial statement. CFS here stands for consolidated financial statement. So this time they will have to do the accounting. They will have to prepare two sorts of what we call two sorts of financial statement. One is separate financial statement and consolidated financial statement. Now, in the separate financial statement, the investor entity is going to record the investment in the associate as per Ind AS 27. In my separate financial statement, correct, the investor entity will record the investment in the associate in accordance with Ind AS 27. And Ind AS 27 states that you can record the investment either at cost or you can record it as per fair value. That means Ind AS 27 gives or provides a discretion, or what we call provides a leeway to the investor entity that you can record the investment in associate in your separate financial statement either at cost or at, as I said, fair value. Is it clear to you? These are the provisions of Ind AS 27. Now further, as I told you, because this time you are exercising the significant influence over the other entity, so you will have to actually prepare in this particular case, as I said, consolidated financial statement also. So consolidated financial statement which you are going to prepare will be in accordance with Ind AS 28. That means when investor entity prepares consolidated financial statement, in that case, Ind AS 28 will come into play. Very important from the MCQ point of view. Is it clear to you? Lots of questions have been tossed up from this particular part, and because the student never pay any attention towards these basic points, they always find at sea whenever such questions are tossed up before them. So that is why I am saying actually these are quite vital. Another important point is that as far as this particular chapter is concerned, now we presume, and this particular point is very important from this particular chapter also, from the perspective of this particular chapter. We presume that there is an entity by the name of E3. This is the investor entity, and it has made some investment in F3 Limited. Of course, the investments are in equity instruments of F3 Limited, but this time the range of the investment is more than 50%. More than 50% means 60%, 70%, 80%, 90%, it could be 100%. So this time your range of investment is more than 50% and maximum it could be 100%. So if your range of investment is more than 50%, in that case we presume or it is implied or it is construed that the investor entity is exercising the control over the other entities. So this time, because you are having more than 50% of these stakes in the other entity, it will be construed, it will be implied that you are having control over the other enterprise. Is it clear to you? Now, if investor entity is having the control over the other enterprise, as you know better than I, actually that other entity is known as subsidiary entity, or it could be known as, or it could be called as acquiring entity. Acquiring entity. While the investor entity will be known as parent entity, it is also known as holding company, or it is also known as acquirer entity. So important point is that when you have control over the other enterprise, and you can exercise control over the other enterprise only when you are having more than 50% stakes in the other entity, then other entity will be your acquiring company or subsidiary entity. Now, if the investor entity is having a subsidiary or acquiring entity, even in this particular case, as you know, we will have to prepare two sorts of financial statement. One is separate financial statement and another one is consolidated financial statement. As far as separate financial statements are concerned, that will be prepared in accordance with Ind AS 27. Just a moment ago, I told you Ind AS 27 states that whatever you have whatever investment which you have made in your associate or in your subsidiary company. Such investment will be recorded either at cost or at fair value. That is what we call complete discretion of the investor entity. So the investor entity will record the investment in acquiring entity or subsidiary entity either at cost or at fair value in accordance with Ind AS 27. This is one point. Another important point, and which is very vital actually, I have seen through my experience, I remember my experiences of almost 4 decades now, that students do not know some very basics of what we call this particular chapter. For instance, as I said, this time the investor entity is having a subsidiary, so investor entity will have to prepare the consolidated financial statement, and they will have to prepare the consolidated financial statement. Now pay attention what I have written here. On the date of acquisition, and they will also have to prepare the consolidated financial statement at the year end and subsequent year ends. Is it clear to you or not? So this time the investor entity will have to prepare the consolidated financial statement, number 2. Number 3, the consolidated financial statement will have to be prepared on the date of acquisition and of course at year end and subsequent year end. Very important point to note is that when parent company, and you can be parent only when you are having control over the other enterprise. Parent is also known as I told you, holding company or acquirer company. So the parent company or the acquirer company will have to prepare the consolidated financial statement on the date of acquisition. And whenever the consolidated financial statement will have to be prepared on the date of acquisition, in that case, Ind AS 103 will come into play. Many people do not know actually where the application of Ind AS 103 lies and where the what we call application of Ind AS 110 comes into play. So very important to understand that whenever consolidated financial statements are prepared by the parent, correct, or the acquirer company on the date of acquisition, they will have to use Ind AS 103. In fact, Ind AS 103 states very clearly that when you acquire the control over the other enterprise, then on that date, that means the date of acquisition, you will have to prepare what we call consolidated financial statement. So here we will apply what we call Ind AS 103. And at the year end and subsequent year end, whensoever the acquirer or parent company will prepare consolidated financial statement, in that case it will have to follow Ind AS 110. Is it clear to you or not? So these are very vital point, and especially this particular point is very important from the examination point of view. There is yet another point, and why I am telling you this another point, because I have seen actually in the last attempt we find actually there were some MCQs. Now, in 4th point, first of all, I have written here point number A. In point number A, I have written that there is an entity by the name of E4, and this entity has made some investment in joint arrangement. What is a joint arrangement? You have heard about joint venture in your earlier level of education, correct? Sometimes 2-3 enterprises or more than what we call 2 enterprises combine together and they decide to actually work upon what we call some basic economic activity. That is known as joint arrangement. For example, there are 3 entities, E4, entity A, entity B, or even entity C. Let us say these 4 enterprises have decided that jointly we are going to carry out some economic activity. So this is nothing but this is known as joint arrangement. Now, importantly, what you need to understand is joint arrangement could be a joint venture or it could be a joint operation. The joint arrangement could be a joint venture or it could be a joint operation. Is it clear to you or not? Now, another important point is that suppose E4, entity A, entity B, and entity C decide that we are going to start jointly some economic activity. And they start this economic activity in an official manner. In an official manner means they completely follow the what we call legal rules, legal procedures. Let us say they form a sort of corporate entity to start a joint venture. So if they are forming a corporate entity to start a joint venture, quite obviously it means they are actually starting this joint arrangement on an official note. So when joint arrangement is official, and generally it is considered official when corporate entity is formed, correct, to start the joint arrangement, then we say that it is a joint venture. Is it clear to you? And sometimes these entities simply actually say, okay, we will combine together and we will start a joint arrangement. But this time no legal process is followed, no legal corporate entity is formed. That means it is unofficial. And if it is unofficial, then it is known as joint operation. Is it clear to you or not? Now, as I told you, there is an entity by the name of E4, and let us say it has made some investment in a joint arrangement. We further presume that this joint arrangement is official. And just a moment ago, actually, I told you if the joint arrangement happens to be official one, then it is known as joint venture. Indirectly, now I would say that E4 has made some investment in a joint venture. Is it clear to you? Now, if the investor entity has some stakes in a joint venture, in that particular case also we will have to prepare separate financial statement as I told you, and also consolidated financial statement. If investor entity has some stakes in a joint venture, even in such cases, the investor entity, in this case E4, will have to prepare two sorts of financial statement. One is known as separate financial statement, while other one is consolidated financial statement. In the separate financial statement, this entity, investor entity, will have to record its investment in the joint venture in the light of Ind AS 27. I've already told you Ind AS 27 states that investments will have to be recorded either at cost or at fair value. And further, they will have to prepare the consolidated financial statement. Importantly, the consolidated financial statement will be prepared in accordance with Ind AS 28. Is it clear to you? That means Ind AS 103 and Ind AS 110 will come into play only when you have the control. But this time we are not having the control, we are simply having some stakes. So, Ind AS 28 we will have to follow. On the other hand, now I presume, earlier I presumed that it was a joint venture. Now I presume that this joint arrangement is a joint operation. Now presume that this E4 entity has 30% stakes in a joint arrangement, and this joint arrangement is unofficial, that is joint operation. If you have some stakes in a joint operation, in that particular case, recording will be done only in the individual financial statement, that is separate financial statement, and you are going to record the investment in the light of Ind AS 111, and in this case, no consolidation is required. In this case, no consolidation is required. Remember one thing. Is it clear to you or not? So these are the basic points which you need to understand. Now the next point is, obviously, because we are doing business combination, so some other facts we need to come across. And in order to come across other facts, what are those other facts in order to make you understand better? Correct? Just allow me a second because I do not want to waste the time. And right here. Now we have gone through the basic points of this particular chapter, and that will hold you in a very good state, provided you are paying actually attention. Now we will move over to the next part, business combination. What exactly business combination is, because after all we are going through this particular chapter, Ind AS 103, so we need to be quite well aware of business combination. Put it in simple words. Business combination simply means when an entity acquires control over the other entity. Whenever an entity acquires the control over the other entity, that is known as business combination. It is as simple as that. Just to make the point a little bit more clear, for example, there is an entity by the name of E1, and let us say it acquires control over the other entity, and let us say the name of the other entity is F1 Limited. So, because in this case, I just told you E1 Limited has acquired control over the other entity. So, in this case, this process will be known as business combination. But another important point is that most among us actually think that control can be acquired only through majority stakes. Because most of the students I have seen actually they are under a notion that an entity can acquire the control over the other entity by way of majority stakes only. Majority stakes means through investments of more than 50%. Because most of the students actually are under an impression that an entity acquires control over the other entity simply by acquiring more than 50% stakes in the other entity. That is not the case. Obviously, that is one of the chief reason, correct? Through majority stakes, most of the time we get actually control over the other enterprise, no doubt. When I say majority stakes, indirectly it means I'm having more than 50% stakes in the other entity. And as you know, most of the time actually control accrues to an entity over the other entity by way of majority stakes only. But on rare occasions, we find that control can be acquired by way of agreement also. Control can be acquired by way of agreement also. What does it mean? Just to make the point a little bit more clear. For example, let us say there is an entity by the name of E1. And let us say it has made some investment in F1 Limited. And we presume that in amount of investment is just 26%. Now this time E1, this is the investor entity, it is not having more than 50% stakes. So obviously E1 is not having control over the F1 Limited if we are going to simply look upon the what we call amount of investment, isn't it or not? Because we are not having the majority stakes, so quite obviously on the basis of majority stakes, I can conclude that we are not actually acquiring the control over the other enterprise, isn't it or not? However, let us say when E1 made the investment in F1 Limited, an agreement took place between the board of directors of E1 and F1 Limited, whereby it was agreed that E1 Limited will have the right to constitute the board of directors of F1 Limited. Sometime it happens in practical life. When we make huge investment, remember one thing, 26% is not a mega investment, it's a pretty huge investment. So when you are making a huge investment in the other entity, sometime actually an agreement takes place between the shareholders of both the companies, whereby investor entity is given a right that you will have the right to constitute the board of directors of the other entity. So in this case, even though actually my investment is falling short of what we call 50% benchmark, correct, more than 50% benchmark, in spite of that actually it will be construed, it will be implied that I am having the control over the other enterprise. Is it clear to you? So that's exactly the reason actually why I'm telling you that an entity gets control over the other enterprise. No doubt about that. Most of the time we are going to get the control by way of majority stakes. But sometime we can get the control by way of agreement. And even in case of agreement, control will accrue to us if we will have the right to constitute the board of directors of the other entity. And sometime there is an agreement that we will have the right to control the what we call or to direct the relevant activities. RA. Relevant activities means financial and operational activity. Suppose in this particular case, if there is an agreement between the shareholders of E1 Limited and F1 Limited that E1 Limited will have the right to direct all the relevant activity, that is financial and operational activity of F1 Limited, in that case also we will presume that control is lying in our hand. So by now you must understand that control can accrue to the investor entity either on account of majority stakes or on account of agreement. And there is a very important point which most of us seldom go through, and last year there was a question on this particular topic. Of course, those among you who have already done regular courses of R, they were in a position to give the answer to it because we did it in the class. Anyway, there is another way of getting the control besides this. Of course, these are the two major what we call ways of getting the control over the other enterprise. Another important point before I move further. When we get the control over the other enterprise by way of majority stakes or by way of agreement, remember one thing, we are simply acquiring the control of the other entity. The other entity will continue to operate. That doesn't mean that the existence of the other entity will come to an end. Remember one thing, you are the investor entity, you are simply acquiring the control over the other entity, either through majority stakes or agreement. When you get hold of or when you get control of the other entity, the existence of the other entity continues. Only thing is that the other entity will function or operate under your direction, under your control, under your terms, under your policies, no doubt about that. But there is another way of getting the control of the other enterprise. Sometimes what happens, an entity acquires the net assets of the other entity. Suppose there is other entity and I am the investor entity. And suppose if I take over all the assets and liability, I purchase all the assets and liabilities of this particular entity. Obviously now this entity is left with no asset or liability. If this entity will not left up with any asset or liability, can it function now? It cannot function. So what you need to understand is there is another way, correct? Another way of getting the control over the other enterprise. So control over other enterprise also accrues when we acquire the net assets of the other entity. Is it clear to you? Now in this case, it is very important to understand. In this case, acquiring company will cease to exist, while in the earlier two cases, as I told you, the other entity will continue to function. But when you purchase all the assets and liability, acquire all the assets and liabilities of the other entity, in that case the existence of the other entity will come to an end, And because the other entity's existence has come to an end, in this case, you are not going to prepare any consolidated financial statement. Last time there was an MCQ. Remember one thing with respect to this particular point. So that is the reason actually why I keep on saying that you need to be very well and very deft with what we call all the aspects, all the basic aspects. Now we move over to the accounting aspects, correct? In order to move over to the accounting aspects, obviously I need not require to waste your time, so I come directly straight to the point. How the accounting or what exactly the procedural aspects of Ind AS 103 are. Because Ind AS 103, I have already told you, states that under a case of business combination, that means when an entity acquires the control over the other enterprise, correct, on the date of acquisition, we will have to prepare the consolidated financial statement. That is the theme and crux of Ind AS 103. So the point is that what exactly are the guidelines and what exactly are the procedural, what we call aspects of preparation of the consolidated financial statement on the date of acquisition. So we need to be very well aware of that. And in order to understand that, first of all, actually kindly open down your notes and come straightway to illustrative case study. This is section 1 and 1.1. I hope that you have the notes, and 1.1 is the question which I am going to actually begin up with the session. So here I have stated that, and kindly pay attention, pull out your pen, pencil, eraser if you really want to have a very good what we call mileage out of these sessions, correct? So in this particular question, I have written already that the balance sheet of A Limited and B Limited as on 31st/3/2026 is given. Because I am simply elaborating the points, that is why I have what we call formed this particular balance sheet in this particular manner. Anyway, so there are two entities, one is A Limited, another one is B Limited. And very few items on the asset side is given, as you can see. Non-current asset and property, plant and equipment of this particular company happens to be 20 lakh, whereas 15 lakh is the property, plant and equipment of B Limited, and likewise current assets of 15 lakh and 10 lakh need not require to tell you that total will be equal to 35 and 25 lakhs. Moving over to the other side, we find actually that share capital of A Limited happens to be 10 lakh, while share capital of B Limited happens to be 5 lakh, isn't it? Other equity is the term which we use for reserve and surplus, as you know, 5 lakh and 10 lakh. And then I have written here liabilities only, so total is 35 and 25 lakh. Kindly pay attention towards the date of the balance sheet also. The date of the balance sheet is 31st/3/2026. That means the current year has ended on this particular date. Of course, the next year will start from 1/4/2026, no doubt about that. Now kindly pay attention over here. Here I have written on 1/4/2026, A Limited acquired 60% stakes in B Limited. Because A Limited has acquired 60% stakes in B Limited, correct, technically now we are having the control over the other enterprise, no doubt about that. And here I want to actually make one thing very clear, because most of us tend to actually neglect, or simply because we are ignorant of all this particular fact. In this particular case, I have already told you there is an entity by the name of A Limited, there is another entity by the name of B Limited. Number one, correct? You have already noticed that total share capital of B Limited is 5 lakh and one share is of rupees 10. So as far as number of shares of B Limited are concerned, total number of shares, if I am going to ask you, that will be equal to 5 lakh divided by 10. Obviously, it will be equal to 50,000. It will be equal to 50,000. Is it clear to you? Out of 50,000 shares, it is clearly mentioned in the question that A Limited has acquired 60% stakes. 60% stakes means out of 50,000, now you are having 30,000 shares of B Limited. That means you have made investments. You have made investment in 30,000 shares of B Limited. Obviously, because it is an investment, A Limited will put it up on the asset side when it will prepare its separate financial statement. Are you getting my point or not? Because we have acquired 30,000 shares, that doesn't mean I'm going to put it on my liability side. It is the investment. It is an asset for me. I'm going to put it towards the asset side. Number one. Number two, because we have acquired 60% share, correct? Quite obviously, I may say that we are having the control now. At least we are having the control. Is it clear to you? Another important point is, because these are some basic points and sometimes we tend to ignore it, and that is the reason we falter at many points because of the fact that we did not any pay notice towards it. Anyway, if out of 50,000 shares you are having 60% share, that means whatever number of shares which have been issued by company B, you are holding upon 30,000 shares, so rest of the share, that is 20,000 or 40% shares, must have been held by other shareholders. Other shareholders, technically known as NCI, non-controlling interest holder. Other shareholders are known as non-controlling interest holder. Why? Because even other shareholders are having some stakes in company B, but they are not having the control. So that is why they are known as non-controlling interest holders. Is it clear to you or not? Other shareholders or non-controlling interest holders. So 30,000 shares are held by company. 30,000 shares have been held by company P, and 20,000 shares have been held by what we call non-controlling interest holder. Because you are having more than 50% share, you are having the control. But another important point is that at this particular moment, I will simply say that you are the legal acquirer. Legal acquirer means, from the legal point of view, you are the acquirer at this particular moment without any doubt. The reason is that because you have acquired 60% stakes in the other entity, more than 50%. So from the legal point of view, you will be considered as I told you, legal acquirer, while from the legal point of view, B Limited will be considered as legal acquiring company. B Limited will be considered as legal acquiring company. Is it clear to you? Remember one thing, that you have made the investment very next day of the balance sheet, that is on 1/4/2026. Obviously, when I'm going to acquire what we call some shares of the other entity, I'm not going to acquire those shares at free of cost. I will have to churn out some money, isn't it? So here it is known as against consideration of 12 lakh. How much amount I am paying, you need to note it very carefully, very deeply. So this is considered as purchase consideration or simply consideration, because you are getting the control over the other enterprise on 1/4/2026 on account of 60% investment in the other entity, and you have paid actually 12 lakh. Another important point which you need to take track of is, what is the mode of payment of this? Because you are paying 12 lakh, you can pay this amount by discharging, by what we call giving cash, or by simply issuing the shares to the other entity. Here it is written to be discharged in cash. That means this time the purchase consideration is being paid by company A to company B by way of cash. Is it clear to you or not? So we have gone through this particular question. Now let us say I have to prepare the consolidated financial statement. So how I am going to prepare the consolidated financial statement? Let us have a look over here. Although I have done complete solutions for you, you need not require to write in case if you want. But my advice will be, if you can take a little bit of efforts to write, then it will hold you in a very, very good step. Correct? Even I have taken the efforts to write. Now pay attention. The first thing is that when we are supposed to prepare the consolidated financial statements in the light of Ind AS 103, the standard says that first of all we need to know the date of acquisition. Now date of acquisition is the date on which you are going to have the control, because on 1/4/2026 you have now 60% stakes of the other entity. Quite obviously on this date now you are having the control. So date of acquisition is also known as date of control. First of all, you will have to note it down very carefully. Under the second step, and sometime you leave on, many a time I have seen students never pay any attention towards this particular point. Correct. Under this step, what I have written identification of acquirer. What we mean by identification of acquirer? Because some of you may say, now, sir, just a moment ago you told actually company A is the legal acquirer. No doubt about that. Just a moment ago I told company A is the legal acquirer because it is clearly stated in the question that company A has acquired 60% stakes in the other entity. So without an iota of doubt, company A is legal acquirer. But what is the repercussion of this particular step? What is the repercussion of this particular step? Identification of acquirer here basically means accounting acquirer. We need to actually trace out who is going to be the accounting acquirer. Sir, accounting acquirer is different from legal acquirer? Yes. Who will be the accounting acquirer? In whose books we are going to actually do the accounting? This is the point, accounting acquirer. So that means in this particular step, you will have to trace out the accounting acquirer. Is it clear to you? This is what we mean by identification of acquirer. Identification of acquirer means you have to determine, you have to find out who is going to be the accounting acquirer. And how we are going to actually find out that who is going to be the accounting acquirer. This is another important point. Now, in order to understand this particular point, because it will consume a bit of time, but once you are going to understand it quite well, you will find that how easy it is to actually prepare the consolidated financial statement. Anyway, first of all, you write here group's share capital. What is the group's share capital? And what we mean by group? And before I move further, let me also just give you a bit of idea. Actually, because at this particular moment, A is the legal acquirer. And of course, B is legal acquiree. In other words, A is the parent company, B is the subsidiary company, but legally, A is the acquirer company, legally, from the legal perspective. Obviously, these two entities will form a group. It is known as group. Group consists of parent company and what we call subsidiary company or acquirer company or acquiree company. That is what we mean by group. Now, if I am asking you, see here, I have written group share capital. Some of you may say, if I am going to ask you, what is the group share capital? So many among you may attempt to give me answer like this. Sir, share capital of company A is 10 lakh and share capital of company B is 5 lakh. So group share capital must be equal to 15 lakh. So some of you may attempt to say so, isn't it or not? Tell me honestly, quite obviously. So many among you may think actually that group share capital is combination of total share capital of the group. No, nothing like that. Never make this particular mistake. Whenever I am going to ask you or whenever you are going to actually do this particular step, that is identification of acquirer, group's share capital, even though we write group share capital, indirectly it means share capital of legal acquirer. I have written here in red pen. See here. Group share capital doesn't mean that share capital of company A and company B. It means the share capital of only legal acquirer. Who is legal acquirer? Legal acquirer is company A. So note down the share capital of company A, you have noted down. Note down the face value of the share. Indirectly, you have noted down the number of share. So number of shares in the group will be considered as 1 lakh. Time and again, I'm telling you, don't be under a phobia or under a notion rather actually that group share capital means combination of share capital of both the companies. No. Whenever you will write group share capital, you will have to take into account who is the legal acquirer. And now actually, you simply take into account this particular share capital, that is 1 lakh. So number of shares is 1 lakh. After having noted down the number of shares of the group, of course, it is known as number of shares of the group. Now you will find how many shares are held by A Limited. Now some of you may think actually, sir, what a childish question. All these shares belong to company A, so obviously all these shares are held by A. No doubt about it. It looks very childish, but I will tell you the importance of this particular point later on. At this moment, no doubt about that, all these shares are held by what we call company A, and none of the share is held by company B. So, in the group, majority of the share are held by company A. That is why company A will be considered as accounting acquirer. Remember one thing, as per Ind AS 3, accounting is done not in the books of legal acquirer, rather it is done in the books of accounting acquirer. And also let me also tell you that 99.99% the legal acquirer will remain what we call accounting acquirer. But sometime opposite may happen, and how it can happen I will let you know in a short while. Just pay attention. Before I move further, let me clarify. I know many points are going in your mind, so let me clarify this particular point. Suppose Suppose in this particular question, because in this particular question it is stated that purchase consideration of 12 lakh is to be discharged by way of cash. In this particular question it is written like this. Is it clear to you? Suppose in this particular question it would have been written that purchase consideration is to be discharged by way of shares. Because company A is going to discharge the purchase consideration and the face value of the share of company A is 10. So in order to pay 12 lakh, company will have to issue 1,20,000 shares of 10 each in case company A decides to make the payment through issuance of the shares. In this question, no doubt it is given that purchase consideration is to be discharged by way of cash. But just to make the point a little bit more clear, now suppose if in this particular question it would have been given this way around, then how this particular step would have unfolded. Now pay attention. In order to know actually who is accounting acquirer, I would have had first of all written group's share capital. Group's share capital. And we know that group's share capital means share capital of legal acquirer. Share capital of legal acquirer. Who is legal acquirer? Company A. Correct? Legal acquirer. Group share capital means share capital of legal acquirer. As I told you, who is the legal acquirer? Company A. Now you will have to find out total number of shares at this moment issued by company A. As per the balance sheet, we know because the share capital of company A is 10 lakh divided by 10. So number of shares as per balance sheet of company A is 1 lakh. But we must not forget now that company A has issued 1,20,000 shares to discharge the consideration. Correct? Now, if in the question it would have been given that company A has discharged the consideration by way of share, in that case, the total share capital of company A, total number of shares of company A would have been 2,20,000. Is it clear to you or not? That is why I am saying this is a pretty important point. So 2,20,000 total number of shares which are issued by A, but it will be considered as share capital of the group. It will be considered as share capital of the group. Now you will have to find out of 2,20,000 how many shares are held by company A. Don't say, for God's sake, don't say 2,20,000. Only 1 lakh shares have been held by company A because 1,20,000 shares have been given to company B. So now I would say that in the group, out of 2,20,000, 1,20,000 shares have been held by company B. And now here you have noticed that in the group, majority of the shares are, or what we call bigger number of shares are in the hands of company B. So in this case, company will become the accounting acquirer. And if it happens, then it is known as case of reverse acquisition. Is it clear to you? And I have kept a separate section for reverse acquisition that I will let you know later on regarding the accounting aspects. But anyway, in this particular question, because some of you otherwise may feel I'm writing here total number of share 1 lakh, then I'm asking this particular question, how many held by A Limited? So some of the students tend to actually these things look very childish. But the point is that you must have noticed that why it is important. Anyway, so once you have determined who is going to be the acquirer company, the next step is now identification and measurement of assets and liability. What we mean by identification and measurement of liability, identification and measurement of assets and liability, because now you have got the control over the other entity, correct? And you will have to prepare the consolidated financial statement. In order to prepare the consolidated financial statement, you will have to actually bring all the assets and liability which are appearing in the books of your acquiree to your books. Correct? Indirectly, you will say that you will have to take over all the assets and liability. And remember, actually, you are not taking over. Only thing is that in order to prepare consolidated financial statement, you will have to record all the assets and liabilities which are appearing in the books of B Limited. Is it clear to you? Now we have already seen. Now, if you are going to look into the column of company B Limited, you will find over there is property, plant and equipment. So obviously, property, plant and equipment you will take over. The rule is that you are going to take all the assets and liability at fair value. But the point is that in this particular question, no fair values separately have been given, only balance sheet values are given. So we will presume that balance sheet value is equal to the fair value. That is what we mean by measurement. That means I'm going to take over property, plant and equipment. I'm going to measure it at 15 lakhs. Similarly, I will take over the current asset, and the value of the current asset in the balance sheet is 10 lakh. We'll presume that itself is the fair value. I will take over the current asset also. Is it clear to you or not? So this is what we mean by identification of assets and liabilities taken over. Similarly, there is liability of B Limited. So liability of B Limited is appearing in the balance sheet at 10 lakh. So that means you will have to identify that which are the assets which you are taking over, at what value you are going to take over. Although this step is just for the sake of what we call, you can say, to explain the guideline of the standard. Now we come over to the fourth step. The fourth step is pretty vital. Under the fourth step, what we are supposed to do. See here, I have written in the title, determination of net assets of acquiring company on the date of acquisition. Your date of acquisition is 1/4/2026. 1/4/2026. And just a day ago, the balance sheet date is 31/3/2026. Technically, in accounts, both these dates are considered as one and same date. Is it clear to you? Anyway, but your date of acquisition will be 1/4/2026. So now I have to find out the net assets. I have to find out the net assets of the acquiring company. You need to pay attention. Who is the acquiring company? Company B is the acquiring company. So on the date of acquisition, I need to find out the net assets of the acquiring company. On the date of acquisition, this is also very important. Date of acquisition is also known as date of acquisition. Of course, you can easily find out net assets, because net assets means assets minus liability. But I don't want you to actually follow this particular approach in order to find out net assets. Sir, why? I will let you know about that later on. But we know that net asset is always equal to assets minus liability. We know this. Correct? But we also know that net asset is always equal to equity. We know in accounts, net assets is always equal to equity. And what we mean by equity? Equity means share capital plus other equity. Share capital plus other equity. Other equity means reserve and surplus. So you can find out net assets simply by applying this formula, assets minus liability. But due to some or other reason, actually, I'm not asking, I would never advise you to follow this particular methodology of finding out the net assets. Why? That could actually land you in some trouble under some cases. So that is the reason actually I'm stressing upon that you need to actually follow this method of finding out the equity. Is it clear to you? So in order to find out equity means net assets. Ultimately, we have to find out the net assets. In order to find out net assets, I can simply find out the equity, because equity always means net assets. So on the date of acquisition, I need to find out equity. As I told you just a moment ago, in order to find out the equity, what I am going to do? First of all, I need to know whose equity I am supposed to find out. I am supposed to find out the net assets or equity of what we call acquiring company. So I will look into the balance sheet. The date of acquisition is 1/4/2026. I have already told you 1/4/2026 or 31/3/2026 is one and same date. So I will take into account the share capital. The share capital which is appearing on 31/3/2026, indirectly it means it is also appearing on 1/4/2026. So on 1/4/2026, share capital of what we call this particular entity, acquiring entity, is 5 lakh. I am going to record it. Then I will look into the other equity of the acquiring entity. The other equity of the other entity is 10 lakh. Is it clear to you? As I told you, share capital plus other equity will deliver you equity, and equity means net assets. So you can see very easily you are able to find out net assets. So total net assets of the what we call acquiring company happens to be 15 lakh. Now, in these net assets on the date of acquisition, acquiring company or subsidiary company is having net asset equal to 15 lakh. Because you are having 60% control now, on the date of acquisition, you have acquired 60% share. Whenever we acquire shares in the other entity, what does it mean? That means 60% of the net assets of the other entity now belong to us. So here I have written acquirer. Acquirer share is 60%. So out of total net assets on the date of acquisition of acquiry company, 60%, that is 9 lakh worth of net asset belong to parent or acquirer entity. Similarly, 40% of the net asset belong to NCI or the other shareholders. Is it clear to you or not? The basic idea of what we call computing the net asset is to know actually out of total net assets on the date of acquisition of acquiry, what proportion belong to actually acquirer and what value of net asset belong to NCI. Is it clear to you? Now, under the fifth step, this particular standard, Ind AS 103, states that we have to find out goodwill or gain on bargain purchase. Obviously, we have made investment, very heavy investment, 60% shares we have acquired, we have paid 12 lakh rupees. So there will be some loss or gain. So in order to determine that loss or gain, standard says that we need to find out goodwill or gain on bargain purchase. Goodwill means capital loss, gain on bargain purchase means capital nature gain. Is it clear to you? So in order to find out goodwill, it is very simple because now you have already prepared this particular table. So in order to find out the goodwill, what you are supposed to do, simply take into account the amount of consideration which you have paid. I have written here consideration transferred. How much consideration we have transferred? 12 lakhs, isn't it? Now I will have to compare it with the net assets which we have acquired on account of our investment in the acquiring entity. So I will write here less share in net assets on the date of acquisition, of course, of acquiry. That means what is my share in the net assets of the acquiring company on the date of acquisition? We have just computed it that on the date of acquisition, total net assets of the acquiring company happens to be actually 15 lakh, and out of that 9 lakh belong to us. So quite obviously, out of 12 lakh, we paid 12 lakh, but we got what we call benefit or net assets of 9 lakh. That means amount of my investment is in excess of what we call my share of net assets. So that is why you can say it is a sort of capital loss to you. So simply you will write here goodwill. So if the amount of consideration would exceed the share of net assets of the parent or acquirer, then you will have the goodwill. Otherwise, you will have the gain on bargain purchase. And under step number 6, standard also states that you need to reflect the NCI, non-controlling interest. What we mean by that? It means on the date of acquisition, what worth of asset belong to NCI. So we can see that on the date of acquisition, total net asset is equal to 15 lakh. Out of that, actually 6 lakh worth of asset belong to other shareholders. So I will simply write NCI on the date of acquisition is 6 lakh. And now I am in a position to prepare the consolidated financial statement on the date of acquisition. In order to prepare the consolidated financial statement, only 2-3 points we need to take care of. The point number 1, especially related to liability. Point number 1 is that the share capital of acquiring company, share capital in this case acquiring company is B, share capital of acquiring company and other equity will not be taken into account. Why it will not be taken account, I will also let you know the reasons behind that. Correct? Now pay attention. Otherwise, all the items of both the company will be simply collaborated in a line-by-line manner, and what we call will put them in the balance sheet. For example, in this particular case, suppose if I am going to prepare the consolidated balance sheet, what and how I am going to prepare it. First of all, I will write the assets. Correct? As you know, the companies which follow Ind AS, they will have to prepare the financial statement as per Division 2. And under Division 2, we write assets first. So under the asset, I will write non-current asset, property, plant and equipment. First of all, I am going to write the property, plant and equipment of the parent. And then I will write the what we call property, plant and equipment of company B. I will simply add them together and put it in the outer column. This outer column figure is also known as consolidated figure. But at the same time, you should not forget to write here goodwill. The goodwill which you have computed under step number 5, it is always better to mention the step number. So amount of goodwill was 3 lakh. We must not forget to put it up. Then current assets. In the current asset, obviously the parent's current asset of 15 lakh, while the current asset of what we call our acquiring company is 10 lakh. But at the same time, I should not forget that these are the current asset basically on 31st of 3, 2026. And on the very next day, we have made an investment whereby we made the what we call payment in cash. So on account of that, our current asset will decline by 12 lakh because we'll presume that cash is included under current asset. So that is the reason I have subtracted here 12 lakh, and the consolidated amount will be 13 lakh and total amount will be equal to 51 lakh. Is it clear to you? Just a moment ago, I told you. Now when we will move over to the equity and liability side, as you know, under equity and liability side, we will have to write first of all equity. And when we are going to write here equity, I will have to write the share capital. Now, as far as share capital is concerned, just a moment ago, I told you, never ever in the consolidated balance sheet, you are going to put the share capital of acquiring company. The rule is that only the share capital of acquirer company will find place here. The reason is why we are not including the share capital of company B. The reason is that actually we have already exhausted this share capital in computation of net assets. You must have noticed here. We have already used the share capital and other equity of company B in the computation of net assets. So that is the reason actually we will have to ignore them out. Is it clear to you or not? So share capital of company B and other equity of company B will not be included as far as consolidation is concerned. So even the other equity only of parent will find place as far as what we call consolidation is concerned on the date of acquisition. Now, NCI is also, just your professional knowledge, that NCI is also considered as part of equity, but it is always presented as a separate line item. Is it clear to you? So separate line item, I am presenting it. So how you are presenting as a separate line item? Because I haven't written here C. I have written here A, B, but I have not written C. So that means it is presented separately. That is equal to 6 lakh. On the date of acquisition, NCI is 6 lakh. Remember one thing, we are preparing consolidated balance sheet on the date of acquisition. So on the date of acquisition, NCI is actually 6 lakh. And the liability 20 lakh plus 10 lakh, you will simply put them in a consolidated manner, and this is how you are going to prepare the balance sheet. Is it clear to you or not? Is it clear? Absolutely clear? I hope so. If it is clear to you, then we can move over to the next question also. Coming over to the next part. This was question number 1. I hope the things are clear. I have given you complete comprehensive what we call studies regarding what we call this particular chapter. Now we move over to 1.2. As far as 1.2 is concerned, let us see what is given in this particular question. Actually, the balance sheet of this question and the earlier question is same. Balance sheet of A Limited, B Limited, you can see the same figures are appearing here. 20 lakh, 15 lakh, 15 lakh, 10 lakh are current asset. These are property, plant and equipment. And similarly, share capital 10 lakh, 5 lakh, other equity 5 lakh, 10 lakh. And then liabilities 20 lakh and 10 lakh. So same figures. Correct? Even the balance sheet date is also same. Only difference here is that, first of all, here it is written, similar to the last question, that on 1/4/2026, we have acquired 60% stakes in company B Limited, and we paid the amount in cash. Even in this question, actually, we are paying the amount in cash. Correct? But here, the only difference between the last question and this question is that this time the fair values are given to you. You can see the fair value of property, plant and equipment is 17 lakh. Whereas the fair value of current asset of company B is 12 lakh, and similarly the liability now is having a fair value of 7 lakh. So this time fair values have been given to you separately. Besides that, here it is also written as contingent liability of rupees 1 lakh is appearing in the books of B Limited on this particular date. So company B is also having a contingent liability. What we mean by contingent liability? This is company B's balance sheet. Correct? In the balance sheet, we have written assets and liability. Obviously, the contingent liabilities are recorded at the bottom of the balance sheet in footnote, as you know. And the contingent liability is 1 lakh. What is a contingent liability? First of all, contingent liability basically means present obligation. What we mean by present obligation? Present obligation means the obligation on the reporting date. Obligation on the reporting date. Obligation on the reporting date. So on the reporting date, if there is an obligation upon me, and on account of that obligation, if I feel that chances of outflow of funds are quite less or insignificant, there is an obligation, but at the same time I feel actually that chances of outflow of funds are quite slim. So If chances of outflow of funds, as we call it, probability of outflow of funds are less, then we consider this obligation as contingent liability. Contingent liabilities are not recorded in the balance sheet, so that is why it is not a liability. Is it clear to you? But at the same time, if there is a present obligation and if we find that there is probability of outflow of funds, then we record it as a liability. So this time they have recorded it as a contingent liability because B Limited might be having an impression that our probability of outflow of funds is less. Now, logically, contingent liabilities are never reflected in the balance sheet, as you know better than I. But Ind AS 103 states that, as you know, Ind AS 103 states that if we are taking over an acquiree, in fact, if we are taking over the other entity, that company will become our acquiree company. If acquiree company is having a contingent liability, we will have to take over that liability also. Irrespective of the fact whether there is probability of outflow of funds or not, we will have to take over this contingent liability, number one. We will have to take over this contingent liability indirectly, means we will have to record it as a liability. Even though it is not a liability, but standard states that we will have to take it over and record it as a liability, correct? And we will have to record it at fair value. So that means in this particular case, even though company B Limited hasn't recorded this liability in its financial statement, correct, yet we are going to take it over and we are going to take it over at fair value of rupees 1 lakh. Obviously, it's a loss to acquirer company, to be very honest with you. If something is not appearing towards the liability side and still we are recording it as a liability, then technically it is a loss to us. No doubt about that. Also in this particular question, it is written that NCI is to be measured at fair value. As you know better than I actually, that because we have already done this particular chapter now, and most of you are very well aware that NCI can be measured at fair value, NCI can be measured at fair value, or NCI can be measured on proportionate share of net assets basis. Proportionate share of net assets basis. For example, in the last question, we recorded, in fact, we computed NCI on PSNA basis because we simply took 40%. This is the proportion of the NCI. And we simply multiply it with the net assets. The net assets were 15 lakhs, so 40% of net asset is equal to 6 lakh. In the last question, which we did, we in fact followed this particular approach. But sometimes question stresses that NCI need to be found out on fair value basis. On fair value basis. So how we are going to find out the value of the NCI? Because this time I cannot say that NCI is equal to 6 lakh because here in this particular question it is clearly stated that NCI is to be measured at fair value. Is it clear to you? So in order to know what is the value of the NCI, if question states that NCI need to be found out at fair value, so under such circumstances how I am going to compute? First of all, I will take into account the majority stakes. The majority stakes are held by company A. Company A has acquired 60% stakes. Then I will take into account how much company A has paid to acquire the majority stake, that is 12 lakh. Indirectly it means that value of 60% stake, and when we say value, indirectly it means fair value, because generally in practical life when we deliver the payment for acquisition of shares, that is as per the market value or fair value of the shares. So that is why it will be construed that 60% of the stake is having a fair value of 12 lakh. So now I can find out the fair value of 40% because NCI is 40%. So whenever we are being asked to compute NCI at fair value under such circumstances, this is the approach I will have to follow. I will take into account the majority stake, I will take into account the what we call purchase consideration, and then I can easily find out the NCI. So 40% fair value will be equal to this much, that is equal to 40 into 12 lakh divided by 60. I think it is coming to, I do not know exactly, but I think it is equal to 8 lakh. Correct? Of course, if you are going to compute NCI at PSNA, you will get a different figure. If you are going to find out NCI at fair value, you will get a different figure, no doubt about that. So in this question, how I am going to actually solve it? In order to solve this particular question, just to make the point a little bit more elaborative, here, yes, I have solved it for you already. I don't want to waste the time, that's the reason. Correct 1.2. As usual, first of all, as I just told you a moment ago, that in order to solve the question, we will have to take into account the date of acquisition. Always make it a habit of writing it. Date of acquisition obviously is 1/4/2026. Why? Because on this particular date, you have acquired the control, you got 60% shares. And then identification of the acquirer, because this is the same question, so I need not require to tell you, the same working will follow. Correct? In order to know the accounting acquirer, just a moment ago I told you we need to find out the total number of share issued by A Limited. Now, as per balance sheet share capital of A, because A is the legal acquirer, correct, we need to find out group's share capital, and group share capital means the total share capital of A Limited. Correct? Now, as per balance sheet, total number of shares of company A is 1 lakh. Here I have written plus issued for purchase consideration. Now in this question, because purchase consideration is being delivered through cash, so that is why here I have written a dash. So total number of share will be considered as 1 lakh of the group. Of course, all these shares have been held by company A and none of these shares have been held by company B. So that is why A will be considered as accounting acquirer. Correct? Just a moment ago, I told you in this step, third step, we need to know actually which are the assets and liability which we will have to take over to prepare the consolidated financial statement. Correct? That is known as identification. And at what value we are going to take them over, that is known as measurement. So of course we will have to take over property, plant and equipment. Although property, plant and equipment in the balance sheet is appearing at 15 lakh, but because in this particular question the fair value is 17 lakh, I will have to take them over at 17 lakh. Similarly, current asset I will have to take at fair value. Balance sheet value is 10 lakh, but I will take them over at fair value. Similarly, liabilities are 7 lakh. Liability in the balance sheet I think is 10 lakhs, but we'll take them over at fair value. And the most important point, just a moment ago I told you, you should not let it skip out of your memory that you are bound to actually take contingent liability in this particular case. And of course, contingent liability you will have to record later on in your balance sheet also, in your consolidated balance sheet also. So technically it is a loss, but at this moment we are simply trying to actually trace out which are the assets and liability we are taking over. So in the light of Ind AS 103, you need to understand that contingent liability must be taken over and must be taken over at fair value. So once you have determined this particular step, see, these are the initial questions. Later on, we'll find that we need not require all these steps. But these are the initial steps to make you thorough with the what we call complete guidance of Ind AS 103, because you tend to skip all these things. Now in this question, I have added a new step, that is fair value changes. Whenever there will be what we call different fair values will be given in the question, obviously there will be some loss or gain. On account of fair value changes, a fair value reserve will come into play. What I want to say is, just pay attention. Now, property, plant and equipment of B Limited, as I told you, it is appearing in the balance sheet at 15 lakh. Its fair value is 17. So there is a gain of 2 lakh in case of property, plant and equipment. In case of current asset, also there is a gain of 2 lakh because balance sheet value is actually 10 lakh and now the fair value is actually 12 lakh. However, in case of liability, because it is a liability, it is appearing in the balance sheet at 10 lakh, but its fair value is 3 lakh. So reduction in liability is a gain to you. So that is 3 lakh. But as I told you a moment ago, that contingent liability, this at whatever amount you are going to take over, that amount itself will be a loss to you because you are taking over the contingent liability at 1 lakh, so entire 1 lakh will be a loss to you. Now you will have to take the net of this, that is 4 plus 3, 7 minus 1 is equal to 6 lakh. This 6 lakh is known as fair value reserve. Fair value reserve. Is it clear to you? Now, what I am going to do, I am going to actually find the net assets on the date of acquisition. Just a moment ago, I told you in order to determine the net assets, what I need to do, I need to take into account the share capital and other equity. So share capital is actually 5 lakh, no doubt about that. Other equity of acquiring company is 10 lakh. But because in this particular question, there is a fair value reserve now got created because of changes in the fair value. And remember one thing, fair value reserve is also a part of other equity. So you can write here fair value reserve. So indirectly share capital plus total reserve is your net asset. So that is the reason actually why it is important to compute the fair value reserve separately, so that it will help you later on in computing the net assets. So now you can see that total net asset is equal to 21 lakh. Now in this question, don't commit this mistake. Correct? Simply by taking 60% in order to know the share of parent or acquirer entity. Don't do this mistake of directly computing 60%. In fact, I would advise you, first of all, always find out NCI, whether PSNA method or fair value method. Just a moment ago, I told you in this particular question, NCI need to be found out as per fair value. And I told you how we have to find out. For 60% it is 12 lakh, for 40% it is equal to 8 lakh. Because NCI on fair value is 8 lakh, that means out of total assets of 21 lakh, 8 lakh worth of net asset belong to other shareholders. So only balance will belong to acquirer company. Only balance amount will belong to acquirer company P Limited. Is it clear to you? That is why it is of paramount importance for you to understand that. Before you find out the respective shares of acquirer or parent and the acquiree, it is always better, first of all, to find out NCI share and then subtract the total net asset belonging to NCI from the total net assets to find out the share of net assets of parent. Is it clear to you or not? Well then, now after have done up with this particular step, now we are in a position to find out goodwill and gain on bargain purchase. Just a moment ago, I told you in order to find out goodwill or gain on bargain purchase, I need to write here the consideration. And then I need to know what is my share of net assets. So my means the acquirer share. The acquirer share is 13 lakh as I told you. Correct? 13 lakh. Here I have written. So 13 lakh is our share of net asset. Because in this case, our share of net asset is more than the amount of consideration. That is why it is known as gain on bargain purchase. Gain on bargain purchase means it is a sort of capital reserve. But in the terminology of what we call Ind AS, we call it gain on bargain purchase. And NCI on the date of acquisition will be considered as 8 lakh. So actually you can find out goodwill through these entries also. See here, you can pass the entries. Suppose question asks you to pass the entries. When we pass the entry indirectly, it means which are the assets which are taking over, which are the liabilities which are taking over, what is the amount of consideration, what is the amount of NCI, etc. So see here, we are taking over property, plant and equipment. It's obviously at fair value, then current asset. We are taking over the liability, but do not forget to write here contingent liability. Acquirer company will have to record the contingent liability. Now I will have to write the NCI, that is 8 lakh. I will have to write the consideration payable, that is 12 lakh. Now I will compare this. I will get the same answer. Gain on bargain purchase this time will be your balancing figure. This is your balancing figure. That means you can derive the value of goodwill or gain on bargain purchase through this particular entry. In the first entry, you have written here consideration payable. So you will write another entry, consideration payable account debit to cash account to discharge the consideration. And now you are in a position to prepare the consolidated balance sheet. In order to prepare the consolidated balance sheet, now I have already told you what you are supposed to do. Look into the asset side. Your own property, plant and equipment is 20 lakh. And at what value you have taken over the property, plant and equipment of company B at 17 lakh. So that is why now it will be written here as consolidated amount 37 lakh. In this question, there is no goodwill. Similar to the last question, current asset will appear at 15 lakh because 15 lakh current asset belong to actually acquirer company, 12 lakh to acquiring company, and 12 lakh cash we have paid to deliver the consideration. So the net amount of current asset will be equal to 15. 15 plus 37 is equal to 52 lakh. Correct? Now we come over to the equity and liability side. Under equity and liability side, just a moment ago, I told you that we are going to write here share capital of only the acquirer entity. Similarly, as far as other equity is concerned, I will write other equity of only company A, that is parent. I told you other equity of company B is already exhausted, correct, in computation of net assets. And because in this question there is gain on bargain purchase, you add it. So your total other equity will be equal to 6 lakh. This is important, gain on bargain purchase. Then NCI as usual, this time NCI will come at a value of 8 lakh because we have computed NCI at fair value. And to be very honest with you, it is the discretion. Ind AS 103 gives a right or discretion or a prerogative to what we call acquirer entity. That means it is acquirer company's prerogative whether they want to compute the NCI at fair value or at PSNA basis. Correct? But at your level in the examination, unless it is specifically specified to compute what we call NCI at fair value, it is always better to compute it on PSNA basis at your level. Correct? Now coming over to the liability side, another important point. Our liability is 20 lakh. The liability of what we call acquiring company is 10 lakh, but we are taking them over at 7 lakh. So total liability is 27 lakh. This is the consolidated amount. But in this question, do not forget to write contingent liability. It is contingent liability because we have taken over a contingent liability. We will have to record it. So total liability will be equal to 28 lakh. Is it clear to you or not? Correct? So we take a break of what we call 2-3 minutes, and then we'll continue with the proceedings with respect to this particular chapter. Hope it is coming up to your expectation. Looking forward to actually have your feedback, but still the class is on. Remember one thing, correct? Hello and great welcome. So after having completed now topic number 1, just immediately move over to your section number 14. Some of you might be wondering, sir, after having completed topic number 1, you are asking us to move over to topic number 14. Oh my God. What's the mystery behind that? I will let you know in a short while why I am moving over to topic number 14. If you will have a look over topic number 14, in this section, you must have noticed we have written recent examination question, correct? So now we are going to pick up this particular question, REQ1, and this question is from June 23 examination. This is related to the topic which we did, in fact. So the question which have stuck in the examination from the topic which we are taking simultaneously will cover that up. So that's the reason we are moving over to section 14 after having completed section 1. And in this particular section, this particular question actually relates to the topic which we have already completed, correct? So just pay attention over here. In this particular question, it is given below are the extracts from the balance sheet of S Limited and P Limited as on 31st of March 2023. So this is the balance sheet given to you of the two companies on 31st of March 2023. You must take notice of this particular fact that figures are in crores. This is your P Limited towards your right hand side, and we will see later on that P Limited is the parent company or acquirer company. And this is S Limited. And you must have noticed that in case of S Limited, there are two columns. One is balance sheet figure and another one is fair value. Is it clear to you? Now, in this particular question, first of all, it is given that equity share capital and equity share capital, one share happens to be of rupees 10 each. And here in the column of S Limited, it is written 8,000. It means 8,000 crore worth of share capital. And here it is written 12,000 in the column of parent or acquirer, that is 12,000 crores worth of what we call share capital. If we are going to divide it by 10, we can also get what we call number of shares. Number of shares of P Limited will be 1,200 shares, while number of shares of S Limited will be equal to 800 shares. Then we have in this case other equity, 6,000 in the column of S Limited and 4,000 in the column of P Limited. Besides that, there are borrowings. And as far as borrowings are concerned, correct, borrowings of S Limited as per balance sheet value is 2,000, but its fair value is also given. Now, if its fair value is given, you need to take note of this particular fact that whether the amount is going up or down. In this case, this amount is more than the balance sheet figure. Now, if the fair value of liability will be high, it will be a loss to you because you are taking a liability which is appearing in the balance sheet at 2,000 at a figure of 2,050. So quite obviously it will be a loss to the acquirer company anyway. So 50 will be considered as what we call loss in this particular case. Similarly, if you are going to have a look over the next item, next item is trade payables. And in case of trade payables, you must have noticed 2,500 is the balance sheet figure and 2,400 is the fair value. In this case, it is a gain because the fair value is less than the balance sheet value. Now, coming over to the asset side, in case of property, you have taken note of that balance sheet figure is 9,000, fair value is higher, again it is a gain. Then we have been given in this particular question investment property. What exactly the investment properties are? Investment property means a property which is held by an enterprise for the purpose of sale or for the purpose of capital appreciation or for the purpose of what we call earning rentals. So that is known as investment property. But anyway, so in this case, investment property value, fair value is higher. So again, it is a gain, 2000. Further, investments are also written over here, but no fair value is given. So we will presume that fair value is equal to 1000. In case of investment, there is neither any gain nor any loss. While current asset, you have noticed that fair value is less than the book value. So in this case, there will be a loss to the extent of 300. But the most important item in this particular question is contingent liability. Now, some of you may falter and may tend to think actually that the balance sheet value of the contingent liability is 800 and its fair value is 750. So in this case, it is a gain to us because the fair value of liability is less than the recorded value. But important point is that just to confuse you, it is given in this manner. You must understand that contingent liabilities are never ever written in the balance sheet. That means in the balance sheet, the value must be 0. You can say that way around because the value of contingent liabilities are never ever recorded what we call in the balance sheet. That is why they are contingent liability. And I told you just before the before the break, I just told you that the acquirer company will have to take over the contingent liability. And we will have to take over the contingent liability at fair value. If you remember, I also told that at whatever value you are going to take over contingent liability, that itself will be a loss to you. So in case of contingent liability, you will have to take it over at 750. That means this liability was not appearing in the balance sheet of what we call acquiring company, and in spite of that, you will have to take them over. So quite obviously, it will be considered as a loss to you. And in case of contingent liability, at whatever value, as I told you, which you will have to take it over, that itself will be considered as a loss because its fair value is 750. You will have to take them over at 750. So that's why 750 will be loss in this particular case. So in case of contingent liability, you will have to think on such line that contingent liability is not at all appearing in the balance sheet. And in spite of that, you will have to take over this liability and you will have to take it over at what we call fair value. So that's why it will be a sort of gain to you, a sort of loss to you. Further, in this particular question, it is written that market price of equity share of P Limited and S Limited are 16 and 15 respectively. Now, in this question, it is also given that market price of P Limited, that is acquirer company, and S Limited respectively are 16 and 15. So market price of the share is also given in this particular question. What role this market price will play, that I will let you know. Now, the question elaborates that P Limited acquired 75% stakes in S Limited on 31st of 3, 2023. So we have acquired 75% shares in S Limited on this particular date. And the purchase consideration is settled by issue of 800 equity shares for which no accounting effect has been given. For which no accounting effect has been given. What does it mean? Because we are given balance sheet on the balance sheet and the date of the balance sheet happens to be 31st of March 2023. And further, it is also elaborated later on that on 31st of 3, 2023, actually you are taking control. Is it clear to you? On 31st of 3, 2023, you are taking control. Even though this date will fall at the end of the year. So some of you should not get confused that at the end of the year, we may have to follow Ind AS to prepare the consolidated financial statement. In this case, because your date of control is falling at the end of the year, still you will have to follow what we call Ind AS 110, because on the date of control, when you are going to prepare the consolidated financial statement, without an iota of doubt, we need to follow actually Ind AS 103. But subsequent year end, obviously, we will have to follow Ind AS 110. Now, I was talking about this particular fact that what repercussion this line is having, which is saying that no accounting effect has been given to. Because we have got the control at the end of the year, that means the investment which we have made and the amount which we have paid for the same is not reflected in the balance sheet. Correct? Important point is that we got 75% share. P Limited acquired 75% share. And purchase consideration is 800 shares we are offering. We are offering 800 shares to settle the purchase consideration. Is it clear to you or not? Further, in this particular question, it is also written that non-controlling interest is measured at proportionate net asset value. At proportionate net asset value means PSNA approach. Actually, question, whenever in the examination I have seen actually, questions have been tossed up from India as 103, and especially if they are lengthy question, long length question. Such questions are not asking you to prepare a consolidated balance sheet, rather they are stressing upon to actually pass the entries. But anyway, I will completely solve this particular question as usual. So how we are going to actually go about this particular question, just have a look over here. Just to save the time, I have already written it, and moreover it is also given to you in a solved manner. As usual, the first thing which we are going to do in order to solve the question, I told you, we need to take care of the date of acquisition. The date of acquisition is at the end of the year, that is 31st of 2023. And second step obviously now is to know who will be the accounting acquirer. And I have elaborated it in the previous session, correct? That in the session before the break. In order to find out the accounting acquirer, we need to take note of group's share capital. First of all, you need to know who is the legal acquirer. Quite obviously, it is clearly given in the question that P Limited is acquiring 75% stakes in what we call S Limited. So, without any doubt, we are the legal acquirer, and S Limited is the legal acquiring company. So P Limited is the legal acquirer. I told you, in order to find out the group's share capital, we need to take care of legal acquirer only. The legal acquirer is P Limited. So you need to take note of total number of shares of P. Now their total share capital is 12,000. You are going to divide it by 10. So you can see that as per balance sheet, the number of shares of P Limited is 1,200. Now, in this question, it is very important that you need to take note of in what mode actually we are paying the purchase consideration. It was given in the question that in order to discharge the consideration, P Limited will offer 800 shares. So, issued shares for purchase consideration is 800. So, you can see in this particular case the total number of shares of A Limited, total number of shares issued by P Limited, will be equal to 2,000. Is it clear to you or not? Once you have determined the total number of shares issued by P Limited, now you need to find out what proportion of these shares are held by P Limited and what proportion is held by now S Limited. Now this will be considered as group's number of share capital. Now out of 2,000, even in the last session I told you, do not actually make a folly of saying that P Limited is having 2,000 shares. No, out of 2,000 shares, these shares have been definitely issued by P Limited, but P Limited is having only 1,200 shares because we have issued 800 shares to S Limited, so 800 shares are held by S Limited. But in spite of that, out of 2,000, greater number of shares are in the hands of P Limited, so P Limited will be considered as accounting acquirer. Is it clear to you? Now the next point is that because in this particular question, lots of fair values are given, so we need to take charge of what we call revaluation of fair value changes. And I have already explained, as far as property, plant and equipment is concerned, I told you the value has gone up by 1,000. Similarly, in case of current asset, I told you value has gone down by 300. Whereas in case of investment property, I told you value has gone up by 2,000. And in case of trade payables, value has, there is a gain, I think, of 100 because the balance sheet value is 2,500 and the fair value is 2,400. Whereas in case of borrowings, I told you there is a loss to the extent of 50. Correct? Now I will total them up to get 2750. And we should not let it skip out of our memory that contingent liability will be considered as a loss because we are taking over the contingent liability which was not recorded in the balance sheet. So at whatever value we are going to take them over, that itself will be considered as a loss. So the net amount still is a gain. This 2,000 will be considered as fair value gain. Is it clear to you? Or fair value reserve. Once we have determined the fair value reserve, now the next point is that we are now in a position to find out net assets on the date of acquisition. I have already told you, in order to find out net assets on the date of acquisition, we follow equity approach, whereby we need to take into account the total equity share capital of S Limited, which is 8,000 in the question, correct? Then we need to take care of other equity given of S Limited is 6,000, and then Whatever what we call fair value reserve is there, you should not forget to add it here. In fact, fair value reserve is also a part of what we call other equity as a 2000. So all in all, now we can say that on the date of acquisition, total net assets of this particular company S Limited is equal to 16,000. Now out of 16,000, you can separately compute the respective share. You can also compute it what we call here itself. But just to make it a little bit more clear, I told you yesterday it is always better to first of all compute the share of NCI. So as per PSNA approach, I told you all we need to take care of is to know the proportion of the NCI, because we are having 75% stakes in this particular case. Other shareholder must be having 25% stakes, and 6 into 16,000. So proportion of net asset which belong to actually NCI is equal to 4,000. And of course, the parent share or P share or acquirer share will be equal to 12,000. Then we are in a position to find out actually goodwill also. In order to find out the goodwill, what I need to do, I simply need to compare the amount of consideration which we have paid. Now the next point is how much consideration we are paying. And here it is very important point. It was given in the question that P Limited is offering 800 shares. But it was not given what was the amount of purchase consideration. So you need to take care of this particular fact that here P Limited, the acquirer company, is issuing 800 share and the market value of the share of P Limited is 16. So you need to multiply 800 share which are being issued by P Limited, of course to S Limited, with the market value of P Limited. So 800 into 16 will give you 12,800. So this is the amount of purchase consideration. And as we have seen that against this purchase consideration, we are getting net assets worth rupees 12,000. So the difference will be considered as goodwill simply because consideration figure is higher. We can find the same result by passing the entries also. In the entries, we need to take care of the items which we have taken over and add the value which is associated with them. For instance, the property, plant and equipment we are taking over, but their fair value is 10,000. Inventory we are taking over at a fair value, at a value of 1,000. Investment property at a fair value of 7,000. Actually, this is not inventory. I think this is investment. Let me check it up, because in this question I did not find any inventory. Just let me check it up. Yes, it is actually investment 1,000. I unfortunately wrote inventory. Anyway, here I have written in the entry, you write it as investment, correct? Sometime mistakes occur. It is actually investments. Actually, investment we will take over at balance sheet value itself, because their fair value is not given. So we will presume that balance sheet value itself is equal to what we call fair value. Then investment property we are taking over at 7,000, current asset at 3,200. And then I will write the liabilities which we have taken over, borrowings at 2,050. We are taking over trade payable at a fair value of 2,400. And now we will have to take over the contingent liability also. Then I will write the amount of consideration payable and NCI. Then I will take the difference. The difference will give me goodwill. Correct? The same result we can get through what we call this particular entry. And then the whatever consideration payable is recorded here, then you pass the entry to settle the same. The consideration payable 12,800. You will write here 2 share capital, because we are offering 800 shares at the rate of rupees 10 each. So 8,000 will be the amount of share capital, and security premium will be 800 into 6, because you are issuing share worth rupees 10 at the rate of 16. So this is how you are going to actually pass the entries. Is it clear to you or not? This is how you need to do this particular question. And that's the reason actually I picked up this particular question first. Now we will again come back to it. So now we have finished section 1. Now we'll move over to section 2. Actually, section 2 I need not require to tell anything, because that particular section deals with goodwill. Correct? Now we move over to section 2. Now, in this particular section, a simple question is given. Generally, such questions comes in the form of MCQ. Here it is written that on 1st of January 2023, Hansa Limited acquired 70% of the equity shares of Nainital Orchards Limited in exchange of cash consideration of 700 lakh. So there is an entity by the name of Hansa Limited in this particular question, as you have already noticed. Now, Hansa Limited is acquiring 70% stakes. It is also given to you in the question. And the other entity is Nainital Orchards Limited. Nainital Orchards Limited. Correct? Also, it is given in the question that you are acquiring 70% stakes against a consideration of 700 lakhs. Against a consideration of 700 lakhs. And it is also stated that 700 lakhs worth of consideration is being paid by H Limited in the form of cash. Now, here it is mentioned that net identifiable assets are measured at 1,500. The identifiable assets are measured at 1,500 and the liabilities assumed are measured at rupees 600. Indirectly, it means when I am taking over the business of what we call Nainital Orchards Limited, so on the date of acquisition, their assets have been measured at, or their assets have been identified at a value of 1,500 and liabilities at a value of rupees 600. If I will take the difference, I may say their net assets have been worth rupees 900. Is it clear to you or not? Further, it is given now in this particular question that NCI need to be computed at fair value. The first of all question states that I need to find out NCI at fair value, and after having computed the NCI at fair value, I need to find out the amount of goodwill also. This is the first question. Whereas in the second question, it is stated that I need to find out NCI on proportionate basis, and again I need to determine the goodwill. Quite obviously, when NCI will be valued at fair value, the amount of goodwill will differ from what we call NCI valued at PSNA basis. So just to elaborate the point, actually it is not very tough task. You can easily manage this particular question. But just to make the point a little bit more clear, what I am going to do, just pay attention. In order to solve this question, I will solve it here itself because there is nothing. So first of all, I will take care of the net assets. The total net assets on the date of acquisition as we computed is equal to 900. Total net asset is equal to 900. Now out of 900, what is the share of NCI? Because it is stated in the question that NCI need to be determined at fair value in part first. Let us say we are solving part first. Correct? So NCI at fair value, first of all, I need to determine. And in order to determine the NCI at fair value, I told you even in the last session means the session before the break, that first of all, I will need to take care of the total number of stakes which have been acquired by the acquirer company. So acquirer company has acquired 70% stakes and they have paid an amount of 700 lakhs to acquire 70% stakes. Indirectly, it is considered as fair value. 700 is considered as fair value of 70% stakes. Now, because we are having 70% stakes, quite obviously, NCI will have 30% stakes. So, what will be the fair value of 30% stakes? So, if I am going to compute, it will be equal to 30% into 700 divided by 70. Divided by 70. I think it will be equal to 300. So we may say that out of 900, 300 worth of net asset belong to NCI. So the remaining assets, so the balance of the asset, will be equal to obviously 900 minus 300, that will be equal to 600. Is it clear to you? So indirectly it means it is parent share or acquirer share. So acquirer's share of net assets will become equal to acquirer's share. Acquirer's share will be equal to 600. Is it clear to you or not? Obviously, in order to determine the goodwill, now what I need to do, I need to find out the amount of consideration. As far as consideration is concerned, it is very clearly given in the question, which is 700. Is it clear to you? Then I will subtract what we call share of net assets. Now, share of net assets of acquirer we just computed is equal to 600. So, in this case, I may say that 100 is the amount of goodwill because the consideration amount is higher. So, this is how we can compute the amount of goodwill. Indirectly, it means if NCI is equal to 300, in that case, goodwill is equal to 100. And remember one thing, when we prepare the consolidated financial statement, it is not part of solution. It is just to make the point a little bit clear. When we prepare the consolidated financial statement, you know already that goodwill will be reflected towards the asset side. I will write the amount of goodwill as 100. and then I will reflect also NCI to on the equity and liability side, and the amount of NCI is equal to 300. So this is how these items will be reflected in the balance sheet. Just for your knowledge sake, when we compute the amount of goodwill, after having valued NCI at fair value, when we compute the amount of goodwill after having computed NCI at fair value, the goodwill which we arrive at is also known as, this 100 is also known as full value of goodwill. It is also known as full value of goodwill. It is also known as full value of goodwill. Is it clear to you? This is also known as full value of goodwill. This is just for your knowledge sake. Now, suppose if I am going to solve this particular question, part 2, just let me actually rub it out. If I am going to solve this particular question by valuing NCI on PSNA basis, so what will be my answer? First of all, I am going to write the net assets. Net assets we have seen is equal to 900. And out of 900, I am going to find out NCI share. Now this time NCI need to be valued on PSNA basis. So NCI on proportionate share of net assets basis will be equal to how much? 30% is the stake of NCI. And total net assets on the date of acquisition is equal to 900. So quite obviously, in this case, share of NCI will be equal to 270. Obviously, now the remaining net asset will belong to acquirer. So acquirer share of net assets will be equal to 900 minus 270. I think it is equal to 630. Now I can compute the amount of goodwill. In order to compute the amount of goodwill, I will simply write the amount of consideration. And the amount of consideration we have seen is 700. I will simply now subtract the share of net assets. Now share of net assets, as we have already seen, is equal to 630 in this case. So what you have found out, actually in this case, we are getting a goodwill of rupees 70. I told you a moment ago, when we compute NCI on fair value basis, in that case, the goodwill which we get is also known as full cost of goodwill or full value of goodwill. Now, in this case, when we value the NCI on PSNA basis, in this case, the amount of goodwill which we get is also known as partial goodwill. It is also known as partial goodwill. Is it clear to you or not? Now, in this case, just pay attention, just for your knowledge sake. When I am going to prepare later on consolidated financial statement, just a moment ago, I told you I am going to reflect the amount of goodwill towards the asset side. Now, in this case, I am going to reflect it at 70. And NCI this time will be reflected at 270. NCI will be reflected at 270. Now, you need to understand, some of the students actually get confused because they never ever get the entire story before them. Now, I am going to talk about the entire story, even though these are fast track sessions. Many students think actually we are getting a different goodwill, and here we are getting an amount of goodwill of rupees 100. So, we are not able to understand it quite well. Some of the students may feel so. Now, I will tell you, if you remember in the session before the break, actually I told you it is the prerogative of the acquirer company. It is completely their discretion whether they intend to actually value NCI on fair value basis or on, as I told you, or on what we call PSNA basis. But ultimately, even though we are getting a different amount of goodwill, correct, and different amount of NCI, ultimately it is not going to make any difference in the consolidated financial statement. How? I will let you know. See here, I told you when I valued NCI on fair value basis, I have written rupees 100 towards the asset side. And in this case, NCI worth is 300. Remember one thing, goodwill is written towards the asset side and it is written towards the liability side. I also told you it is known as full cost of goodwill. What we mean by full cost of goodwill? See here, full cost of goodwill indirectly means the goodwill which is appearing in the consolidated balance sheet. This goodwill, some portion of this goodwill belong to parent or acquirer and some portion of this goodwill belong to NCI. Because 70% portion is held by parent, so rupees 70 worth of goodwill will belong to acquirer company and 30 worth of goodwill belong to actually NCI. Now you can see, because this part of goodwill belong to NCI and this part related to NCI is written on the asset side and 300 is written on the credit side. So the difference, as you can see, is equal to 270. The difference is 270. You must have noticed indirectly now I can say that I have written goodwill amount of 270 here and 30 minus 300, 270 is NCI. Is it clear to you? And now, when we compute the amount of goodwill this way around, in this case, goodwill is known as partial goodwill. What we mean by partial goodwill? It means the entire goodwill belong to acquirer company or parent company. So you can see NCI is 270 and parent share of goodwill is 270. In both the cases, ultimately, we are getting the same results. So that is the point. Anyway, generally such questions are asked in the examination in MCQ form. Now, there is another very important topic, and you can take my hair as a bet that, it's a phrase in English, you can take my hair or in a bet, that means I'm giving you almost a sort of what we call surety that from this particular section you are going to get a question in the examination, correct? Because when we are going to analyze the question paper of the last 5 attempts, actually what we have seen, a question from this particular part is striking with great velocity in the examination. Correct? So you need to pay a little bit what we call high amount of attention as far as this particular topic is concerned. So in order to comprehend this particular topic, first of all, we need to know actually what we mean by business combination achieved in stages. I know that each one of you by now are well familiar with this particular concept, but in spite of that, business combination achieved in stages in simple words means just pay attention. For example, there is an entity and this entity is, let us say, E1, and let us say it has made 27% worth of stakes in company F1, correct? Because my investment, let us say this is year 1. In this year, we made an investment to the extent of 27% only. Obviously, we are not having any control in this particular case. That's a different matter. We are exercising significant influence because our investment is more than 20%. If your investment is 20% or more, but up to 50%, in that case, other entity is your associate entity, but it cannot be your acquiring or subsidiary company. Let us say in the next year or after some time, let us say in year 3, correct? In year 3, again, entity E1 acquired, let us say, 30% stakes in F1 Limited. So this 30% will be considered, first of all, as additional investment because you have already made investment, and this investment now will be considered as previously held investment, PHI. It will be considered as previously held investment, and now you have made additional investment. And because you have made the additional investment to the extent of 30%, so indirectly, after making the additional investment, total worth of stakes in F1 Limited obviously will go up by more than 50%. Indirectly, it means additional investment when you made, actually it brought you control over the other enterprise. So when control is acquired on account of additional investment, that is known as business combination achieved in stages. Is it clear to you or not? Is it clear? So this is the first thing which you need to understand. Another important point which you need to understand, because the student do this particular part, but as I told you, problem with the CMA student is that no one is telling them the entire stories. But anyway, and stories means the full-fledged knowledge. As I told you, in this particular case, my previously held investment was 27%, my previously held investment. And a moment ago, I told you I made additional investment to the extent of 30%. And I also told you on account of additional investment, now we are having 50% stakes. So indirectly now we got hold of or the control over the other enterprise. That is why it will be considered as business combination achieved in what we call stages. Another important point is that when we make the investment, correct, whenever any entity will make the investment in the other entity, the investment is an asset for the entity which is making the investment. Correct? For the investor entity, the amount invested in the other entity obviously is an asset. I need to require to talk about that. But the important point is that which you need to understand. The investment is considered as financial instrument. In fact, it is considered as financial asset because it is a financial instrument. Correct? As you have already gone through financial instruments, some of you must have gone through financial instrument. You know that financial instruments are financial asset, financial liability, and what we call equity instruments. Actually, the investment is covered by Ind AS 109, and it is a financial asset. In financial instrument, as per Ind AS 109, I can measure my investment in equity instrument. Investments in equity instruments. Investment in equity instruments can be measured. I do not know whether you have done it or not, but you need not require to worry. The investments in equity instruments are generally measured as per FVTPL approach. FVTPL means fair value through profit and loss account, or you can measure them as per FVTOCI approach. For example, if I have made investment in other entity, I can measure my investment as per FVTPL approach or as per FVTOCI approach. What does it mean? It means if there will be any change in the value of the investment, as you know, because it is a financial asset, we have made the investment in the equity shares of the other entity. With the passage of the time, the value will definitely change. So if there is change in the value of the financial instrument, so there will be gain or loss. So if we have decided, or the policy of the entity is to measure the investment as per FVTPL approach, indirectly it means whatever change in the value is there, that change will be recorded in profit and loss account. That is the meaning of fair value through profit and loss account. That means change in fair value will be recorded in profit and loss account. And if the policy of the entity is to measure them as per FVTOCI approach, then whatever change will take place, that change will be debited or credited to other comprehensive income. Other comprehensive income means the lower part of profit and loss account. Is it clear to you or not? So it is the prerogative of the company, it is the choice of the company whether they want to measure their investment as per FVTPL or what we call FVTPL or FVTOCI. So generally the question which you get in the examination with respect to business combination achieved in stages, the first thing is that you must notice this fact, whether the previously held investments are being recorded at FVTOCI or these are being recorded as per FVTPL. Correct? You must take note of that. If the question is silent, then you always presume that these are being measured by the entity as per FVTPL category. Is it clear to you or not? Why I am saying so? Because when you will do the accounting on this particular date, generally it will be given to you that some change has occurred in these investments. So you will have to record those changes. So whether you will take the gain or loss because of change in P&L or in OCI, that will depend upon the policy which is followed by the entity. So that is why you need to take care of this particular fact. So these are the important ingredients as far as this particular topic is concerned. Another important point is, when you are taking control of this particular enterprise on this particular date, obviously it will be given to you what is the amount, how much amount you paid to acquire additional 30% share. Obviously it will be given how much additional consideration you have paid, and you will be also given the net assets on this particular date. And question will ask you to actually find out the goodwill. So how the goodwill is found out under business combination achieved in stages, correct? And what else we need to do in order to understand that, just pay attention over here, correct? In 3.1 in this particular question, it is given that there is an entity by the name of A Limited and it acquired 35% of stakes in entity B in 2021. So in 2021, it is stated in this particular case that we are acquiring 35% stakes, correct? We have acquired 35% stakes, and we acquired 35% stakes by paying rupees 35,000 rupees. Now it is given to you in the question that in 2022, fair value of the shares of entity B is 42,000. Indirectly, it means because entity A has invested in entity B, number one. Indirectly, it means because earlier it was written you acquired 35% shares in entity B and you paid 35,000. But now it is stated that in 2022, value of these 35,000 worth of shares has gone up to 42,000. So you must have noticed actually now there is a change in the fair value of the investment. Of course, there is a change of rupees 7,000 and it's a positive change because the value has gone up. So how I am going to record it? Here it is also stated in the question, thus rupees 7,000 reported under OCI in 2022. Now here the question has specified that this change in value has been recorded in OCI. Indirectly, it also means actually that company is following a policy of recording the investment as per FVTOCI. Is it clear to you or not? It is also given A Limited, actually A Limited further acquired 40% stakes in B. Earlier you were having 35%, now you acquired further 40% stakes in B Limited. I need not require to tell you what will happen. Now we will get the control on account of additional investment. Consideration paid 60,000. So in order to acquire 40% share in B Limited, we paid 60,000. This 60,000 consideration obviously has been paid to acquire additional investment. Entity A identifies the net assets of B Limited as 1,20,000. I told you it will be given to you. What will be the additional consideration? In this case 60,000. It will be also given to you the amount of net assets. So it is clearly written that net assets, that means assets minus liability, on this particular date is 1,20,000. Another important point which is given, value of 35% shares is 45,000. Value of 35% stakes means your previously held investment. On this particular date means on the date of additional investment, your value of previously held investment is 45,000. Now it is also stated that NCI is to be valued as per net assets approach, that means on PSNA approach. Although I have solved everything, but still my heart says that I need to elaborate it further, and for you I have taken lots of pains. Correct? See here. In the question, it is written 21 and intentionally I have simply written year 1. Correct? It is written in the question that in year 1 or in year 2021, we have 35% stakes in the other entity and we acquired these 35% stakes by paying rupees 35,000. The other entity is B Limited. Is this clear to you or not? Further in the question, it was stated, obviously it will be considered as previously held investment. It will be considered as previously held investment. Now here it is given in next year, that means year 22 or year 2. It was given in year 2022, the value of previously held investment now is 42,000. Let us say on this particular date, the value of our previously held investment is 42,000. That means value has gone up by 7,000. And it was given in the question that the increment of 7,000 was reported in OCI. So I will have to pass this particular entry as far as solution is concerned. First of all, I will have to pass this entry, investment in B Limited, because the value of my investment in B Limited has gone up. Investment is a financial asset for me. So I will debit investment in B Limited by 7,000 and I will write here to OCI. However, if the question is silent, then I will always presume that the policy of the entity to measure the previously held investment was on FVTPL basis. In that case, I would have had written to profit and loss account. Is it clear to you or not? This time I will write OCI, other comprehensive income, because it is clearly given in the question that company is following a policy of measuring the investment as per FVTOCI. Is it clear? Now, in the question, it is also given, exact dates are not given, but it is given that company made additional investment in year 2 or in year 2022 to the extent of 40%. To the extent of 40% additional investments were made. Indirectly, 35% was my previously held investment, 40% is additional investment. That means now I am having 75% stakes in this particular company, isn't it or not? Also given that in order to acquire additional 40% stakes, we paid consideration of 60,000, and it is also given on this particular date the net assets of B Limited have been identified as to the extent of 1,20,000. Important point is that regarding your previously held investment, there are two types of increases. Earlier increase was worth rupees 7,000, correct? And now your investment on this particular date has gone up to 42, and on the date of control, because now this will be considered as date of control, it was stated in the question that our previously held investment were assessed at 45,000. That means now their fair value on the date of acquisition is equal to 45,000. So because the value again is going up from 42,000 to 45,000, so again I will have to pass this particular entry, investments in B Limited account, because we have already recorded the investment at 42 after having passed this particular entry. So now I will have to increase the investment from 42 to 45, that means by 3,000. So investment in B Limited account debit to other comprehensive income. So total amount credited to other comprehensive income is 3,000. But here you need to be alert. You need to be alert. Whatever amount on account of change in fair value which you have credited to other comprehensive income will be reclassified to profit and loss account, as we call it, reclassified. Is it clear to you or not? The reason behind is that because earlier this entity was an associate, but now this entity has become our subsidiary company or our acquiring company, so we need to cancel out our what we call old investments. And the standard says that whenever we are going to cancel out or whenever we are going to dispose of our investments, then whatever amount on account of fair value change has been taken to OCI will be reclassified to other comprehensive income. So that's the reason actually in this case that whatever amount which you have taken to other comprehensive income, 7 plus 3, 10,000, you will reclassify it to P&L. That means now I will debit other comprehensive income and credit the profit and loss account. Is it clear to you? Another important point is that these are the entries which you are supposed to pass, and further you need to find out the goodwill. And here you need to be a little bit more alert in order to find out the goodwill actually in case of business combination achieved in stages. Obviously, on the date of acquisition, we will have to note down the net assets. The net assets of B Limited is stated in the question is 1,20,000. As usual, first of all, I am going to find out NCI share. And NCI, it is clearly stated in the question that we have to measure it on PSNA basis. So because total number of shares, now we are having 35% plus 40%, that is 75%. So the stakes of NCI will be 25%. So 25% proportion into 1,20,000 worth of net assets. So we may say that out of 1,20,000, 30,000 worth of net asset belong to NCI. Obviously, the remaining asset, 1,20,000 minus 30,000, all these remaining asset will belong to acquirer company, no doubt about that. But here you need to be quite alert. In case of business combination achieved in stages, no doubt about that, the remaining asset belong to acquirer, but I need to find out of these 90,000 worth of assets which are flowing towards the acquirer company, what worth of assets were flowing towards the acquirer company on account of previously held investment. See here what I have written. I have segregated it into two parts, and here I have written share due to previously held investment. Share due to previously held investment means whatever net assets, correct, which belong to acquirer company, which is 90,000 in this case. Actually, out of this 90,000, I would say 45,000 worth of net assets are accruing towards acquirer company because of their previously held investment. And how did I find actually that it is 45,000? Because the fair value of your previously held investment on the date of acquisition is 45,000. Fair value of your previously held investment on the date of acquisition is 45,000. Indirectly, it means out of 90,000, 45,000 worth of asset are flowing to the acquirer company on account of previously held investment. Now I will separate 45 from 90. So this remaining amount 45,000, what does it suggest? It suggests that this 45,000 worth of claim is accruing towards us on account of additional investment. So basic purpose under what we call business combination achieved in stages is we want to somehow find out the share of net assets on account of additional asset. So now I can say that this 45,000 worth of net assets are accruing to us on account of what we call additional investment. So share due to additional investment is 45,000. And now, in order to find out the goodwill, I will write here consideration for additional investment. You must have noticed for additional investment we have paid 60,000. Against this additional investment, how much we are getting? We are getting 45,000. Share of net assets on account of additional investment is 45,000. And the balancing figure will be considered as goodwill. Is it clear to you or not? Is it clear? Absolutely clear. I hope so. It is absolutely clear. Now, if it is clear to you, then we can definitely move over to section 14 to find out some questions which have struck in the examination with respect to this particular topic. So with respect to this particular topic, we have already done REQ1, correct? This is section 14, correct? Question number 1 we just did, and now we are moving over to REQ2. REQ2 will tell you, correct, what sort of question you face in the examination with respect to business combination achieved in stages. This question came only for 4 marks. K Limited holds 30% stakes in L Limited. So this time there is an entity here. I have also written there is an entity by the name of K Limited, and it is having in L Limited 30% stakes, correct, so far. Further, it is given in the question that this investment in L Limited is accounted for as an investment in an associate as per Ind AS 28, and the carrying amount of such investment is 140 lakhs. I have already told you, because my investment is 20% or above, but up to 50%, so quite obviously L Limited is my associate entity, and whatever investment which I have made in L Limited will be considered as an investment in associate, and this is exactly what this particular company is doing. So this is written in the question. Also, it is written that these investments are being carried at 140 lakhs. So now you can write that your previously held investment are 30%, and because you are carrying them over at a value of 140, that means right now their carrying amount is 140 lakhs. This is your previously held investment. And earlier you held 30% stakes. Now it is written that K Limited purchase the remaining 70% stakes in L Limited for a consideration of 980 lakh. Because earlier you were having 30% stakes and now you acquired additional investment of 70%. Indirectly means now 100% shares in L Limited are in your hands. Is it clear to you? So obviously this will become your date of control. This will become your date of control. And now you are having 100% stakes, correct? Number 1, I have written here 100% stakes. Number 2, here it is written that you have paid additional consideration of 980 lakhs. 980 lakhs we have paid, so additional consideration is given. Also, it is given that fair value of previously held 30% interest in L Limited is measured at 420 lakhs on the date of acquisition of 70% additional stakes. I told you on this particular date, generally it will be given in the question regarding previously held investments fair value. So your previously held investment, which you carried in the books at 140 lakhs, on the date of control, its fair value is 420. So the value has gone up. Now, in this particular question, it is not stated what is the policy of the company, correct, regarding the measurement of previously held investment. So you will presume that entity was measuring them on FVTPL basis, and whatever gain is there, you are going to take that gain to profit and loss account. In the question which we did a minute ago, there were 2 increments, but in this question there is only 1 increment. Only the previously held investment is given, and then directly you are given what is the value on the date of control. So the value is now 420 because the value of your previously held investment has gone up by, so you will have to pass this entry. Investment in L Limited 280 to profit and loss account. This time you are not going to write OCI because you will presume that previously held investment are being measured on FVTPL basis, and the gain will be equal to 420 lakh minus 140, that is 280 lakhs. Is it clear to you? Also, it is given the value of L Limited's identifiable net assets as per Ind AS 103 on this particular date is equal to 1120. So it is also stated in the question that net assets of L Limited on the date of what we call control is equal to 1120. So now we can find out the amount of goodwill. As I told you, in order to determine the amount of goodwill, we need to write the amount of net assets on the date of acquisition. Of course, then generally we write NCI, but in this question, because now 100% shares are in our hands, so no question of any NCI. So entire net asset will belong to definitely acquirer. But I will have to segregate because it is a case of business combination achieved in stages. So whatever remaining assets are there which belong to acquirer, I will have to find out actually what proportion of 1120 are accruing to acquirer on account of previously held investment. And it is simple. Only thing is that we need to note down the fair value of previously held investment on the date of acquisition, which is 420. So we can safely say that out of 1120 worth of net assets, 420 lakhs worth of net assets are accruing to us on account of our previously held investment, PHI, previously held investment. Now I will subtract 420 from 1120. It will tell me, correct, that this is the amount of net assets which we are getting on account of what we call additional investment. So after having determined this, now we are in a position to find out the amount of goodwill. So I will have to simply write the consideration transferred, and then I will compare it with the net share of net assets which I am getting on account of additional investment, which is 700. So your goodwill will be equal to 280. Is it clear to you or not? Interesting? Very interesting. So if it is interesting, then we move over to the next part of this particular question, and we will do it, and we will do question number 3 also in a moment. Just give me 2 minutes of break. We will continue with this, correct? And we will finish this particular topic also. So after 2 minutes, I will meet you. Class is still on. Remember one thing. Welcome again. After the break, of course, now we'll pick up question number REQ3. Again, this question is similar to the question which we did on REQ1, if you remember. You will find that same sort of balance sheet is given, and some of you might actually attempt to think actually why I'm doing it again. You will come to know about it very soon. Just pay attention here. So everything is almost same. Given below are the extract from the balance sheet of S Limited and P Limited. Once again, the figure are in crore. Same balance sheet is given to you, which we did under what we call REQ1, P Limited, S Limited. Correct. With respect to P Limited, balance sheet figures are given. Share capital 12,000 crores, and then we have other equity to the extent of 4,000. And then we have liability in the form of borrowings and trade payables. And then we have assets in the form of what we call property, plant and equipment, investment property, and also investment and current asset as far as parent is concerned or acquirer is concerned. Coming over to the liability side, as far as liability side of S Limited is concerned, this time similar to REQ1, 2 columns are given, same figures are given. Equity share capital 8,000, one share is of rupees 100 each. Equity share capital is 8,000. Then coming over to borrowings, as you can see, the value is going up, fair value is more, so it will be considered as a loss. In case of trade payables, we find that value is coming down, it will be considered as a gain, 100. And property, plant and equipment, as far as is concerned, property, plant and equipment, that is an asset, investment property asset, investment asset, current asset. So in case of property, plant and equipment, we find that value is going up by 1,000. So I will write here change 1,000. Investment property, we find change is equal to 2,000. And in investment, no fair value is given, so no gain. no loss. And with respect to current asset, there is a loss to the extent of 300. And once again, contingent liabilities are given in the question. I told you in REQ1 also, so it will be considered as a sort of loss to you. Correct? So these are the fair value changes. Till up to this particular point, this particular question is absolutely similar, correct, on similar lines as we did under REQ1. Now what is the difference? Let's have a look over here. Once again, here it is given that market value of equity shares of P Limited and S Limited are 16 and 15. So even in this particular question, market values are given. Market value of company P is 16 and market value of S Limited is 15. Now, see here the difference. The P Limited acquires 45% stakes in S Limited on 31st of 3, 2023 and purchase consideration is settled by 400 in equity share for which no accounting effect has been given. Now here some of you may actually get confused because let us say this is the end of the current year. The balance sheet is given to us on 31st of 3, 2023, correct? And here it is stated that P Limited is acquiring 45% stakes on 31st of 3, 2023. So some of us might actually think that we are not having the control, obviously, because voting rights are less than 50%. Anyway, and further it is also given that when we paid 45%, actually, we paid a consideration by way of 450 shares. And because the market value of our share is 16, in order to know the amount of purchase consideration, I will have to multiply it with 16. Is it clear to you? Now the main point in this particular question is this one. The investment in the balance sheet of P Limited shows the previously held 30% interest in S Limited. See here, this is the amount of investment in the balance sheet of P Limited. Now question says that this investment is nothing but your previously held investment. This is your previously held investment to the extent of 30%. Indirectly, what does it mean? Indirectly, it means in the current year, no doubt about that, we acquired 45% share. But now the question clarifies that earlier, P Limited had already made investment in this particular entity and the amount of investment was 30%. And its carrying amount is 3,500. This is the meaning of this particular line. Is it clear to you? This investment which is appearing in the balance sheet of P Limited shows the previously held 30% interest. So that means previously you were having 30% interest and its carrying amount is 3,500 and now it will be considered as your additional investment. It will be considered as your additional investment. So on this date, now you will get the control, no doubt about that. You will get the control over this particular enterprise. And the additional consideration is equal to this much. But very important in this particular question is, because ultimately I will have to find out the goodwill. And I told you in case of business combination achieved in stages, in order to find out the correct amount of goodwill, I need to know the share of net assets on account of previously held investment on the date of acquisition. On the date of acquisition, what is our share of net assets on account of previously held investment? In order to know that, I need to know the fair value of previously held investment on the date of acquisition. As I told you, I need to know the fair value. But problem is that in this particular question, fair value of previously held investment is not given to you. But anyway, we will be able to track it out. Also given in this particular question that non-controlling interest is measured at fair value. So in this particular question, you have to measure investment at fair value and the main question is that you have to pass the entry. So that is why I kept this question again, because now this question is of business combination achieved in stages. And in order to understand it completely, although I have given you in a solved manner, kindly pay attention towards here in order to understand it better. As usual, first of all, I will have to find out the date of acquisition. This will be 31st of 3, 2023, because on this particular date, we made additional investment. And because of additional investment, now we are having 75% stakes. So our shares now on this particular date is equal to 75%. Obviously NCI proportion will be equal to 25%. And if you want to actually write purchase consideration, you can show that amount of purchase consideration because you are offering 450 shares. Obviously, you will issue them at as per the market value of your share. So purchase consideration will be equal to 7,200. And to know who will be the accounting acquirer, you will have to find out group's share. In order to find out group's share, you will have to take into account legal acquirer. First of all, the legal acquirer obviously is the P Limited. And the total number of shares of P Limited as per balance sheet is equal to 1,200. And it is given in the question that in order to discharge the purchase consideration, we have given 450 shares. So total number of shares issued by P Limited is 1650. It will be considered as group's number of share. Now out of this 1650, P Limited holds 1200, and obviously 450 shares are being held by S Limited, but still the majority of the shares are in our hand. So P Limited will be considered accounting acquirer. Similar to the last question, now I will have to do the revaluation as we did because all figures are same. So ultimately you will have a gain of 2,000 rupees. Is it clear to you? Because this is absolutely similar. Now I will have to find out the net assets on the date of acquisition. In order to find out the net assets, as you know, actually we take into account the share capital of the subsidiary company, which is 8,000. Then we will take into account the other equity of the subsidiary company, which is 6,000. And of course, the fair value reserve, which is equal to 2,000. So the net assets will be equal to 16,000. Now, once I have determined the amount of net assets, I need to know what is the proportion of acquirer and acquiree. So first I need to find out NCI share. Because in this particular question, it is stated that NCI need to be valued as per fair value. Now, in this question, how you are going to determine the fair value? Because this time parent is having 30% previously held investment, and again they made investment worth 45%. So you will take into account 45% because for 45% you are paying 7,200. It is given. How much you are paying? You are paying 7,200 for the additional investment, correct? So we may conclude that the fair value of 45% stakes is equal to 7,200. So what will be the value of 25% stakes? You can determine it. It will be equal to 4,000. So we can say that fair value of NCI is 4,000. Indirectly, it also means out of 16,000 worth of net asset, 4,000 worth of net asset belong to NCI. Then we can find out parent share because out of 16, 4,000 belong to NCI. Remaining 12,000 will, of course, belong to parent company. We can also find out the what we call goodwill or gain on bargain purchase. Total net asset is equal to 16,000, which we just computed. We also know that out of 16,000, 4,000 belong to NCI, and the remaining actually is 12,000. Remaining is 12,000, not 16,000. Just wait. Remaining will be equal to 12,000. So remaining 12,000 worth of asset belong to actually parent. I told you. Now the important point is that because it's a case of business combination achieved in stages. In order to find out the goodwill, I need to know the amount of consideration paid, and I need to know share of net assets on account of additional investment. And in order to know the share on account of additional investment, first of all, I need to find out share of net assets on account of previously held investment. So that is the reason it becomes imperative for me now to actually determine the fair value of the previously held investment on the date of acquisition. And it is not given in the question, but we can determine. See here, I have written here share on account of previously held investment. And how I have determined it? See here. As we know, for 45%, the fair value is 7,200. It is given in the question. And our previously held investment was 30%. Do not let it escape out of your memory. Your previously held investment is 30%. So what will be the fair value of 30% investment? So 30% investment's fair value on the date of acquisition will be equal to 4,800. So now we can conclude that out of 12,000 worth of net asset, 4,800 worth of net assets are accruing to us on account of previously held investment. So if I will subtract 4,800 from 12,000, I will get 7,200 share of net assets of what we call on account of additional investment. So now we have determined the share of net assets on account of additional investment. Now we are also in a position to find out the amount of goodwill. For that, I will have to write actually The amount of consideration, which happens to be 7,200, as we just saw earlier, 4,450 share into 16. And now I will compare it with the share of net assets on account of additional investment, which is also 7,200. So coincidentally, in this particular question, neither there is any goodwill nor there is any gain on bargain purchase. Is it clear to you? Further, in this particular question, you can write the entries also. I have written it for you to make you understand complete in a comprehensive manner. In order to write the entries, see here, first of all, you will have to write property, plant and equipment, because the value of property, plant and equipment, sorry, this is not the, here entries are not written. Let me tell you, this is some other question. Okay, I will tell you entry from solution itself. No problem. Here I have written entries for you. Is it clear to you? The first entry which you need to write under such circumstances, because in case of business combination achieved in stages, as I told you, because your previously held investment, which is reflected in the balance sheet at 3,500 and now its value we just computed is 4,800. So your previously held investment has gone up by 1,300, because in the balance sheet it is written 3,500. That means the carrying amount of your previously held investment was 3,500 and we just computed its fair value is equal to 4,800. That means its value has gone up by 1,300. So first entry you will write here in this manner. Investment in, of course, B Limited, investment in S Limited account debit 1,300 to statement of profit and loss account, or simply profit and loss account 1,300. It is not given what is the policy of the company to measure the investment. And I told you, if it is not given, you will presume that your previously held investments are being measured on FVTPL category. So change in fair value will be taken to profit and loss account. This is the first entry which you need to pass. Then another important point is that obviously you will take into account all the assets, correct, which you are taking over, correct, and their respective values. Then you will also write the amount of goodwill, amount of what we call liabilities, borrowings, trade payables and contingent liability. Besides that, you will have to write the consideration payable. You will have to write the NCI, and very important, in case of business combination achieved in stages, correct, I will have to write here previously held investment. It is known as cancellation of previously held investment. So previously held investment will have to be cancelled out by crediting it. Is it clear to you? Of course, its fair value is 4,800, as I told you just a moment ago. And now if I am going to compare, I will not get any goodwill or gain on bargain purchase. And then I will write the entry for the payment of consideration. So consideration account debit. Then I will write here 2 share capital, 450 shares we are offering. Of course, one face value of our share is 10, and then I will write 2 security premium, 450 into 6, that is equal to 2,700. This is how I will have to pass the entries in case these are asked in the examination. So in case of business combination achieved in stages, you need to take care of this particular fact, that you must pass this particular entry, and especially if you are passing this particular entry for taking over assets and liability, you must not forget to cancel out your previously held investments. Is it clear to you or not? So now we can say that we have achieved our basic target of what we call completing this particular topic. We come back now. This is topic number 1, which we completed, topic number 2, 3. And next topic is related to contingent consideration. Correct? It's a very simple topic. I told you what exactly we mean by contingent consideration. Sometime it is agreed between the what we call acquiring company and acquirer company. Correct? Sometime it is agreed between the acquirer company. Let us say acquirer company is A1 and acquiring company is A2. Obviously, acquiring company will get control over the other enterprise by acquiring some percentage of shares, and that percentage of share obviously must be actually more than 50%, and it will have to pay on this particular date some consideration. Generally, this consideration, which is paid on the date of acquisition in order to acquire the stakes, is known as immediate consideration. Is it clear to you? And sometime or should I say more often than not, sometime what happens actually, there is an agreement actually takes place between the acquirer company and the acquiring company, whereby acquirer company tells to the acquiring company that we will pay you some additional consideration. We will pay you some additional consideration. We will pay you some additional consideration. But at the same time, some conditions are also attached. Some conditions are also attached. For instance, let us say acquirer company tells to company A2, which is the acquiring company, that will pay you what we call 20 lakh after 2 years, provided you are able to achieve a target of 20% profit, let us say. So, contingent consideration means this additional consideration, whether it will be paid or not, it will depend upon the attached conditions are being met or not. That means this consideration is dependent upon something that is known as contingent upon something. So, if those conditions will be met, then this additional consideration will have to be paid. Is it clear to you? Now, the important point is that only the future course of action will tell whether this consideration will ultimately have to be paid by the acquirer company or not. Because, as I told you, the actual payment of this consideration will depend upon the fact whether the acquiring company is able to meet the attached conditions or not. If acquiring company will be able to meet the attached condition after 2 years, I will have to pay. And if acquiring company will not be able to achieve, definitely we need not require to pay. But the point is that, in spite of the fact that payment ultimately will be known later on whether the payment will have to be made or not, but in spite of that, standard says that if there is a contingent consideration, then it will be considered as a part of consideration. Is it clear to you? That means on the date of acquisition, whatever contingent consideration is there, you will have to record it. And how it is recorded? It is recorded in this manner: provision for contingent consideration. So this is the point, correct? So generally MCQ questions have been asked in the examination from this particular topic. For instance, let's have a look over this one. Here it is stated that there is an entity by the name of D Limited and it has acquired 100% of F Limited on 31st of March 2021. Further, it is stated that purchase consideration comprises of an immediate payment of 10 lakh. So we acquired 100% stakes and we paid immediate payment of 10 lakh. And 2 further payments of 1.21 lakhs if the return on equity would exceed 20% in each of the subsequent 2 financial years. So this time, indirectly, what is happening here? Just wait. In this question, what is happening? The acquirer company is acquiring 100% stakes, number 1, correct? And it is stated in the question we are making an immediate purchase consideration of 10 lakh. Number 2, it is also stated in the question that we will pay you in each of the next 2 years. In each of the next 2 years. So next 2 years, correct? We will pay you 1.21 lakhs and 1.21 lakhs. Correct? In each of the next 2 years, we will pay you 1.21 lakhs, 1.21 lakhs, provided in each of the next 2 years, the return on equity is more than 20%. Correct? So if these conditions are met, we will pay you, of course, 1.21 lakh, 1.21 lakh. That means in absolute term, it is equal to 2.42 lakhs. Now the important point is that standard says that actually question will simply ask you what will be the amount of total purchase consideration. The total amount of consideration will be immediate payment. The immediate payment is actually 100 lakhs. Immediate payment is 100 lakhs, no doubt about that. Immediate payment is your 100 lakhs. No doubt about that. This is your immediate payment. But as I told you, whether we will ultimately pay this additional consideration or not, it will be known only after 2 years. Correct? But in spite of that, standard says that on the date of acquisition, I will have to record it as a part of purchase consideration. So I will have to record contingent consideration. So contingent consideration will be recorded and it will be recorded at fair value. And in order to record the same, we write provision for contingent consideration. And standard says that it will be recorded at fair value. In order to determine the fair value, I will have to find out the present value. In order to determine the fair value of the contingent consideration, I will have to find out the present value because it will be paid after 2 years. And here you are being given 10% discount rate. So at 10% discount rate, first you will write year 1, correct? 1.21, and the discount rate for year 1 will be equal to 0.9091. And similarly for year 2, you will write again 1.21 lakh and you will take the discount rate. The discount rate will be equal to, I think, 8265. And then you will multiply to get the present values. So whatever present values you will get, you will simply write, I think it will be equal to 2.10. So your total purchase consideration will be equal to 12.10. This is how you will have to show that, and you will have to in fact tick mark, because generally such question will be asked in the examination in MCQ form. Correct? And here I have done the complete solution for you also. Immediate payment is 10 lakh. As I told you, the present value will be equal to 2.10 and the total purchase consideration is this. And just for your knowledge sake, on the date of acquisition, in case if you were to record how you would have, correct? First of all, you would have written assets account debit to liability account, and then you will write to cash because purchase consideration it is not mentioned that paid in shares, so you will presume purchase consideration is being paid in cash, and then you will write provision for contingent consideration to 2,10,000. Is it clear to you? Similarly, next question 4.2, actually this is 4.2 is given, so you can do it. Correct? I have given you this particular question. The answer given in bold is the correct answer. Similarly, another simple topic, concept-based topic, is contingent liability. What we mean by contingent liability, I have already talked about contingent liability. Correct? In simple words, you can manage this question easily of your own. Actually, in this particular question, what is happening, there is an entity by the name of Z500 Limited. There is an entity by the name of Z500 Limited, and it is acquiring a company by the name of C400 Limited. C400 Limited. Further, it is stated that C Limited, which is the acquiring company C400 Limited, it is having a contingent liability. It is having a contingent liability and its fair value is 50,000. Its fair value is 50,000. So all you have to write is that as per Ind AS 103, any contingent liability which is appearing in the books of acquiring company will have to be taken over by Z Limited. Z Limited will have to recognize them and will have to measure them at fair value. Correct? So you will record them at 50,000. This is exactly what I have written in the answer. Then there is a case of deferred consideration. Now what we mean by deferred consideration? Actually, deferred consideration and contingent consideration are one and same thing, but only difference is that in case of deferred consideration, you will tell to the acquiring company that we will make you some payment, let us say within next 2 years, next 3 years, whatever it is. Correct? But this time you will not put up any condition. That means these payments will have to be made. So similar to the contingent consideration, even deferred consideration will be recorded. It will be considered as a part of purchase consideration. And in order to record the deferred consideration, you will write provision for deferred consideration and you will have to compute the what we call present value. In order to record the deferred consideration at fair value, you will have to find out its fair value. The present value will be considered as the fair value. For instance, in this particular question, 6.1, here it is written that there is an enterprise by the name of E1. It acquires E2 in the beginning of the year and the amount of purchase consideration is 200 lakhs in cash. This is the immediate payment. And also to pay 40 lakhs after 2 years. So this time E1 is telling to the acquiring company E2 that we'll make you a payment of 2 lakh right now, that means on the date of acquisition, and we will also pay you 40 lakhs after 2 years, and there is no attachment, there is no conditions attached. There are no condition attached in this case. So it will become a case of deferred consideration. Also, it is given that discount rate is 10% and present value factor at 10% for second year is straightway given to you. So calculation of present value of deferred consideration. The deferred consideration is 40 lakh and discount factor of second year, because this time the amount will be paid after second year. So you will take the discount factor of the at 10% for second year, which is given to you 8.264. So the present value will be equal to this much. That means your total consideration will be 200 lakh plus 33 lakh 5,600. This is exactly what the question will ask you. And in case if you want to learn how we initially how we will pass the entry initially, that means on the date of acquisition, your entry will be asset account debit to liability account, and then you are going to write to purchase consideration, and then you will write to provision for deferred consideration. This is how you will have to actually write it in the examination. Is it clear to you or not? Now, the next one is reverse acquisition. Reverse acquisition, concept of reverse acquisition, because it will take a bit of time. So I will explain it obviously after the break of 2 minutes. So now in this particular session, as you can see, we are going to actually discuss the repercussions of reverse acquisition. In the initial stages, I told you actually often it might happen actually that legal acquiree may become the legal acquirer. So how the accounting pattern would unfold under such a situation, let's have a look over this particular question. 7.1 is on the cards. Kindly pull out your notes and open down this particular question 7.1. And if you are ready, we on our side are absolutely ready, and we are moving over to the business end. Let's start this question. Balance sheet of H&S Limited as on 31st of 3 2022 is given to you. Now if you will have to pay attention here, then you are going to see that only few items are given. Non-current asset, that is H Limited, is 2000. You can make it 2000 lakhs, 2000 crores, whatever you may feel so. And S Limited is having non-current asset to the extent of 3000. H Limited is having 1000. S Limited 1000. And this is the total. Only two items are there as far as asset sides are concerned. Then as far as equity share capital is concerned, that is 1000, and you have to note down the face value, that is equal to 10. That means total number of shares of S Limited happens to be 100. On the other side, if we are going to have a look over the column of S Limited, we will find over there that total share capital happens to be 800 and one share is of 10. So that means number of share is equal to 80. Besides that, we are being given here other equity 500 and 1,600. The non-current liability is 700, 1,200, and current liability is 800 and 400. Well, after having a look over the what we call balance sheet items, now we shall move over to the additional information wherein it is furnished that H Limited and S Limited shares are quoted in the market at rupees 20 and 50 respectively on this particular date. So this is the line which would demand your attention actually. So here you have noted down that as far as quoted price is nothing but market price. Is it clear to you? So in the market, the price of one share of H Limited at this particular moment is only rupees 20, and you have also noted down the price of S Limited, which happens to be 50 in this particular case. Now further also it is given in this particular question that H Limited issues shares in exchange ratio based on the quoted price. So now you have to actually read between the lines, read it very hard. You will find over there that in this case it is H Limited which is issuing the share. So it is implied now, or we can actually construe that H Limited here is the legal acquirer. From the legal perspective, we can actually conclude that H Limited, because it is issuing shares to the what we call S Limited. So far, till up to this particular point of time, we may conclude that H Limited is the legal acquirer. Correct? Now, just pay attention how we are going to move about, and the demand of the question is pass entries in the books of the acquirer, and of course, we are supposed to prepare the consolidated balance sheet. Now, H Limited and S Limited. Here I have written H Limited acquires S Limited. How I concluded it, I told you just a moment ago, because it is given in the question that it is H Limited which is issuing the shares. So quite obviously at this particular point of time, we may conclude that H Limited is the legal acquirer and S Limited is the legal acquiree. Why? Because H Limited is issuing shares to S Limited. Is it clear to you or not? And also for your reference, I have written here that given in the question that S Limited shall issue shares to S Limited, and that is the reason actually why we are concluding that till up to this particular point of time, H Limited happens to be the legal acquirer while S Limited happens to be the legal acquiree. Now once you have configured it, now the next point, how you are going to move about. See here, slowly and steadily we will try to learn the repercussions of the accounting as far as reverse acquisition is concerned. Now, at this particular point, I will simply note down the total share capital of H Limited and total share capital of, this is total share capital of S Limited, let us say 800 lakhs and 1000 lakhs. And face value of one share is 10. So number of shares of H Limited is 100 and number of shares of S Limited is equal to 80. Now, once you are confident of the fact that what exactly are the number of shares of the H Limited, the legal acquirer and the legal acquiree, then you will move over to the next point. In the next point, I am going to compute here the exchange ratio. Why I am going to compute the exchange ratio? Because it is given in the question that H Limited is issuing shares to S Limited on the basis of the exchange ratio, and the exchange ratio is based upon the quoted price. And so, once again, what I am going to write here, H Limited and S Limited, it is given in the question that quoted price of one share of H Limited is 20 and quoted price of S Limited is 50. Now you shorten it down, so we can say ratio at this particular moment is 2:5. Try to understand what exactly I am doing here. One is H Limited, another one is S Limited, correct? And I've told you quoted price of H Limited is 20 and quoted price of S Limited is 50. So I'm simply just shortening it now 2:5. Now what I am doing, in order to understand the meaning of this 2:5, what I am doing, I am shifting the figure. This is why I have marked it this way. I am shifting the figure. This figure is lying towards my right side, so I will take it towards the left side, and I will take this figure towards the what we call right side, because it is lying towards my left side, and I will take it towards the right side. Is it clear to you or not? Fine. Now, why I am interchanging the position of these figures? In order to know what exactly this ratio 2:5 stands for. Because just earlier, a moment ago, I told you that the respective what we call quoted price of these two companies happens to be 20 and 50, and indirectly we may say that the ratio is 2:5. But what exactly this meaning, what exactly this ratio means, and in order to configure the meaning of this ratio, I'm interchanging the position so that now I am in a better position to understand what exactly this ratio means, 2:5. Don't let it escape out of your memory that ratio is 2:5. Just to understand the meaning of this ratio, I'm interchanging the position. Now, what does this particular ratio would mean? Now, pay attention. It means H Limited shall issue. It means H Limited shall issue 5 shares for every 2 shares of S Limited. By interchanging the position, it will help you to understand the meaning of this ratio. Otherwise, sometimes mistakes unnecessarily get committed in the examination. So my advice to you is, one, in case of such sort of question strike in the examination, first you simply compute the ratio in a normal manner, change the position, and then you will be able to find out easily. It means now in this particular case, it is H Limited which will have to issue 5 shares for every 2 shares of S Limited. Is it clear to you? I will try to explain this particular point further. I told you H Limited will issue 5 shares. Because the quoted price of one share of H Limited happens to be 20, so indirectly it means when H Limited will issue 5 shares, the value is 100, and they will issue 5 shares for every 2 shares of S Limited. Because the quoted price of S Limited, as you have seen, is 50. That means, in order to settle the value of 100, they will have to issue actually 5 shares. So that is why, in this case, H Limited will have to issue 5 shares for 2 shares. Is it clear to you or not? So in order to understand the meaning, I interchange the position, although it is not necessary in the examination to do so. So, in this case, now we conclude that it is H Limited which will issue 5 shares to what we call S Limited. Now, number of shares. Now the next point is, once you have concluded how many shares are going to be issued by H Limited to S Limited, the next point is actually how many shares as per this particular ratio now H Limited will have to issue in total. As we have already seen that total number of shares of S Limited is equal to 80, and according to the ratio, for 2 shares of S Limited, we are supposed to issue 5 shares. So it means H Limited will offer 200 shares to S Limited. Is it clear to you or not? So now we have concluded here that H Limited will issue 200 shares to S Limited. Now the next point is very important. In the initial stages, I talked about this particular point. Now, if suppose I am going to ask you the total number of shares of the group. First of all, you need to know and recapitulate the meaning of the group. Right from the beginning, actually I am stressing upon this particular fact that when we say group or group's share capital or number of share of the group, indirectly it means we are talking about the legal acquirer. Indirectly it means we are talking about only the legal acquirer, and we know that legal acquirer in this particular case is H Limited. H Limited is the legal acquirer. I'm not talking about the accounting acquirer, because so far we do not know who is the accounting acquirer. So when we say that total number of shares in the group, that means we are talking about the number of shares of H Limited. We know that total number of shares of H Limited is 100. Their total share capital is actually 1000. So 1000 divided by 10, total number of share is already there, 100. And now just a moment ago, we found that H Limited is issuing 200 share to discharge the consideration, isn't it? Just a moment ago, we concluded that H Limited is going to issue 200 share. So we can easily and safely now conclude that total number of shares in the group is equal to 300. This is exactly what I have written over here, 300. Now out of these 300 share, actually H Limited is holding upon only 100 share because 200 shares have been issued to S Limited. So out of 300, 200 shares are in the hands of S Limited. So now you can easily figure it out actually that this is the position of the group and the majority of the shares are in the hands of the S Limited. So that means the control of the group in this particular case is in the hands of the legal acquirer. So in this case, legal acquirer will be considered as an accounting acquirer, and that is why it will be considered as a case of reverse acquisition. Is it clear to you or not? So now we have figured out that who is the acquirer. So we have figured out after a great battle with the wordings, now we found out that actually the legal acquirer, accounting acquirer in this particular case happens to be the legal acquirer. So it is a case of reverse acquisition, and now we know that S is the accounting acquirer. So quite obviously now S will be considered as the accounting acquirer, number one. And if S is the accounting acquirer, indirectly we will have to do the accounting in the books of S Limited. Is it clear to you or not? Now we know how the accounting is done in the books of the acquirer. If you are the acquirer, quite obviously, first of all, you will record all the assets and liabilities of the acquiring company, because now you are the acquirer, so the other company, H Limited, will become the acquirer for the accounting purpose. So you are the acquirer company. Now you will have to look into the balance sheet of, H Limited. H Limited. Because now S Limited is the acquirer, correct? So you will take over all their assets in order to prepare the consolidated balance sheet. You will have to take over all their assets. Obviously, no fair values are given separately in the question. So we may presume that whatever values are existing in the balance sheet, that is equal to what we call fair value. Is it clear? So there is non-current asset, there is current assets, and besides that, we will take over two liabilities. There are two liabilities of H Limited. One is non-current liability and current liability is 800. Now the next point is that asset taken over to liability taken over. Now I will write here to consideration payable account. Now the point is that from the perspective of S Limited, what is the amount of purchase consideration? If you are the accounting acquirer, what sort of purchase consideration you are supposed to actually pay to the other company? Other company is H Limited. In practical life, actually, suppose now I am S Limited, I am the accounting acquirer and you are H Limited. Now I am supposed to pay you the purchase consideration. Now the question is actually how much purchase consideration should I pay to you? In order to pay the purchase consideration, because consideration is paid to the owners, and who are the owners? The shareholders. Now I know that total number of shares is equal to 100 as far as this company H Limited is concerned. Obviously their face value is 10, but their quoted price is 20 or market price is 20. So obviously the shareholders of H Limited would ask for a total consideration of rupees 2000, because they will simply tell to S Limited, if we are going to sell off our share in the market, we can easily get at the rate of 20. So total amount we can get for 100 share is equal to 2000 lakhs. Is it clear to you or not? So total number of shares of H Limited is 100 and their market value is 20. So this is the amount of purchase consideration which now the accounting acquirer will have to pay to the other company. Is it clear to you or not? So that is the reason why I have written here 2000, and for your what we call facilitation, I have also written here how I have computed it. Total number of shares of H Limited into quoted price of H Limited. So this is how we have derived the now amount of purchase consideration. So in the books of accounting acquirer, we have taken over the asset and the liability. We have written the amount of consideration. Obviously now we will take the difference. The difference is coming over to the debit side. Obviously it will be considered as goodwill. Is it clear to you? So this is the first entry which we are going to put up in the what we call books of accounting acquirer. Now the next point is consideration. Obviously now I will have to discharge the amount of consideration. Now again here is a tricky point in the sense because you are the acquired company and now you are supposed to discharge total 2000 rupees. Obviously in order to discharge 2000 worth of purchase consideration, now you will try to find out how many shares you are supposed to issue. So total amount of purchase consideration is 2000. Now because you means the accounting acquirer, that is S Limited, is supposed to issue the consideration, so they will take into account their own market price. So the market price of the issuing authority, in this case S Limited, is 50. Is it clear to you? So in order to discharge the consideration, I will divide it by the market value of our share. So now I can find that total number of shares which I will have to issue is equal to 40. I am issuing 40 share at the rate of 50 because market price is 50. So in order to discharge 2000 rupees, the accounting acquirer will have to offer 40 share at the rate of 50. But important point you should not neglect here, the face value of your share is 10. So indirectly it means you are issuing the share at a premium of rupees 40. Is it clear to you or not? So that is the reason actually why the entry will be like this: to equity share capital. In order to discharge the consideration of 2000, I will write here total number of share 40 which we drove out from here, and face value of the share is 10. I will have to put up face value, that is nominal value of the equity share capital, and besides that I must write here security premium 40 shares and premium amount is 40, so total amount will be equal to 1600. And I have also given here the working that how we computed the amount of number of shares. The total number of shares to be issued by S Limited to discharge the consideration will be equal to 2000 divided by 50, that comes to what we call 40 shares. So important point is that there are two major questions. First of all, how much of the consideration S Limited will have to issue? Correct? In order to know the amount of consideration, you will have to simply take into account the total number of shares of the company to whom you are discharging the consideration. And after having found out what we call total number of shares, the next point is that now you are going to simply multiply it with the market value. The market value is 20, so total amount is 2000. That is why we wrote here 2000. Now the next point is that how many number of shares which we are supposed to issue to discharge the consideration. So for that, I will have to divide the amount of purchase consideration by our market value. So this is how we have driven it out. So these are the two entries which we are supposed to actually put up. And the next point is consolidated balance sheet. Remember one thing, that you are the accounting acquirer. You are S Limited. When I am going to prepare the consolidated balance sheet, obviously when I am going to write non-current asset, first of all I will write the non-current asset of the acquirer company, that is 3000. And again an important point, in the consolidated balance sheet, the values of the acquirer company, will be the value which is being carried in the balance sheet. For example, in the balance sheet, my value is 3000, S Limited I am talking about. So same value must find place in the what we call consolidated balance sheet. Another point is that at what value you are going to record the non-current assets of the company which you are taking over now, in the sense because now you are the acquirer. In this question, actually revised values are not given. In case if any revised value or fair value would have been there, you would have taken these values at fair value. Is it clear to you? So acquirer's item will always come at carrying amount, whereas the items of the acquiring company will find place in the consolidated balance sheet at the value at which these items have been taken over. Is it clear to you? So 3,000 plus 2,000, 5,000, and there was goodwill also, because we computed under entry number 1, there was a goodwill of 500. And current asset, first of all, I'm going to write the current asset of S Limited, then I'm going to write the current asset at a value at which I have taken them over. In this question, we have taken them over at 2,000, so total amount will be equal to 3,000. Here you write 3,000, not 2,000. So total amount will be equal to 3,000. And the total amount will be, and the total will be equal to, in this particular case, 5 plus, I think it is equal to 8,500, or what is the amount of current asset? First of all, let me check. Current asset, sometime it becomes problem for me. Current asset is actually 1,000 and 1,000 of S Limited. Okay. So in this case, current asset of S Limited is 1,000 and current asset of the other company is also 1,000. So total will be equal to 2,000, and total now is okay, 7,500. Now coming over to the liability side. So often I have been telling you that when we prepare the consolidated balance sheet, in the consolidated balance sheet, only the share capital of the acquirer find place. Remember one thing, the share capital of acquirer S Limited is 800. This is the total share capital. And just a moment ago, we passed an entry, consideration account debit to equity share capital to what we call security premium. Actually, we have issued some share capital, and the nominal value of the share capital issued by H Limited is actually 400. So this 1,200 is the total share capital of H Limited. Is it clear to you? Share capital, this is 1,200 is total share capital of accounting acquirer, that is S Limited, sorry. So total share capital of S Limited is 800, and we just passed an entry to discharge the consideration wherein we wrote actually that equity share capital at nominal value is 400. So that is the reason 800 plus 400, 1,200. This is the entire share capital of what we call accounting acquirer S Limited. As far as S Limited's share capital is concerned, it will not find place in the consolidated balance sheet. I need not require to talk about that. Coming over to other equity, again, here the other equity, first of all, when we write other equity, we only write the balance of the other equity of H Limited. So H Limited's other equity, sorry, in this case, the accounting acquirer is S Limited. So here I am going to write the accounting acquirer's equity, which happens to be S Limited. Correct? The other equity of acquirer only will find place in the balance sheet. So often, because we have already done earlier question wherein I have already talked about that other equity and share capital of the acquiring company will never find place in the balance sheet. So this is the other equity of the accounting acquirer, which happens to be S Limited. But we must not forget that we just issued share capital at a premium. So, and premium is also a part of other equity. So now the total equity will become 3,200. Is it clear to you? And then our non-current liability is equal to 1,200. This is accounting acquirers, and we have taken over the what we call non-current liability of the acquiring company at a value of 700. So total amount will be equal to 1,200. And likewise, on similar logic, I will write current liability 1,200. So this is how you are going to prepare the consolidated balance sheet. And you must have seen actually it is not a very tough nut to crack. Is it clear to you or not? Is it clear to everyone? Okay, if it is clear to you, then I can move over to the other part of this particular question. You might be wondering, sir, why you are moving so far away? Because I will do another question for you immediately so that you comprehend it better. And you move over to section, I think, 14. You move over to section, which section it is? Just wait. Now we will move over to REQ4. REQ4, correct? This is the last section wherein I have incorporated all the recent examination question, correct? In this particular section, we have incorporated all the recent examination questions. Section 14, now kindly actually have a look over here. And in this particular question, this is similar to the question which we just did a moment ago. So in this question, you have seen actually that there are two companies, M Limited and N Limited. and they were amalgamated to form a new company MN Limited on 31st of 3/2021. So in this question, the storyline is like this. Actually, there are two companies, one M Limited and N Limited. Now they decided to amalgamate into one single unit. So the new company is MN Limited. No doubt here M and N Limited both, after mutual consensus, decided to amalgamate and form a new entity. From the accounting perspective, how it will be inferred and how it will be analyzed. From the accounting perspective, we may say that MN Limited is taking over the business of M Limited and MN Limited is also taking over the business of N Limited. This is how from the accounting perspective you have to analyze it. Although it is given that M and N Limited both are combining into a one single unit, but from the accounting perspective we will have to analyze it this way around, that this is the new entity and the new entity is taking over the existing entity M Limited and N Limited. Is it clear to you or not? Further, it is given in this particular question, this entity MN Limited, because it is taking over these two entities, will issue requisite number of equity shares of rupees 10 each to take over the business of M Limited and N Limited. So in order to take over the business of N Limited and N Limited, it is also given in the question that this particular entity M Limited will issue requisite number. Requisite means necessary or required number of shares. Is it clear? Further, it is given in the question that abstract of the balance sheet of the two companies on 31st of 3/2021 is also given to you, and you find over here that figures are in lakhs. Correct? This question, of course, is from MTP. I do not know. I think it is December 24. M Limited and L Limited. And here the information goes like this. As far as asset side is concerned, 15,000, 16,000. Then financial asset. Financial asset 1,600 and 1,000. Then current asset 9,400 and 13,000. So as far as position of asset is concerned, this is the scenario. And coming over to the liability side item, we are being given equity share capital of 12,000 and 20,000. Correct? And besides that, we are given other equity 6,000 and 2,000. And further, we are also given borrowings 4,000 and 6,000 and current liability to the extent of 4,000 and 2,000. Is it clear to you or not? Now, in this question, there is a slight what we call extension in the sense that something else is also given. For example, in this particular question, which was not given in the last question, here it is given that fair value of the items. So as we see that some fair value of the items of M Limited and N Limited is given to us, and here it is stated that property, plant and equipment is having a fair value of 16,000, whereas in the balance sheet it is 15,000. Similarly, as far as N Limited is concerned, its fair value is 12,000, whereas fair value in the balance sheet is 16,000. Then current asset. As far as current assets are concerned, the fair value is 10,000 and 14,000, and in the balance sheet, the current asset is 9,400 and now it is 10,000. Whereas 13,000 is the value of N Limited of current asset and the fair value is 14,000. And now we are also being given here the fair value of the business. Fair value of the business. What does it mean? Fair value of the business is nothing but fair value of total share capital. Fair value of total share capital. It is nothing but it is total fair value of share capital. Fair value of business basically means total fair value of the share capital. Is it clear to you or not? Now further here it is given that however the control of MN Limited is taken over by the management team of erstwhile N Limited. Logically, in this particular question, if we will just go through this particular question, you will find, because here in this particular case, we saw that it is MN Limited which is taking over the business of these two companies. Correct? In this particular question, what we saw that it is MN Limited, which is the company which is taking over the business of M Limited and N Limited. So technically, in this particular case, what we find, actually MN Limited is the acquirer company. It is the acquirer company. Whereas M Limited and N Limited should be considered as acquiring company. Because MN Limited, the new company, is taking over the business of these two companies. Correct? So logically, these two companies, M Limited and N Limited, should be considered as acquiring, whereas this company should be considered as an acquired company. But here, later on the question, that means at this particular moment, we may say that as far as legal angle is concerned, the legal acquirer is actually MN Limited and legal acquiree is M Limited and N Limited. But below it is given that control of MN Limited is in the hands of N Limited. Now this time the question is specified that control is in the hands of the N Limited. The control is in the hands of the N Limited. And you can see actually that it is the legal acquiree, but the control is having N Limited because it is given in the question. So because legal acquiree is having the control, again this particular question will fall under the domain of reverse acquisition. Is it clear to you or not? Clear? Absolutely clear? I hope so it is clear to you. And in order to understand this, let's have a look over here. In order to make you understand better actually, first of all, let me tell you this way around, then you will be able to understand better, I think. Well, now you will be able to understand better. This is REQ4. Correct? Now, in this particular question, REQ4, first of all, it was given to us that there is an entity by the name of M Limited, another entity was N Limited, and it was also given that they merged into one single unit, that is MN Limited. So that is the reason why I'm telling here that from the legal perspective, we may say that M Limited is a acquiring company, N Limited is also a acquiring company, and this new entity should be considered as an acquirer company. This I have already explained. However, later on the question is specified that control will be in the hands of N Limited. Because control is having in the hands of legal acquiree, that is why it will become a case of reverse acquisition. That means N will be considered as the accounting acquirer. Now, another important point under step number 2, actually just pay attention here. First of all, I have written here M Limited, then N Limited, and then I have written here group. Is it clear to you? Now, in this particular question, we are being given fair value of the business, and just a moment ago, I told you what we mean by fair value of the business. Actually, fair value of the business is nothing but the fair value of the total share capital. So the total value of the share capital of M Limited is 15,000, we may say so. And total fair value of N Limited, total fair value of the business of M Limited is 15 and total fair value of N Limited is 30,000. So we may say that total fair value is actually 45,000. At this particular moment, it is equal to 45,000. Is it clear to you? Now, out of 45,000, what we have seen that 1/3 of the fair value of the business is being commanded by M Limited and 2/3 of the fair value of the total business of the group is commanded by N Limited. So this substantiates the point which is given in the question that control is in the hands. Although this particular point is not required as far as solution is concerned, the reason being is that because it is clearly given in the question that N Limited is the accounting acquirer. For the purpose of accounting, N Limited is the acquirer. And in order to substantiate that, just to prove that how the control is moving into the hands of N Limited, I am talking about this particular fact. So I simply added the fair value of the business, and out of the total fair value of the business, we can see that 1/3 is in the hands of M Limited and 2/3 is in the hands of N Limited. Correct? So now in this case, you can easily find out that who is the accounting acquirer. So N Limited is the accounting acquirer, number one. Another important point is that in the last question, actually, we were given the total market value of both the companies, correct? Or the quoted price or market value was given in the last question. You can also find out here, although it is not given in the question in a very clear manner, but you can find it out very easily. For example, if suppose I am going to ask you the total number of shares of M Limited. So total fair value of the share capital is equal to 15,000. And the total fair value of the share capital of N Limited is 30,000. Just a moment ago, I told you that fair value of the business is nothing but total fair value of the share capital. Now, total fair value of the share capital is 15,000. And if I want to know the fair value of one share, what I need to do? I need to actually simply divide it by the total number of shares. Actually, total number of shares are given as 12,000, and this time face value is not given in the question. if face value of the share is not given, it is always presumed as 10. So that is the reason I have taken total number of share as 1200. Actually, total share capital which is given in the question is 12,000. And if I will consider one share as 10, so I may say that total number of shares of M Limited is equal to 1200. So if I am going to divide the total fair value of the share capital by the total number of share, I can easily say that the fair value of one share is actually 12.50. And this fair value is nothing but the market value or the quoted price, whatever you may like to refer to it as. Similarly, the total fair value of N Limited in this case happens to be 30,000, and you simply divide it by the what we call total number of share. How you are going to find the total number of share? Because the total share capital is 20,000 and one share is of 10, we will have to assume it. So total number of shares of N Limited will be equal to 2,000. So the fair value of one share is equal to 50. So now you have the fair value, and now you are also aware of this particular fact that it is N Limited who is the accounting acquirer. So in the books of accounting acquirer, your first entry will be, now you will take over all the assets of the other company. The other company is M Limited. So look into the column of M Limited. But when you are going to take over the items, you should not let it escape out of your memory that in case fair values are given, you will have to record them at fair value. So the property, plant and equipment of M Limited is of M Limited I am talking about. It is having what we call a fair value of 16,000. This time it is given in the question. So you will take them over at 16,000. Fair value of financial asset is not given in the question. So you will consider the balance sheet value as the fair value. Is it clear to you? And the fair value of current asset is given. Fair value of current asset of M Limited is given, so you will take over current asset at a value of 10,000. Likewise, you will take over the borrowings, you will take over the current liability, and similar to the last question, now you will have to write here consideration payable. Just a moment ago, I told you in the last question, if you are the acquirer, you are N Limited, and you are supposed to make the payment to M Limited. You are supposed to make the payment to M Limited. So how much payment you are supposed to make to M Limited? In the last question, I told you it was S Limited which was supposed to make the payment to H Limited. So in order to know the amount of purchase consideration, what we did, we took into account the total number of shares which were, I think, 100, and then we multiplied it by what we call market value, that is 20. So total purchase consideration was 2,000 in the last question which we did. On similar logic, I will take into account the total number of shares of M Limited. Total number of shares of M Limited is equal to 1,200, number one. And we have found out the market value or fair value, which happens to be 12.50. Now, if you are going to multiply, obviously it will be equal to 15,000. And moreover, you need not require to do in this case this sort of working. The reason being is that because in this particular question, the total fair value is already given. You are already having that total value of the share capital. So this much of consideration you are supposed to pay. Moreover, I have written over here that total number of share 1,200 of the other company, and you have multiplied it with the what we call market value 12.50. So total consideration payable will be equal to 15,000. Now in this case, when you will balance, you will find what we call balancing figure over the credit side. So it will be referred to as gain on bargain purchase. Now you will make the entry for paying the or discharging the consideration. The amount of consideration is 15,000. The next question is, how many shares you are supposed to issue? In the last question, I told you, first you write the amount of purchase consideration. Now you will have to divide it by the fair value of your or market value of your own share. We have already computed that market value of our share is equal to 15. We are N Limited. So in order to make a payment of 15,000, I will divide it by 15 to know the number of shares which I am supposed to issue. So I am supposed to issue 1,000 shares. So I will write here 2 share capital, 1,000 shares of 10 each at nominal value I am going to write. And because I am issuing the share at the rate of 15, so I am going to write here 1,000 into 5. This will be security premium. So on the basis of these entries, these 2 entries, you are supposed to prepare the consolidated balance sheet. Just a moment ago, I also told you when we are going to prepare the consolidated balance sheet. In the consolidated balance sheet, we will write the what we call values of the acquirer company at carrying amount. At carrying amount means which is given in the balance sheet. We will ignore the fair values of the acquirer company which is given in the question. In the consolidated balance sheet, only the values which are appearing in the balance sheet will be written as far as acquirer company is concerned. And at what values you have taken over the assets and liabilities, you have already written them over here, and accordingly you are going to actually merge them with your assets and liability in the consolidated balance sheet. So now you are in a position to prepare the consolidated balance sheet also, and for your better understanding I have prepared it, although I have given in the solution also. So when we are going to prepare the asset side, so towards the asset side, first of all I am going to write the non-current assets. First of all, I will write the non-current asset of the acquirer company, and I will write them at carrying amount of 16,000. And we have taken over the non-current assets of the other company at a value of 16,000. So I will write here 16,000. So total value will be equal to 32,000. Similarly, financial asset. Our financial asset acquirer 1,000, and we have taken over their financial asset at a value of 1,400. So total amount will be equal to 2,400. And likewise, current assets. As far as current assets are concerned, our current asset is equal to 15,000. First, I am going to write here 15. And now I have taken over their current asset at a fair value of 10,000. I will add here 10,000. Total amount will be equal to this much. And this will be your total 57,400. Moving over to the equity and liability side. In the equity and liability side, first of all, I will write share capital. So often I have already told you and I have been telling you, correct? It is almost like harping upon the same string. Harping upon the same string means too often repeating the things, correct? That in the consolidated balance sheet, we write share capital and other equity of only the acquired company. The N Limited is the acquired company. So the share capital of N Limited, obviously it is given 20,000. And just a moment ago, I told you that in order to discharge the consideration we have issued, we means the N Limited has issued 1,000 shares of 10 each. So that is why I am going to write here 10,000. So total share capital of N Limited will be equal to 30,000. Similarly, as far as other equity is concerned, the other equity of acquirer is 2,000 as per the balance sheet. Now, in this particular question, we have issued the share capital at a premium of 5,000, and security premium is also a part of other equity. Don't let it skip out of your memory. And similarly, gain on bargain purchase was also there as per entry number 1, and gain on bargain purchase is also a part of other equity. So you will have to add all these three items and you will write here 11,400. Accordingly, now you are going to write non-current liability. Your own non-current liability in the form of borrowings is equal to 6,000. You have taken over the what we call non-current liability of the other company at a value of 4,000. So total amount will be equal to 10,000. Is it clear to you? Similarly, now you are going to write here current liability. Your current liability is 2,000, and you have taken over the current liability of the other company at rupees this much, and now you simply add it and you will get now 57,400. So you have gone through the what we call reverse acquisition. I hope so that you have understood the fundamentals in a crystal clear manner. The only thing is that when you are going to prepare the consolidated balance sheet, you need to be aware of this particular fact that only the carrying amount of the acquirer will find place in the balance sheet, and obviously the items which you have taken over of the other entity, correct? Obviously, you have written those values in your entry, and accordingly you are going to put them in the consolidated balance sheet. So this is how we have to do this particular section, correct? We'll take 1 minute short break and we'll continue it with the other section of this particular chapter. Short break only we are taking. Hello and welcome again. Now we are going to pick up this particular section, section 8. This section deals with common control, demerger, spin-offs and sale of division. Correct? Common control, demerger, spin-offs and sale of division. What exactly this particular concept is all about? Let's have a look over here. In order to make you understand, first of all, you need to pay attention over here that when we say common control, correct? Under this, actually, we are going to study three things. As I just told you, it also encompasses what we call sale of division, split off, and as I told you, mergers. So, in order to understand the what we call intricacy of this particular chapter, this particular section, and this particular concept, we presume that there is an organization. This is the organization, and it's a pretty big organization. Correct? At this moment, simply just pay attention towards this particular point, and we presume that this organization is having two divisions. Division 1 is A, and there is another division, division B. We presume that this particular division is producing TV sets, and this particular division, let us say, is producing mobile sets. correct? Mobile sets. Of late, actually, the management of this particular company is having a sort of notion that this particular division, Division B, which is producing mobile, is not actually functioning as per the desired levels, or it is not fetching returns as per our expectations, or there could be another reason that this particular division might be what we call incurring the loss. So what the management decided of this particular organization to simply what we call dispose it off, to sell it off. So ultimately management decided to sell Division B to another company, and I have simply written as new company. Is it clear to you? So this organization, which is having two divisions, Division A and Division B, decides to sell off one of the division to new company. First of all, you need to understand that this process of selling one division to the new company is known as demerger. It is known as demerger because demerger is opposite of merger. When two things combine together, obviously the size and the what we call, when I say size, it means the entity becomes more stronger, or the size of the entity now will increase because of the combination of the two entities. And demerger is just opposite of that, because out of two division, now we have sold out one division. So first of all, you need to understand that this organization or this entity now will be referred to as demerged entity. It will be referred to as demerged entity because it has sold out one of its division. So this organization will be considered as demerged entity. Number one. Number two, because one of the division has been sold out to a new company, so this process of selling the division, as I just told you, will be known as either demerger, or you can refer to as sale of division, or you can simply refer to it as split off. Split off. Is it clear to you or not? This process of selling the what we call division to a new company will be considered demerger, split off, or sale of division. Number one. Now, when an entity decides to sell one of its division to the other entity, obviously because we are selling out one of the division to a new company, we will not sell off our division free of cost. Obviously, the new company will have to discharge some consideration. And because this is the organization, division belongs to the organization, and this organization or entity or enterprise has sold off one of the division to a new company. So obviously now the new company is obliged to pay actually some consideration. So when the new company will make the payment or will deliver the purchase consideration, various scenario may unfold. And you need to be very careful if you really want to understand the accounting aspects under this particular concept. Number one. The first scenario is that the new company may deliver the payment or purchase consideration directly to the organization. If new company, which is taking over the business of B Limited, decides to deliver the purchase consideration directly to the demerged entity, then it will be considered as a case of common control. Then it will be considered as a case of common control. What we mean by common control, that I will talk about later on. But what you need to understand is that if it becomes a case of common control, then in the books of the acquirer, because new company is the acquirer entity, in the books of the acquirer entity, we will have to use pooling interest method for the purpose of accounting. Is it clear to you or not? We will have to use pooling interest method of accounting. Normally under Ind AS 103, I've already told you, when we do accounting in the books of the acquirer, we follow acquisition method, wherein actually we take over all the assets and the liability at fair value. And of course, we discharge the consideration later on and prepare the consolidated balance sheet. Under pooling interest method, also we will take over the assets and liability, but only difference is that here assets and liability will be taken over at carrying amount. Besides that, there are some other points which I am going to discuss later. But at this moment, you need to know actually that if the purchasing company will deliver the purchase consideration directly to the demerged entity, then it will be considered as a case of common control. Is it clear to you or not? Then it will be considered as a case of common control. This is the point which you should not neglect. This is one point. Now there is another point. The new company may decide to deliver the purchase consideration instead of demerged entity. It may decide to deliver the purchase consideration to the members of the demerged entity. Members means shareholders of the demerged entity. So new company may decide either to deliver the consideration directly to the organization. In that case, it will, without an iota of doubt, will become what we call a case of common control, and we will have to adopt the pooling interest method in the books of new company. Number one. Number two, if new company delivers the purchase consideration to the members of the demerged entity, DME means the demerged entity. Is it clear to you? So this time consideration will not be received by the demerged entity, rather it will be received by the members of the demerged entity, that is shareholders of the demerged entity. Now, if the consideration is being delivered to the members of the demerged entity, then three scenarios could unfold. One scenario, new company has delivered the consideration to the members, and scenario one of the member now holds more than 50% stakes in the new company. If new company delivers the purchase consideration, because mostly we will see under a case of common control, merger, demerger or sale of division, generally the purchase consideration more often than not we'll see actually is delivered by way of shares only. Now, if new company delivers the consideration to the members, and one of the members holds now, one of the member of the demerged entity now holds more than 50% stakes in the new entity, then again it will be referred to as case of common control. Correct? So you need to know actually when there will be case of common control and when there will not be a case of common control. So again it will be considered as a case of common control. Second scenario, new company delivers to the members, and now I have written here point number B. Here you can see in point number B I have written that none of the members hold more than 50% shares in the company. If none of the member holds more than 50% stakes in the new company, then in this case you will do the accounting under what we call Ind AS 103 as we normally do. That means in the books of acquirer company we will use the acquisition method. So this will not be considered as a case of common control. Is it clear to you or not? If none of the member holds more than 50% of the stakes in the new company, again here it will be considered as a case of acquisition method and no common control method. You will do the accounting in the books of what we call accounting acquirer as hitherto we are doing. Is it clear to you? Scenario 3. Scenario 3 is that new company delivers the purchase consideration to the members, but the question is silent. That means question is not specifying whether there is a shareholder who is having more than 50% stakes, or question is not specifying whether there is a shareholder who is or none of the shareholder who is having stakes. If question is silent, then my advice is always presume it as a case of common control. Is it clear to you or not? Always presume it. That means we are trying to find out in the books of new company, correct, for the purpose of accounting. For the purpose of accounting, here I have written, for the purpose of the accounting actually, especially in the books of the new company, we need to know whether it is a case of common control or whether it is a case or whether it is not a case of common control. Whether it is a case of common control or whether it is not a case of common control. This is only for doing accounting in the books of the new company. Now, many students sometimes ask, sir, what about demerged entity? How the accounting pattern will be done? Now, let me tell you, and this point many people skip. In the books of demerged entity, of course, I will have to do the accounting because demerged entity is selling one of the division. So I will have to do the accounting in the books of the demerged entity, but not a single accounting standard will apply. Neither existing accounting standard AS 14 nor what we call Ind AS 103. Only general principles of accounting are applied to do accounting in the books of, as I told you, demerged entity. In the books of demerged entity, we will simply use general principles of accounting. We are configuring whether it is a case of common control or not, simply for the sake of doing accounting in the books of what we call accounting acquirer, in the books of what we call acquirer. Is it clear to you or not? Now, the next question is how the accounting will be done. Actually, although it is pretty long one, but it is very easy, correct? In the books of demerged entity, what sort of entry you are going to do? Actually, if you are going to cram, you are not going to learn anything. To be very honest with you, in the books of what we call demerged entity, in order to know how the accounting will be done, it is very simple. You have to simply look into the fact which part of your entity, which division is being sold out. Out of these two divisions, Division B is being sold out. And when we say Division B is being sold out, indirectly it means all the assets and liability of this division are going to be passed to the new company. This is the entry you will have to write. Because the assets of this division will definitely move out, and the liability of this division will move out, and accordingly you are going to actually pass the entry. At the same time, this entity, this demerged entity, is supposed to receive some consideration from the what we call new company against what we call transfer of this asset and these assets and liability. So that is accordingly, entry number 1 will be like this: for transfer of assets and liability. When you are going to write the entry, first of all, you must write new company account debit. Why you are going to write new company account debit? Because you are selling the assets and liability to the new company, and you are transferring the assets and liability to the new company. And I've already told you, you are not going to transfer assets and liability free of cost. Obviously, you are supposed to receive some amount against the same. So that is why new company is your debtor company, and you will have to debit the same. Then you will debit all your liability because your liabilities are moving out. Obviously, indirectly it means your liabilities are decreasing. So in order to decrease the liability, we have to actually here liability are not only decreasing, rather they are extinguishing. Anyway, in order to extinguish or decrease the liability, we are going to actually debit the same. So you are going to debit the liability. And then you are going to write here assets, to assets account, because assets are moving out. So you are going to credit the assets. Now, once you have written new company account debit, liability account debit to assets account, obviously there may be some difference. Now, if the difference appears towards the debit side, remember one thing: you are doing accounting not in the books of acquirer at this moment. You are doing accounting in the books of demerged entity. Only general principles will apply. I have already told you. So if difference will appear towards the debit side, you simply write here other equity account. Or you can also write reserve and surplus account or profit or loss account. But ultimately, profit or loss account, general reserve fund will fall in play under the heading other equity. So you can directly write here other equity. Is it clear to you? Likewise, indirectly it means it is loss also. And if the difference appears towards this particular side, again that difference will be credited to other equity account. That means whether the difference appears on the debit side or the credit side, you are going to simply put that difference in other equity account. You can also write what we call capital reserve, but ultimately capital reserve will find place under other equity. So you can directly write other equity. Is it clear to you or not? This is entry number 1, and it is not a very tedious task. You must have seen already. Now the point number 2. Next part is with respect to consideration. I told you the new company, there are two possibilities. New company may deliver the consideration to the demerged entity, or new company may deliver the consideration to the members of the demerged entity. So that is why under consideration I have written here situation 1. If consideration has been received by demerged entity, that means the new company is delivering the purchase consideration and the consideration is being received by the demerged entity. If demerged entity will receive the consideration, then we are going to write an entry shares in new company account debit to new company account. Correct? It is as simple as that. However, there could be another possibility, that consideration is not received by the demerged entity, rather it is received by the members of the demerged entity. If consideration is received by the members of the demerged entity, in that case, consideration is not received by demerged entity. Problem is that demerged entity has already debited new company account. And when new company will pay the consideration, because new company may pay the consideration directly to the demerged entity or what we call to the members. So when new company will deliver the consideration, new company will simply tell to demerged entity that we have already actually met our obligation of discharging the consideration. So new company will have now no more alternative, they will have to credit the new company because new company has already given the purchase consideration. Now the only problem is that the amount of consideration which was supposed to be received by the demerged entity was actually received by the members. So that is why it is a sort of a loss to the new company. That is why here I am going to write other equity. Actually, it is a sort of loss to the new company. It is almost like what we call debtors not paying off your amount. Is it clear to you or not? So if consideration will be received by the members, then in the books of demerged entity, we will write the entry this way around, other equity account, it's a loss to us. Why it is a loss to us? You need to understand that to new company, because you have debited new company. So new company was your debtor company, but you did not receive a single penny. So that is the reason actually other equity will be debited, and to new company you are going to pass the entry. Is it clear to you or not? In the books of demerged entity, number one, we will have to pass the entries. As I told you, we are supposed to pass the entry. And besides that, we will have to prepare a balance sheet of demerged entity. Actually, preparation of balance sheet of the demerged entity is extremely easy task. Extremely easy task. Just to cite an example. For example, let us say we have two divisions, A and B, and our total property, plant and equipment of division A is 100 and division B is 200. Because we have transferred division B, now I will simply write what we call property, plant and equipment of division A. That means when I am going to prepare the balance sheet of demerged entity, that means after the sale of the division, I will simply include only the items of the division which is left with us. Is it clear to you? So it is not a very tough task, and when I will do the practical question, then I am going to let you know how it is prepared. So in the books of demerged entity, two things you are supposed to do. Number one, first of all, you need to understand that accounting in the demerged entity will be done on the basis of what we call general principles of accounting. Here no accounting standard will apply. Is it clear to you? And now part B, that is books of new company. In the books of new company, as I told you, we have to figure it out whether it is a case of common control or not. If it is a case of common control, we have to apply the pooling interest method, as I told you. Correct? Presuming that it is a case of pooling interest, common control, then I will have to do the accounting in the books of acquirer entity, and the accounting will be done in this manner. Before doing the accounting, let me also remind you that under pooling interest method, all the assets and liabilities will be taken over and will be taken over at book value only. Correct? If there will be any difference, either towards the debit side, because you have now acclimatized to the fact, or should I say that you have become accustomed to the fact that wherever difference arises on the debit side, you write goodwill, and whenever difference arises towards the credit side, you write gain on bargain purchase. Correct? Because so far we are exactly doing this way around, because under acquisition method in the books of acquirer, we have to debit the difference to the goodwill and credit the difference to gain on bargain purchase. But in case of common control, if it is a case of common control, under entry number 1, if there will be a difference either towards the debit side or towards the credit side, you are simply going to write only capital reserve. You are not going to write goodwill, especially if the difference arises towards the debit side. You will refrain from writing goodwill. You will simply put a capital reserve whether the difference is arising towards debit side or towards the credit side. The reason being is that actually, the why I'm asking you to refrain from writing what we call goodwill, because the appendix which deals with what we call this common control states that no new asset should be recognized. No new asset must be recognized in case of common control. So if I'm going to write goodwill, that means basically I'm recognizing a new asset. So that's the reason actually, if there will be a difference, the difference will be put up towards what we call capital reserve, whether difference is towards the debit side or on the credit side. Third point, and it is very vital, the amount of consideration in the books of acquirer will be recorded at nominal value only. Nominal value only. You are going to record the consideration at nominal value only. Is it clear to you what we mean by that? Suppose new company is discharging a purchase consideration of 50 lakhs. But in order to discharge 50 lakh, they are issuing share capital at a nominal value of, let us say, 30 lakh and at a premium of rupees 20 lakh. So in the books of acquirer company, because it is suppose if it is a case of common control, then as per the guidelines, I will have to write here in the books of acquirer company the nominal value of the purchase consideration, which in this case will be equal to 30, and I will have to ignore out this security premium. Correct? This is another point. Next point is acquirer company will create reserve in its books similar to the reserves which are existing in the books of the acquiring company. What does it mean? Suppose I am the new company and I am taking over the business, or division B should I say. Correct? I am taking over division B. Obviously, division B is having some assets and some liability, and on the liability side, let us say division B is having reserves to the extent of, let us say, 10 lakh rupees. Correct? Now, as per this guideline, if it is a case of common control, besides taking over assets, besides taking over liability, I will not take over the reserve. This line is not telling, because many among us are under a confusion, under a notion that in case of common control, all the assets, liability and reserves are taken over. No. The reserves of what we call any entity, you can never ever take. Let me tell you. You can never ever take the reserves. You can take only the assets and liability. This line is acquirer company will create reserves similar to the reserves which are appearing in the books of the acquiring company. Because you are the acquirer, this is the acquiring company, this reserve is appearing in the books of the acquiring company. You will, only thing is that you will have to create a reserve. You will not take over this, but you are going to create it from your own resources. So indirectly, and many among us actually think that actually we are taking over the reserve. Reserves can never ever be taken over. You will have to create it from own resources. This is the point. Is it clear to you or not? So we are going to create reserves from own resources. Obviously, it's a sort of loss to the what we call new company, no doubt about that. Here there is a confusion. Sometimes profit and loss account exists in the books of the new company. And if profit and loss account is having a positive balance, obviously you will have to, because P&L also is a sort of reserve. So you will also create P&L. But if P&L is having a negative balance, then you are not going to create any reserve. Negative reserves will never be created. Correct? Only positive. This is the point which you need to understand in this particular case. So in case of common control, as I told you, we are not going to apply the appendix method. We are going to apply the pooling interest method. As per pooling interest method, you have already seen actually all the assets and liability will be taken over and taken over at carrying amount. Number one, the difference will be debited or credited to capital reserve, and the consideration will be recorded at nominal value only. And in case if there are some positive balances in the reserves or profit or loss account, we will have to create what we call similar to those reserves and P&L in our books also. This is the point which you need to understand. So that is why in the books of what we call new company or the acquirer company, first of all, I'm going to write here assets. Obviously at book value, I will take over the liability. Correct? In case some reserves are there, I will have to create the reserves, no doubt about that. Then I will write the consideration payable. And then I will compare, of course, debit credit side. In case the balance appears towards the debit side, I will write capital reserve. And irrespective of the fact whether difference is on the debit or credit, I have already told you, you are going to actually use the word capital reserve. Is it clear to you? Because if I'm going to use the word goodwill for the debit balance, technically speaking, debit balance in capital reserve is nothing but goodwill. But we have to refrain from writing goodwill, because if we are writing goodwill indirectly or indirectly, it means actually we are recognizing a new asset, and which is prohibited as per appendix. Is it clear to you? So now we will make the entry for consideration payable. Another important point is that when you are going to make the entry will be at nominal value only. At nominal value only. Nominal value only. This is the point which you need to understand in the books of. And accordingly, after these entries, you will prepare the balance sheet in the books of the what we call due company, and which is not a very tough task, to be very honest with you. In order to make you understand it better, let's have a look over one question so that you understand it quite easily, and then things will become easy for you to understand. Well, we'll pick up first of all this particular question so that you understand it quite easily. 8.1 is the question. Here, as you can see in this particular question, there is an entity by the name of AB Limited, and it is given to you. It has got two divisions, Division A and Division B. And the respective balances of Division A and B are given to you as on 31st of March 2023. And here it is written, property, plant and equipment at cost 500. And of Division B it is 1000. Then less accumulated depreciation 450 and 800. Technically you can say property, plant and equipment is appearing at a value of 50. And with respect to Division B, it is having a value, written down value of 200. So the total value of property, plant and equipment, of course the net value is 250. Correct? 50 plus 200 is equal to 250. Only two items are given, as you can see. One is actually property, plant and equipment. Another one is current asset. As far as current asset is concerned, you can see here it is given to you 400 and 1000. Then you will add them. Actually, it is given in the question that total is 1400. And then we are being given the liability side item. We are being given actually capital, equity share capital. One share is of 10 each. Equity share capital of Division A is given, and it is given as total B. And then other equity is given. Other equity is 350. Just pay attention. Other equity balance of B Limited is 200, negative 200. So 350 minus 200, total becomes 150. And besides that, loan amount is also given, but in the books of A Limited, there is no amount of loan. In the books of Division B, there is amount of loan. And then we have got current liability to the extent of 50 and 800. Now, below it is given that Division B, along with its assets and liabilities, were sold off for 50 lakhs to X Limited, a new company which issued 2 lakh equity shares of 10 each at a premium of 15 per share. So in this case, as you have already noted down carefully, that there is an entity by the name of AB Limited. AB Limited is the organization. It has got two divisions, of course, Division A, Division B, and Division B is being sold out to X Limited. Division B is being sold out to X Limited. Further, it is stated that X Limited is going to make a payment of 50 lakh purchase consideration. Also, it is mentioned in the question that in order to discharge 50 lakh, the new company will issue 2 lakh equity shares. New company will issue 2 lakh shares, having what 2 shares of rupees 10 each. That means the nominal value is 10. So 20 lakh is the nominal value. And each share will be issued at a premium of rupees 15. It is also stated in the question you have seen here. Correct, at a premium of 15 per share. So total premium amount is 30 lakh, and this is how actually new company is going to deliver the amount of purchase consideration. Is it clear to you? Now the main point is, here it is also stated in the question, to the members of division in full settlement. Point is that this payment is being received by the members. Now if the payment is received by the members, I told you earlier, there could be 3 scenarios. One of the shareholder may have now more than 50% stakes in the new company, then it will be considered as a case of common control. Second scenario, none of the shareholder is having what we call more than 50% stakes in the new company, then it will not be a case of common control. Normal accounting will be done. And another one, question is silent. Now, in this particular question, actually nothing is mentioned. Whether any shareholder is having more than 50% stakes in the new company or not. It is not stated in the question. And I told you earlier, if nothing is stated in the question, it is always better to treat it as a case of common control. Is it clear to you? So we will treat it as a case of common control. There are no other transaction and you are required to show journal entries in the books of AB Limited. I told you generally the question will ask you in the books of demerged entity. Now AB will be considered as demerged entity. So they have asked you to pass entries and also prepare balance sheet. Generally it will be asked, correct, in the books of AB Limited and in the books of X Limited, which is new company. You are supposed to again pass the entries and prepare the balance sheet, and which is not a very tough task to do. Is it clear to you? So you have to note down very carefully the assets, especially of division B, because division B is being sold out. Now the written down value of division B as far as property, plant and equipment is concerned, 200, current asset is 1000. As far as liabilities are concerned, there are two liability, loan and current liability. Correct? Loan and current liability. And importantly, their reserves, other equity or reserves is having a negative balance. So although it is a case of common control, in the books of what we call new entity, I will not create negative reserves. I have already told you. Is it clear to you or not? So this is how I am going to pass the entry, and it is not a very tough task to pass the entry. I have already told you. First of all, I will write in the books of AB Limited. Then I will prepare the journal. Correct? I need to write here very clearly in the examination whether the figures are in lakhs or not. So figures are in lakhs. I told you in the books of demerged entity, you have to think very logically because one of the division is being sold out. The division B is sold out. Obviously, you are going to first of all write the name of the company to whom this particular division is being sold out and how much of consideration you are supposed to receive. You are supposed to receive 50 lakh. X Limited you are debiting because it is almost like a debtor for you right now. Correct? So X Limited account debit 50 lakh. And then I am going to debit all the liability of this particular division. There are two liability, loans and current liability, 600, 800. Then I will write here two property, plant and equipment. I have written actually in your notes it is two property, plant and equipment, and the written down value of the property, plant and equipment of this entity is actually 200, division B. So you will credit the asset, and there are current asset also, so you will write also current asset. Now in this case, the figure is appearing, the difference is appearing towards the credit side. So this difference, I've already told you. Now because we are doing accounting in the books of demerged entity, in the books of demerged entity, we have to apply general accounting principles. Now as per general accounting principles, difference should be debited to what we call capital nature reserves logically. Correct? Or you can directly write other equity. I have written here capital reserve because ultimately capital reserve, net effect of capital reserve will be taken to what we call other equity. You can directly write other equity. I have written here capital reserve. You can write capital reserve also. Correct? In the books of demerged entity, the difference I told you, if the difference appears towards the debit side, you can write other equity or capital reserve. Or if the difference appears toward the credit side, you can write other equity or capital reserve or even general reserve or profit and loss account, whatever you may feel so. Correct? Now the second entry. Second entry is that with respect to consideration, if you remember in the books of demerged entity, obviously you will have to credit the X Limited. Why? Because X Limited will have to discharge the consideration and they will discharge it. But the only point important is that the consideration which you were supposed to receive, you didn't receive. You did not receive the amount of consideration. Are you getting my point or not? You did not receive the amount of consideration. It is a loss to you. I've already told you, you can write other equity or capital reserve. So you will write here loss. Is it clear to you or not? You can see in the here there is a credit balance in the capital reserve, and now here capital reserve is debited. These are the two entries which you are supposed to pass, and now you are supposed to prepare the balance sheet. And when you are going to prepare the balance sheet, it is important for you to understand that now you are left up with only one division, division A. So you obviously the property, plant and equipment of division A will come here, and then written down value of this is the cost, this is the depreciation, and this is the net value. You can straight away write net value. And current assets of division A is 400. So total of the current asset is 450. It is so easy, correct? And now we'll move over to the equity and liability. As far as equity and liability are concerned, correct, I will write here equity share capital. Obviously the equity share capital of division A, that mean of organization, is 50. So I will write 50 here, correct? And it is given in the question that one share is of 50. This is 50 lakhs. So that is why I have written here 5 lakh shares of 10 each. You can directly write 50 lakhs. Coming over to the other equity, I've already told you the acquirer entity can never ever take over the assets and liability. They can take over only the assets and liability, not the what we call other items. So in this case, first of all, you need to understand that you are left up with division A, and the total equity of division A is equal to 350. Other equity of division A. But that other equity of division B hasn't been taken over. It is not taken over. So that is why the other equity of division B will be taken into account, and it is having a negative balance. So 350 minus 200 is 150. And as I told you earlier, because you have credited capital reserve in the first entry, you will add capital reserve, and in the second entry, capital reserve is debited. I told you instead of capital reserve, you can write other equity also directly. So ultimately, it will be fitted over here only. So your final balance in the other equity will be 350. Is it clear to you or not? Similarly, current liability of division A will be written over here. So total amount will be 450, 450. Coming over to the new company, books of new company. In the books of new company, now you presume you are the new company. Now you are the accounting acquirer. First of all, you need to figure out whether it is a case of common control or not. It is a case of common control, number one. Now, in case of common control, you will record all the assets and liability, but at book value only, number one. So you will write property, plant and equipment, book value 200. At this value you have taken over. Of course, it is a written down value. Then you have taken over the current asset 1000. Then you have taken over the loan. I have written loan funds. Then you have written here, you are going to write here to current liability. Now, just a moment ago, I told you in this particular case, when you are going to write the amount of consideration, I told you consideration will be written at nominal value only. So you are not going to write here 50 lakh in the books of the acquired company. If it is a case of common control, you are going to write it at nominal value. Is it clear? Another important point. This time the difference is coming over to this side. In the books of acquirer, with respect to common control, I told you, you will never ever write here goodwill. Correct? So you will write here capital reserve only. So this is your capital reserve 220 in the books of acquirer company. In case of common control, the difference either appearing towards the debit side or towards the credit side will be adjusted through capital reserve only. But that's a different point, that capital reserve debit balance also means goodwill. But you have to refrain from writing goodwill, as I told you. Number one, now here is a slight confusion when guideline says that consideration should be written at nominal value. Many among us think actually, what about security premium? Now just imagine for a while, suppose if you would have had written here full amount of consideration. The full amount of consideration is 50 lakh. So 20 I have already written. If that means 30 more I would have had written. If I would have had written full amount, that means the total amount would have been 50 instead of 20. Now, if I would have had written here 50, then what would have happened? My capital reserve debit balance would have been higher by 30. So ultimately the net effect will be the same, because both these items, correct, security, this is security premium and this 30, both these items ultimately will find place under other equity. So ultimately it is not going to make any difference whether you are going to write here full amount of what we call consideration or not. It will have the same effect, correct? But the point is that we have to follow the guideline, and the guideline says that actually we have to write here only the nominal value. So nominal value you are going to write here. And then because you are the company which is taking over the business of the other company, you are supposed to discharge the consideration. And because you have written here 20 lakh, you are going to debit the consideration account at 20. And to discharge 20 lakh, you have issued equity share capital worth rupees 20 lakh. Now, on the basis of these two entries, you are going to frame the balance sheet. Actually, it is very easy to frame the balance sheet, because now we have taken over the property, plant and equipment. And I am a new company. So in my new company's balance sheet, property, plant and equipment will find place at 200. Likewise, current asset will be there to the extent of 1000. And capital reserve is having a negative balance of 220 at this particular moment. I will tell you where it will be written. Of course, it will be written under other equity. It will be written under other equity, no doubt about that. At this moment, the balance is minus 20. And then loan funds will be written towards the liability side, current liability also, and then consideration amount here I have written and here I have written. So it will get cancelled. I will not write consideration anywhere, and I will write equity share capital 20 lakh. So this is the balance sheet. On the basis of the entries, you will have to frame the balance sheet in the books of the new company. You have seen actually how easy it is actually. So balance sheet of the new company, when I'm going to prepare, obviously I have taken over property, plant and equipment. I will write over there. Current asset we have taken over 1000. I will write it over there 1200. And besides that, I have issued share capital worth rupees 20 lakh. So now my equity share capital will be equal to 20 lakh. And under other equity, as I told you, because there is a debit balance in capital reserves, so 220 debit balance will appear, negative balance will appear. And we have taken over non-current liability in the form of what we call loan and current liability to the extent of 100. So total amount will be equal to 1,200. So it is so easy. It is not a very tough task to do. And on similar what we call note, you can easily manage question number 8.2. It is pretty easy and absolutely similar to the one which I just told you earlier. So if you are going to read this particular question, in this particular question also there are two divisions, laptop and mobiles, number one, correct? And then we are being given almost same item. I think the figures are half, correct? Otherwise, this question is similar to the one. Actually, under common control, you are not going to have many varieties. In fact, so that's the reason. Actually, once you are able to understand the what we call accounting aspects through one question, you should be in a position to handle any sort of question which may be flung before you. So in this case also written down value of property, plant and equipment and current asset, two items are there. Share capital last time was 50, this time 25, and other equity, it is having a positive balance, it is having a negative balance. So Mobile Limited's other equity will not be taken over, quite obviously. Loan is not there, here it is 25,400. So this is the situation in this particular question. And in the last question, we sold it out for 25 lakh. This time, this division, mobile division, has been sold out to Turnaround Limited for rupees 25 crores. Similar to the last question, in the last question, 2 crore shares were issued. This time, 1 crore shares. Although last time figures were in lakhs, this time figures are in crores. So 1 crore shares of 10 each at 15 per share. So total amount 1 crore into 25 crores. Correct? Nominal value is 10 crores. 1 crore into 10, and premium amount will be 1 crore into 15, that will be equal to 15 crores. And it is clearly mentioned to the members of the enterprise limited, correct? And further it is written, one of the members of the enterprise is having more than 52% stakes. The only difference is that in this particular question, it is clearly mentioned. So you can easily manage. It is a case of common control, almost same question as I told you. And you should be in a position to do this, but honestly speaking, chances of question striking from this particular part, to be very honest with you, are very slim, correct? Now, of course, before we move over to the next section, we will take a break of 1 or 2 minutes, and then after that we'll start this particular section also, correct? So after the break, we'll meet you. Hello and great welcome. So after wrapping off section 8, now we shall move over to section 9, and in this particular section you may be a bit amused when you are going to actually go through the heading of this particular section, books of vendor company. Why we are studying this particular what we call section, it is very important because more often than not actually you are more focused only on the what we call accounting aspects in the books of the accounting acquirer, but hardly anyone knows regarding the accounting in the books of the vendor company. I will talk about all this concept in detail, need not require to worry about that. And now first of all, let me actually give you a bit of idea regarding this particular section, correct? So as far as this particular section is concerned, in order to grasp the intricacies of this particular section, let's actually take you towards this particular point. If you remember, in the initial stages, I talked about this particular fact that an entity could acquire actually control over the other entity either through majority stakes. MS means majority stakes. This is one way of getting the control over the other enterprise, and besides that, through agreement, correct? So we can get the control over the other enterprises. If you remember in the opening session itself, we talked about this particular aspect, correct? So we can get the control over the other enterprise either through majority stakes or through agreement. But when we get control over the other enterprise by having what we call majority stakes or through an agreement, under such circumstances, the existence of the acquiring company continues. This is very important to understand. Under such circumstances, the existence of the acquiring company does not come to an end. The acquiring company actually keeps on what we call functioning, but only difference is that it functions or operates under our directions, under our dictates, under our terms, under our guidelines. However, if you remember in the opening session, I also talked about what we call this particular fact that we can get control over the other enterprise by acquiring their assets and liability. When we get the control over the other enterprise by acquiring their assets and liability, generally under such circumstances, the existence of the acquiring company comes to an end. Correct? And that is the reason actually, under such circumstances, consolidated financial statements are not prepared. When we get control over the other enterprise simply by purchasing their all assets and liability or acquiring their all net assets, under such circumstances, the existence of the acquiring company would come to an end, and definitely there is not going to be any what we call question of preparing consolidated financial statement. So this is the point which you need to understand. Correct? Now try to understand this. Whenever you are going to get the control over the other enterprise by taking over the net assets, by taking over all the assets and liabilities of the other entity, under such circumstances, the acquiring company is also known as vendor company, and acquirer company is also known as A1 is acquirer company, A2 is acquiring company. Acquirer company is also known as purchasing company, and acquiring company is also known as vendor company. Is it clear to you? So when the existence of vendor company will come to an end, under such circumstances, we need to draw accounts in the books of the vendor company also. And how the accounts are drawn by the vendor company, this is exactly what we are going to study under this particular what we call section. Is it clear to you or not? So how we are going to actually draw out the accounts in order to make you understand better, let me actually take you towards this particular side so that you understand it better. Because the existence of the vendor company has come to an end, that means vendor company's business is now liquidated. Isn't it or not? If you remember in your earlier phases of education, you have gone through a chapter by the name of dissolution of partnership. Even under those what we call circumstances, the business of the partnership comes to an end. If you remember, you used to prepare what we call realization account. Isn't it or not? You used to prepare partner's capital account, that is owner's account. And then you used to prepare what we call cash account. On similar logic, when the business of the acquiring company or the vendor company will come to an end, the vendor company will also what we call open realization account. It will open realization account. It will also open owner's account, but the owners of, in case of a company, are shareholders. So instead of partner's capital account, they will open shareholders account. They will also open cash account, cash bank account. And besides these three accounts, the vendor company will also open purchasing company account or acquirer company account. Is it clear to you? When the business of vendor company will come to an end, in order to actually prepare the accounts, so vendor company first of all will open 4 ledger accounts. Is it clear to you? Acquirer company account, realization account, and shareholders account and cash account. Now the first step is that the vendor company is going to close down its asset side. I'm talking about asset side. I'm not talking about the assets. Is it clear to you? Now, as far as asset side is concerned, you need to understand that on the asset side, we have assets and we have valueless items also. Asset side I'm talking about. We can break asset side into 2 major categories, assets and valueless items. Valueless items basically are nothing but they are valueless items in the sense because they are either accumulated losses or they are what we call fictitious sort of what we call assets. Correct? For example, preliminary expenses, underwriting commission, discount on issue of shares and debentures, even debit balance of profit or loss account is also considered as valueless item. So on the asset side, first of all, you need to understand that our first step in order to prepare the account is closure of asset side. In order to close the asset side, first of all, I need to know that asset side can be bifurcated into 2 parts, that is asset side, assets and valueless assets. Because valueless assets are losses, all the losses and gains actually belong to the owners. So that is why later on you will learn that all the losses will be transferred to the debit side of the owner's account, that is shareholders account. Whatever losses are there. Valueless item, I have already told you, are preliminary expense, underwriting commission. I have already written what we call all the items of valueless which will fall under this particular category. You need not require to write at this particular moment. I am simply trying to tell you actually how you are going to post them. So whatever valueless item you come across, correct, on the asset side, like preliminary expense, discount on issue of shares, underwriting commission, any miscellaneous expenditure, any deferred expenditure, any suspense account, any debit balance or profit and loss account, you are going to post them simply to the debit side of the shareholders account, correct? Now, we come over to the asset side. As far as assets are concerned, again, we can divide the assets into two parts. One part is cash and bank and other assets. Correct? We are dividing the entire what we call category of assets into two parts, cash and bank. And besides cash and bank, whatever assets are there will be known as other assets. Other assets you are going to transfer to the debit side of the realization account irrespective of the fact whether they have been taken over or not. You are going to transfer all the other assets, plant, machinery, building, even all intangible assets, data, stock, etc. All the assets you are going to transfer to the debit side of the realization account, importantly, whether they are being taken over or not. Without caring about this particular fact, whether these assets have been taken over or not, you are simply going to transfer to the debit side of realization account. Is it clear to you or not? Clear? So, coming over to cash and bank. Regarding cash and bank, you need to exercise a bit of caution. Bit of caution in the sense, if cash and bank is taken over, if it is given in the question that cash and bank also has been taken over, in that case, you are going to transfer them to the realization account. R means realization account. If cash and bank has been taken over, in that case, you are going to transfer it to what we call debit side of realization account like other assets. But if cash and bank is not taken over, NTO, not taken over, in that case, you are going to transfer the cash and bank to the cash account. Is it clear to you or not? So this is how you are going to close down your asset side. Correct? All the valueless asset will be taken to the debit side of the shareholders account. Besides cash, whatever assets are there, all those assets will have to be transferred to the debit side of the realization account. And regarding cash, as I told you, we need to exercise a bit of what we call caution. In that case, we need to find out, first of all, whether cash and bank has been taken over or not. In case if the cash and bank has been taken over, in that case, you are going to transfer it to the debit side of realization account. And besides that, if cash and bank is not taken over, in that case, you are simply going to take it to the what we call cash account. This is how you are going to close down your asset side. This is going to be your first step. Your first step, as I told you, is closure of asset side. Then you are going to close down your liability side. For simplicity's sake, we can divide the entire liability side into three parts: capital, reserves, and what we call liabilities. Liability side comprises of three things I need to require to tell you, especially at this particular level. Entire liability side can be divided into three parts: capital, reserves, and liability. Now, whatever capital is there, capital means share capital. The share capital will be taken to the credit side of realization account. I have written here, correct? Capital, you are going to post it to the credit side of share capital, shareholders account. Now, as far as liabilities are concerned, all the liabilities, you are going to post them to the credit side of the realization account, irrespective of the fact whether liabilities have been taken over or not. Is it clear to you or not? Whether liabilities have been taken over or not, you are going to post them to the credit side of the realization account. This is very important. All the liabilities, sundry creditor, bills payable, loans, debentures, etc. Whether these liabilities have been taken over or not, you are going to take them to the credit side of the realization account. Is it clear to you or not? Now coming over to what we call reserves. As far as reserves are concerned, you need to understand that even reserves can be subdivided into three types. That is what we call free reserves. FR I have written here, free reserves, then statutory reserve. SR stands for statutory reserves. And then third category is specific reserves. Specific reserves is nothing but provision because they are specifically created against a particular what we call asset. Now, if there are free reserves, what are free reserves? General reserve, reserve fund, profit and loss account, insurance fund. I have given a list, don't worry about that, correct? So whatever free reserves are there, you are going to actually post them to the credit side of the shareholders account, correct? All the free reserve, general reserve, reserve fund, what we call profit and loss account, credit balance, all the free reserves, you are going to take them to the credit side of what we call shareholders account, as I just told you a moment ago. Now, coming over to statutory reserves, what we mean by statutory reserves, as the name itself is suggesting, here there is what we call sort of pressure upon us on account of law. Any reserve which an entity creates because of pressure exerted by the law is known as statutory reserve. For example, if you are an entity and you are functioning in a notified zone, say special economic zone, so generally there will be a condition imposed upon you that every year some part of the profit will have to be transferred to, let us say, foreign export reserve account. So these are statutory reserves. So statutory reserves are generally created by an enterprise on account of some pressure, as I told you, which is exerted by the law. That is why the name is statutory reserves. Statutory reserves like foreign project reserve account, like investment allowance reserve account, development rebate reserve account. All these are examples of statutory reserves. If you come across any statutory reserves in the question, all the statutory reserve will have to be posted again to the credit side of the shareholders account. Is it clear to you or not? Besides that, if you come across any specific reserve like provision for doubtful debts, like provision for depreciation, all the specific reserves will have to be posted out to the credit side of realization account. You are going to take them to the credit side of what we call realization account simply because of the fact that their corresponding assets have been taken to the debit side of realization account. So as far as what we call liability side is concerned, all the liability will have to be taken to the credit side of the realization account. We need not require to bother about the fact whether the liability have been taken over or not. So irrespective of this particular fact, we are going to take all the what we call liability to the credit side of realization account. As far as capital is concerned, simply you are going to post them to the credit side of share capital account. All the free reserves and statutory reserve will have to be taken to the credit side of shareholders account. And only thing is that specific reserve you need to take care of, it must be posted to the credit side of realization account. Correct? So after having what we call done up with these two steps, that means now you have closed down your asset side and liability side. Now the third point is regarding the purchase consideration. You are the vendor company. Directly, when I am saying that I am purchasing your business, I am the acquirer company, you are the vendor company. Now, from your perspective, you are selling the business to the acquirer company. Are you getting my point or not? Because I am purchasing your business, all the assets and liability, indirectly it means you are selling the business. When vendor company is going to sell off its business to the purchasing company or the acquirer company, in that case, obviously you are bound to receive some amount of what we call consideration, known as purchase consideration. So this is the next part of the accounting as far as what we call books of vendor company is concerned. So the next part is with respect to purchase consideration. In practical life, generally an agreement takes place whereby it is agreed between the what we call vendor company and the purchasing company that what amount of consideration will be given by the purchasing unit to the vendor company. So when the agreement takes place, the vendor company is going to pass down an entry. It will write purchasing company account debit or acquirer company account debit to realization account. The vendor company is going to actually debit the acquirer simply because of the fact that acquirer is a sort of debtor for the vendor company because they have to receive this money. They haven't received it yet. Correct? Only agreement has taken place. Remember one thing. So that is the reason we are going to pass down this particular entry, acquirer company account debit to realization account. It's a gain to us. That is why we are going to credit the realization account. Is it clear to you? That means on the credit side of realization account, I will write by acquirer company, and on the debit side of acquirer company, I will simply write to realization. Obviously, then we are going to receive this consideration. When we will receive the consideration, because our business has been purchased by other companies, so other company may discharge the consideration either through cash or shares or some portion in cash or some portion in shares. So in whatever form we are going to receive the what we call purchase consideration, we are going to debit that. For example, the total purchase consideration from the acquired company is received in cash and in shares. Some portion is received in cash and some portion in shares. So I am going to actually debit cash account. I am going to debit the shares in acquirer company account, and then I am going to write acquirer company account. So this way I will receive the amount of the consideration. Is it clear to you or not? So when I am going to receive the consideration, as you can see, acquirer company account is getting credited. So on the credit side of acquirer company, I am going to put up by cash by shares. And obviously in the cash account I will post to acquirer, and in the what we call shares account I will post to acquirer company account. Is it clear to you? So these are the two entries with respect to purchase consideration. After these three steps, the next part is, what is the next part then? After these three steps, where I have written the next part, I haven't written the next part. Just wait. If I haven't written, then okay, I will let you know in a short while, don't worry. After this particular part, the next step is, I must have written somewhere, but anyway, I will write it for you, don't worry about that. The next part is that now I will have to take care of the fact we have closed down the asset, we have closed down the liability. Now I have taken into account the purchase consideration. The only thing is that now I will have to check whether there are any assets, which haven't been taken over by the purchasing company. Are you getting my point or not? So if there are any assets which haven't been taken over by purchasing company, remember one thing, in the initial stages, I have already told you, all the assets, barring cash and bank, all the assets you will have to post to the debit side of realization account, whether being taken over or not. That means you have already posted all the assets to the credit side of realization account, irrespective of the fact whether they have been taken over or not. Now, out of those assets, let us say some assets haven't been taken over. So if some assets haven't been taken over, you are going to dispose them off. So the next one is realization of assets not taken over. Realization of assets not taken over. So if some of the assets which haven't been taken over, then you are going to realize them, and your entry will be cash account debit to realization account. Cash account debit to realization account. I have already told you, as far as assets are concerned, all the assets will be taken first of all to the debit side of the realization account. I have already told you whether taken over or not. Let us say out of these four assets, this particular asset hasn't been taken over. And now later on question states that this particular asset has been disposed of for so and so value. So you are going to pass down this particular entry, cash account debit to realization account. Is it clear to you or not? Of course, this entry is affecting cash account and realization account. You are going to actually post it later on. Then, similarly, I told you in the initial stages that all the liability you will have to post to the credit side of the realization account, whether taken over or not. Let us say there are three liabilities. So I will post them first of all to the credit side of the realization account. But let us say out of this particular liability, this liability hasn't been taken over. But I will have to post it here, whether taken over or not. And if this liability hasn't been taken over, now it is my duty, the duty of the vendor company, to pay it off. So payment of liabilities not taken over. Next step is payment of liabilities not taken over. Payment of liabilities not taken over. So if there is any liability which hasn't been taken over, you are going to pay them off, and your entry will be realization account debit. Realization account debit to cash account. Realization account debit to cash account. Is it clear to you or not? Clear? Absolutely clear. Now the last step, technically this is the last step. Last step is with respect to expenses. With respect to expenses. Sometime it would be given in the question that because purchasing company is taking over the business of the vendor company, so sometimes some expenses crop up on account of what we call such process. So if it is given in the question that some expenses have taken place, then how the treatment will be done? If it is given that expenses have been borne by vendor company, have been borne by vendor company, have been borne by vendor company. If it is given in the question that expenses amounted to, let us say, 10,000, and these expenses have been borne by vendor company, obviously in that case vendor company is going to pass an entry, and the entry will be realization account debit to cash account. Vendor company is going to pass down this entry, realization account debit to cash account. Is it clear to you or not? Clear? Likewise, it could be a possibility that it may be given in the question that expenses have been borne by acquirer company. Expenses amounted to so and so, and it is borne by acquirer company or purchasing company, whatever you may like to write. If it is given in the question that expenses have been borne by acquirer company, then this entry will not be passed by obviously vendor company. Vendor company is not going to pass any entry in this case. In the books of acquirer company, the entry will be profit and loss account debit. Profit and loss account debit to cash account. This is how the entry will be done. So, as far as accounting in the books of vendor company is concerned, you have already seen what exactly we have to do. Now, after having done all these steps, that means now the last step is that we will have to close down the realization account. The realization account will have to be closed down. Whatever balance will be there in the realization account, that balance will have to be transferred to the shareholders account. That balance will have to be transferred to the shareholders account. Then, obviously, I'm going to then tally cash account, and whatever balance is there in the cash account, that balance again will have to be transferred to the shareholder account. And finally, your shareholder account must get automatically tallied. Your shareholders account must get tallied of its own. Is it clear to you? This is how the vendor company is going to do the accounting in its books. Is it clear to you? And to be very honest with you, everything I have written for your sake. See, I have already told you, since vendor company is closing down its business, indirectly it means its business is liquidated now. So it is going to open all these accounts as I told you in the initial stages. Then I told you your first step is closure of the asset side. First of all, we need to bifurcate the asset side into two parts, that is assets and valueless assets. And here I have given you all the list that valueless asset comprises of underwriting commission, preliminary expense, discount on shares, debentures, share selling commission, suspense account, any debit balance or profit or loss account. So, and it will have to be transferred to the debit side of shareholders account as I told you. Coming over to the asset side, I talked about cash. If cash is taken over, cash will be transferred to the debit side of realization account. If cash is not taken over, then you will simply write it in the cash account as balance brought down. Then assets other than cash, I've already told you, you are going to transfer them to the debit side of realization account, irrespective of the fact whether taken over or not. Then we will come over to the closure of the liability side. As I told you, liability side can be divided into three parts: capital, reserves, and liability. I've already told you the treatment that capital will have to be transferred to the credit side of shareholders account, and all the liabilities, whether taken over or not, will have to be posted to the credit side of realization account. And I have here given you the list of the liability: correct sundry creditor, bills payable, outstanding expense, bank overdraft, unpaid dividend, short-term, long-term loan, debenture, etc. Then coming over to the reserves, I told you reserves are of three types: free reserves, then statutory reserves, then specific reserve. I have given you the list also, and I've already given you the treatment. As far as free reserves are concerned, I have told you that you are going to take them to the credit side of shareholders account. Similarly, statutory reserves account. Now, as far as specific reserves are concerned, you are going to post them to the credit side of realization account. Then I talked about what we call purchase consideration. So two entries are passed with respect to purchase consideration. The first one is known as due entry, purchasing company account debit to realization account. And next entry is that when we are going to receive the amount, the entry will be cash account debit or shares account debit or debentures account debit to purchasing company account, depending upon the fact in what manner we are receiving the what we call payment. Then payment of liability not taken over. If any liability hasn't been taken over, and before that I also wrote one thing, that in case if any asset which hasn't been taken over and it is realized, then you are going to pass an entry cash account debit to realization account. After that, payment of liability not taken over, realization account debit to cash account. Then I talked about this particular fact: closure of realization account, closure of cash account, closure, and finally equity shareholder account will get automatically tallied. Is it clear to you or not? So now we are in a position to do one question, correct? Now here the heading is actually when purchase consideration is not given. Sorry, when purchase consideration is given. So more often than not, you will find that purchase consideration is given, but More often than not, you will find that it is not given. But anyway, presently we are picking up the case when purchase consideration, amount of consideration is given in the question itself. Let's have a look over here. The following is the balance sheet of Stoff Limited on 31st of 12, 2026. Is it clear to you? But before I move over to this particular step, let me also actually just give you an idea so that later on no problem arises. I told you in the beginning how we have to do the accounting. Now let me also give you a brief idea regarding the what we call ledger accounts. I've already told you, as far as books of vendor company is concerned, we are going to prepare one acquirer account, then realization account, then we are going to prepare what we call cash bank account and shareholders account. I told you under the first step that first step is closure of asset side. So whatever valueless assets are there, you are going to post them to the debit side of shareholders account. As you can see, I have written over here valueless asset. Besides, all the other assets will have to be posted to the debit side of realization account, irrespective of the fact whether these assets have been taken over or not. So you are going to write two other assets in the realization account. Regarding cash, I told you, you are going to post them to the debit side of realization account if taken over. I have written here in bracket, if it is taken over. If it hasn't been taken over, then simply you are going to write here by to balance brought down. In bracket, I have written not taken over. So if in case cash hasn't been taken over, then you are going to write them on the debit side of cash bank account. This is how your asset side will get closed. Now coming over to the liability side, all the liability, first of all, I told you that you are going to actually post to the credit side of the realization account, irrespective of the fact whether these liability have been taken over or not. Number one. Coming over to the capital, then I told you that capital will be posted to the credit side of the shareholders account. Correct? Then as far as reserves are concerned, all the free reserves, general reserve, profit or loss account, etc. In fact, a long list I have given to you. All the free reserve and all the statutory reserve, like for foreign project reserve account, like development reserve account, like investment allowance reserve account, all these are statutory reserves. So statutory and free reserve will also find place on the credit side of the shareholders account. And then if there are any specific reserve like provision for doubtful debts or provision for depreciation or investment reserve account or stock replacement reserve account, those specific reserve will be what we call crossed out to the credit side of the realization account. So this way around we will close down our what we call liability side also. After that, we will take into account the purchase consideration. I told you the first entry is purchasing company account or acquirer company account debit to realization account. So that is the reason on the basis of this entry, I will write on the credit side of the realization account by acquirer company or by purchasing company. In bracket, I can write purchase consideration. Correct? Then I will post it to the debit side of realization account. This is how the first entry will be posted. Then we will receive the amount of the consideration. In whatever form we are receiving the consideration, we will simply write it on the credit side of the acquirer company. Let us say we are receiving the amount, some portion in cash and some portion in shares. So my entry will be cash account debit, shares in acquirer company account debit to acquirer company. So on the credit side of acquirer company, I will write here buy cash and buy shares in acquirer company account. Then I will cross it also. On the debit side of cash account, I am going to write here to acquirer company account. And now very important point. If you are going to receive the purchase consideration, that portion of the purchase consideration which you have received in cash will be posted to the cash account without an iota of doubt. But besides cash, whatever form you are receiving, whether shares or debentures or preference share, whatever form you are receiving, correct? That form will find place on the debit side of the shareholders account. For example, in this case, when I receive the consideration in the form of cash, I posted it to the debit side of cash account. But if I am going to receive the amount in shares, then I am going to simply put it on the debit side of what we call shareholders account. Is it clear to you? Besides cash, whatever form of payment is there, that payment will be written towards the debit side of the shareholders accounts. Is it clear to you or not? Clear? So now the next one is In case if some liability hasn't been taken over, I am going to pay it off. Entry will be realization account debit to cash account. When you are writing here to cash, obviously you will have to cross it out to the credit side of the cash account. Similarly, regarding expenses, I told you, if expenses are borne by vendor company, then again you are going to write realization account debit to cash account and you are going to cross it over here. Important point is that your acquirer company account will automatically get closed the moment you are going to receive the amount of the consideration. So that is why now you will have to tally off your realization account. I told you whatever result is there in the realization account, you are going to post it to the shareholders account. So you will, whether balance is on the debit side or on the credit side. Obviously, if our credit side is more, it means it is a case of profit. So it will be posted to shareholders account, and on the shareholders account, I am going to write by what we call realization. After that, I am going to tally out my cash account. Whatever balance in the cash account will be there, I will post it to the what we call shareholders account. Indirectly, it means whatever cash is left, that is paid off to shareholders account. So shareholder account, we will cross it to cash. And finally, our shareholder account must get tally of its own. So this is how you are going to prepare your what we call ledger accounts. Now we can move over to the question so that you understand and comprehend it in a better manner. Now here we go. This is the question 9.1. In this particular question, first of all, we are given shareholders fund account. This is the balance sheet of Staff Limited. We will see that business of Staff Limited is being taken over by Start Limited. We will see it later on. Correct? So this is the balance sheet of the vendor company or the acquiring company. Share capital is written. Obviously, on where I am going to post share capital account. Obviously, I am going to post it to the credit side of what we call shareholders account. I will simply write by share capital. Don't write by balance brought down, because your entry technically to post the share capital is share capital account debit to shareholders account, because you are closing it down. So on the credit side of shareholders account, you will write by share capital. Now, as far as reserve and surplus are given, profit and loss account and general reserve both are free reserve, and free reserve again will be taken to the credit side of shareholders account. Coming over to the non-current liability, only one liability in the form of debenture is there. I told you all the liability. There are two liability in this question, debentures and creditors. Actually, bills payable simply written, but no figure is given. So only two liabilities are there, debentures and creditor. Both these liability will have to be posted to the credit side of realization account, irrespective of the fact whether they have been taken over or not. We need not require to bother that, correct? So this is how our liability side will get closed. Now coming over to the asset side, we have here, as far as non-current assets are concerned, property, plant and equipment, we have tangible asset in the form of land and building, and we also have plant and machinery. Both these items will be posted to the debit side of realization account. Then goodwill is also there, goodwill, patent, copyright, trademarks, whatever. Tangible or intangible, you are going to post them to the debit side of realization account. Now, here you have to exercise question. This is preliminary expenses. Preliminary expenses given under the heading other non-current asset. Now, preliminary expense, underwriting, commission, discount on issue of shares, I told you these are valueless items, and so it will find place on the debit side of the shareholders account. Debit side of the shareholders account. And even stock and debtors, you are going to post to the debit side of realization account. Now, regarding bank, I am not sure whether the bank has been taken over or not at this particular moment, correct? If it will be taken over, I will post it to the debit side of realization account. And if it will not be taken over, then I am going to obviously write it as a balance brought down in the cash bank account. Below it is given to us that Start Limited acquired the business of Staff Limited. Now, Start Limited has acquired the business of Staff Limited. So, Start Limited is the purchasing company or acquirer company. Further, it is see how you will come to know that you are purchasing. It is a case of purchase of assets and liability, because under such question, it will not be given that you are acquiring so many stakes, 70%, 80%, 90%. So you will have to presume that you are taking over the business of the other entity and the existence of the other entity is coming to an end. Is it clear to you? So Start Limited acquired the business of Staff Limited. And here it is given that except cash at bank and 12% debentures. Except cash at bank. That means now I come to the conclusion that cash and bank hasn't been taken over. Number one. Also, on account of this line, I come to the conclusion that even this liability debenture hasn't been taken over. Is it clear to you? Because cash at bank is not taken over, I am going to post this in the cash and bank account. Is it clear to you? Further, it is given for rupees 16,80,000. That means you are taking over the business of the other entity for a consideration of 16,80,000. That means in this particular question, your purchase consideration is 16,80,000 and it is given to you. This is known as amount of purchase consideration. Second thing is that I need to know actually what exactly is the mode of the payment. In what manner this payment will be delivered to us. Mode of payment. And it will always be given in the question. It is given later on in the question that payable 15 lakh in the form of 1 lakh equity shares of 10 each at a premium of 5 per share. So out of 16,80,000, it is given to us that some portion will be delivered to us in the form of shares. And purchasing company will deliver 1 lakh shares of rupees 10 each, but at a premium of 5. That means 1 lakh shares will be issued to us at the rate of 15. That means 15 lakh worth of payment will be given to us in shares. And remaining amount is in cash. It is given in the question, correct? And balance in cash. Balance in cash means 1,80,000 we are going to receive by way of cash. Is it clear to you or not? So further, it is given to us that Stop Limited redeemed its debenture at a premium of 10%. I told you because debenture liability hasn't been taken over. So ultimately you means the vendor company will have to pay it off. But vendor company will, it is given in the question that vendor company is paying it off at a premium of 10%. That means 1,50,000 plus 15,000 at 1,65,000. Finally, here it is given acquisition cost amounted to 10,000 and were borne by Start Limited. So acquisition cost or liquidation expenses, whatever it is, correct? So these expenses have been borne by the acquirer company. Vendor company need not require to pass any entry. Is it clear to you or not? So in order to solve this particular question, although I have already solved here, but just to make you understand better, let's have a look over here. First of all, books of acquiry company. Here I have written books of acquiry company, as you can see. Now, books of acquiry company or vendor company, I have already told you we are going to open down acquirer company account, realization account, then cash account, and then shareholders account. Is it clear to you? As usual, it is your prerogative whether you want to start with liability side, because generally you will be given liability side first. So we start from the liability side in this particular question. First of all, liabilities were written. The first item in the balance sheet was share capital. I will simply write it towards the credit side of shareholders account. Next item was reserve and surplus, and there were two items, profit and loss account and general reserve. Again, these two items will find place over here. Besides that, there are two liabilities. I'm talking about this and repeating it time and again, that all the liabilities will have to be posted here, whether being taken over or not. We know now actually that debentures haven't been taken over, but in spite of that, we are going to post it here first of all. Is it clear to you? Now your liability side is closed. Coming over to your asset side, we were given land and building, correct? We were given plant and machinery, we were given goodwill. All these three items will be posted to the debit side. Besides that, there were preliminary expenses. So preliminary expenses will be taken to the debit side of shareholders account. Is it clear to you? Then there were items like stock and debtors. There was another item, bank balance, cash at bank. So I told you it will be written on the debit side of cash bank account. You simply put up the title as cash bank account. Because cash bank account hasn't been taken over, so that is the reason you did not transfer it to the debit side of realization account. Instead, you have written here balance brought down. Is it clear to you or not? So this way around, your asset side and liability side is closed. The next part is, first of all, I will think of the entries, because we need not require to pass the entry. In your imagination, you simply actually think about your first entry, purchasing company account debit or acquirer company account debit to realization account. This is the due entry for the purchase consideration. So on the credit side of realization account, you will write here by acquirer company. This is your purchase consideration due. That is 16,80,000. Then you will cross it to the debit side of realization account. Then you are going to write here to realization 16,80,000. Then you are going to receive the payment. You have received 1,80,000 by way of cash, and you have received 15 lakh by way of shares. So you will write shares in acquirer company account. Now your acquirer company account will get automatically closed, no doubt about that. Now, whatever payment you have received in cash, you are going to cross it to the debit side of the cash account. And I told you earlier, besides cash, whatever form of payment is there, it will be taken directly to the debit side of the shareholders account, and that is the reason shares in acquirer company account I have taken it over here. Is it clear to you or not? After having received the purchase consideration, now you think of only one point. Whether out of these two liability or out of these liability, is there any liability which hasn't been taken over? Answer is yes. So you will have to pay off that liability and your entry will be realization account debit to cash account. Amount of debenture is 1,50,000. If in this question, it wouldn't have been given to us that debentures were paid off 10% discount, I would have had paid only 1,50,000. But it is given in the question that vendor company paid off the debentures at 10% premium. So 1,50,000 plus 10% premium, 15,000, 1,65,000 I will write here. And I will cross it to the credit side of the cash account also. So now, after paying off the liability, I will have to think about the expenses. Because the expenses are being borne by the purchasing company or the acquirer company, I need not require to pass any entry. Now, I will have to tally it off. If I'm going to tally, I will get a figure of 1,55,000. Obviously, it's a credit balance. It's a profit, no doubt about that. I'm going to post it to what we call equity shareholder account. And on the credit side of the equity shareholder account, I will write by realization. You can write in bracket profit also. Is it clear to you or not? Then I will have to close down cash account. Whatever balance is there in the cash account, that is 45,000. This balance will be paid off to shareholders account and you will cross it to the debit side of the shareholders account. You will write 45,000. This is how the what we call accounting is done in the books of vendor company. Now, question may also ask you under such circumstances to pass what we call opening entries in the books of the acquirer company. So in the books of the acquirer company, as usual, because you are the acquirer company, you are taking over the business of the other entity. So whatever assets and liability which you have taken over, you will have to record them. In case if revised values are given, you will consider the revised value, otherwise simply book value. For example, you are taking over land and building, you are taking over plant and machinery, you are taking over goodwill, you are taking over stock, you are taking over debtors. So all the assets which you have taken over, you will write over here. Then you have taken over creditors only. Remember one thing, correct? You haven't taken over what we call debentures. Indirectly, so far, I have noted down the net assets. All the assets which I have taken over and all the liability indirectly, so far, I have recorded only the net assets. Now, I will write here to consideration payable. When we say that so far, we have taken into account net assets, and then we are writing here to consideration payable, indirectly it means we are trying to compare the amount of net assets which we are acquiring and the payment which we are delivering, correct? So on account of this, there may be some difference, and that difference may be goodwill or gain on bargain purchase. So in this case, when you will compare the items, debit item with the credit item, you will get a difference of 1,70,000 and you will write it as goodwill on business combination, that is 1,70,000. Is it clear to you or not? This is how you are going to pass this entry. Then consideration payable, you have to pay it off now. So you will write the entry consideration payable account debit 16,80,000. And you are disposing of consideration by making a payment of cash 1,80,000. Then because you are the issuing authority, you are the issuing company, you will have to reflect the nominal value and the premium amount. Equity share capital, 1 lakh shares have been issued by the acquirer company. Nominal value is 10. So you are going to write here 10 lakh. And likewise, security premium will have to be reflected separately. Coming over to the acquisition cost. Correct? Acquisition cost, because the expenses have been borne by the purchasing company. So purchasing company, first of all, is going to write acquisition cost account debit to bank account. Correct? And because this acquisition cost is nothing but a sort of expense, so these acquisition costs later on will be debited to the what we call profit and loss account. Instead of writing these two entries, you can directly write profit and loss account debit to bank account. So this is how what we call entries are done in the books of acquirer company. Is it clear to you or not? On the basis of this particular question, you should be in a position to manage question number 9.2. It is not at all tough. Then we move over to the next part. The next part is section 10. And again, actually this topic is related to vendor company, but this time it is given to you that consideration, calculation of consideration through net asset method. More often than not, as I told you in the question, you will find that amount of purchase consideration is not given. If amount of purchase consideration is not given, obviously you will have to find out the amount of purchase consideration. If amount of purchase consideration is not given, if purchase consideration is not given, I will have to find it out. And in order to find out, I can apply net assets method. I can apply net assets method. Under net assets method, how I am going to compute the amount of purchase consideration, this is the crux of this particular question. So first of all, let me have a look over the question, then I will explain it, and it is very easy, don't worry about that. Now in this particular question, Top Limited decided to sell the business to Bottom Limited. Indirectly, it means Bottom Limited is purchasing the business. Indirectly, it also means in this particular question, it is not given how many shares, 70, 80, 20% shares I am purchasing. So automatically, I will conclude that it is a case whereby the acquirer company is acquiring the what we call business of the other company. That means we are taking over all assets and liability. So Top Limited decided to sell the business to Bottom Limited on 31st of 12, 2026, and on which date the balance sheet of the companies are given. Balance sheet of Top Limited is given. Top Limited is the vendor company because it is selling out its business. Later on, you will have to prepare the account. As far as shareholders fund is concerned, share capital is given. I need not require to tell you where share capital will find place. Obviously, you are going to put it on the credit side of the shareholders account. And then we have reserves and surplus. Reserves will be written on the credit side of the shareholders account. In this question, there is one liability in the form of debentures. I will write debenture on the credit side of realization account. Another liability is in the form of creditors. I will take it to the credit side of realization account. So items of liability side are over, and now we can move over to the asset side. On the asset side, we have property, plant and equipment, you can say. So property, I need not require to tell you. You will have to write it on the debit side of the realization account. Similarly, plant and machinery will find place, correct? Again, goodwill is there. I told you goodwill will also be written on the debit side. In this question, we have stock 3,50,000, but we are not having debtors in this particular question. We have cash. Stock will be posted to the debit side of realization account. Regarding cash, we have to exercise a bit of caution, correct? We cannot simply conclude whether it will be posted or not, or where it will be posted. Should it be posted to the debit side of realization account, or simply we will have to write on the cash account, in the cash account. Further, it is given to you that Bottom Limited took over all assets and liabilities except cash. So now I come to the conclusion that cash balance hasn't been taken over, so cash will be posted to the cash account. It is also given that all the assets and liability except cash have been taken over at book value. First of all, question states that all the assets which you have taken over. In this particular question, as far as assets are concerned, property, plant and equipment, plant and machinery is there, goodwill is there, stock is there. These are the four assets. First of all, question says that you have taken over the assets at book value, but later on question says that, however, goodwill was taken over at rupees 1 lakh and property was taken at 1 lakh 80. Now we may say that property has been taken over at 1 lakh 80,000, correct? And goodwill has been taken over at 1 lakh rupees. So now everything is clear. Now we can say that property has been taken over at a valuation of 180. Plant and machinery, goodwill has been taken over at a value of what we call 1 lakh, and property has been taken over at a value of 1 lakh 80. Indirectly, it means the rest of the items have been taken over at book value, correct? Also, it is given in the question, Bottom Limited agreed to pay 90,000 in cash. Now, Bottom Limited is the company which is taking over the business. Obviously, the Bottom Limited is supposed to make the payment. It is given in the question that Bottom Limited is making a payment in cash worth rupees 90,000. In cash worth rupees 90,000. And further, it is elaborated in the question, and balance in the form of equity shares of 100 each. Now, question says that balance of the payment is in the form of equity shares. But problem is that how I am going to find out the balance of the payment, because we are not given the amount of purchase consideration. So that is why in this particular case, we may say that purchase consideration is not given. So first of all, I need to find out the amount of purchase consideration. And from there on, I will subtract 90,000 to know the balance amount, and the balance will be given to us in equity share. That's a different matter. Correct? Also, it is written expenses of liquidation amounted to 15,000. But this time it is not specified in this particular question which company is actually bearing the expense. If the question is silent, always presume that expenses are being borne by vendor company. So vendor company will have to pass the entry in this particular case. Is it clear to you or not? So first of all, let me explain you this question, although I have given you complete comprehensive solution, but still actually I would love you to pay attention, correct? Because handwritten notes are better than the typed one. So in this particular question, let me start this way. If suppose I am going to solve out this particular question, first of all, I need to find out the amount of purchase consideration as I told you. So this is going to be the first step, calculation of purchase consideration. Now, if purchase consideration is not given, I can compute the purchase consideration in this manner. I will simply take into account assets taken over at revised value, if any. Which are the assets which I have taken over? And in case if revised values are given, I will consider the revised value, otherwise book value. For instance, in this particular case, we are taking over property, plant and equipment at a valuation of 180. Goodwill has been taken over at a valuation of 1 lakh rupees. Actually, plant and machinery is taken over at the same value. Stock is taken over at the same value, but Goodwill has been taken over at 1 lakh. Is it clear to you? Whatever assets which you have taken over, simply note them down. Number one, and the values at which you are taking them over, note down those values. So directly or indirectly, I may say that I am taking over all the assets for a value of 8,40,000. Besides that, I am taking over the liabilities. In this case, there are two liabilities. One is 7.5%. Now see, actually, in this particular question, it is stated that we are taking over all assets except cash and liability. Indirectly, it means I am taking over both the liabilities. So 7.5% debentures and creditor, 1 lakh, 1 lakh 50, 2 lakh 50. The difference of these two items is known as purchase consideration. So it is as simple as that. When I will compute the purchase consideration in this fashion, it is also known as net assets method. That means I have computed purchase consideration by applying net assets method. Under net assets method, all you have to do is simply take into account the assets which you have taken over and values at which you have taken over, correct? And then you will have to subtract the liabilities which you have taken over, take the difference. This is your purchase consideration. Once you know the amount of purchase consideration, you can easily configure the what we call mode of payment. For example, in this case, it is given out of total purchase consideration of 5,90,000. 90,000 will be delivered to you in cash, and also it was given balance in shares. Now balance in shares means rupees 5 lakh. Also it is given in the question that purchasing company will issue shares and one share is of rupees 100 each. It means 5 lakh divided by 100, purchasing company will issue 5,000 shares of 100 each. Now coming over to the ledger balances or ledger accounts. In the liability side, because in the question liability side is given first, the first item was share capital. Now I need not require to tell you. Share capital will be posted to the credit side of share capital account. Another item was reserve. Reserve will also be written over here in this particular question. Then there were two liabilities, debentures and creditors. You will post them to the credit side of realization account. Your liability side is closed. You will move over to the asset side. In the asset side, there is property. Here, a confusion may arise because this time the value of property is also given 1,80,000. So sometime we may get confused. Should we write here 150 or 180? See here, you are closing down your asset side. Closing down your asset side means whatever values are given in the balance sheet, only those values will come here in the realization account. Is it clear to you? That means whatever value is written in the balance sheet, that is 150. Similarly, plant and machinery, similarly Goodwill at 60,000, and stock will be written here 350. In this question, there was cash balance, but cash balance was not taken over. So I will write here to balance brought down 70,000. Is it clear to you or not? After this, it is given in the question There is no valueless asset, let me tell you, in this particular question. If there would have been valueless asset like preliminary expense, underwriting commission, discount, I would have had posted them to the debit side of shareholders account. After closing down asset side and liability side, now the next thing is that, first of all, I will have to write on the credit side of realization account by acquirer company, that is purchase consideration. Purchase consideration is 590. I will cross it to the debit side of acquirer company account or purchasing company account to realization 590. Now I will receive the payment. I have received 90,000 of cash. We have received what we call shares also. Cash will be posted to the debit side of the cash account. We will write here to acquirer company or purchasing company, and whatever shares which we have received, shares in purchasing company, will be written on the debit side of shareholders account. Is it clear to you? Now I will think of only one. Now I will have to actually think only one thing, that out of these two liabilities, is there any liability which hasn't been taken over? Now in this particular question, both the liabilities have been taken over, so I need not require to pay off any liability. However, in this particular question, there are expenses, and we have to presume that expenses have been borne by vendor company, because it is not specified in the question which company is bearing the expense. So that is the reason I will have to write here to cash, and I will write here 15,000 for expenses, and I will cross it to the credit side of cash account. Now we are in a position to tally out our what we call realization account. You will get a figure of 55,000. And this figure will be posted to shareholder, and in the shareholder you will write by realization account. Then you will balance your cash account. This will be your balancing figure, 1,45,000, and you will cross it to the shareholder account. Your account will get closed. This is how you are going to actually prepare the account in the books of vendor company. Coming over to acquirer company. In the books of acquirer company, if you want to write the entry, you can directly have a look over here in the books of acquirer company. I told you in the books of acquirer company, generally we take into account all the assets which we have taken over. I just told you which are the assets which we have taken over. We have taken over property, plant and equipment, correct? We have taken over what we call property, we have taken over what we call plant and machinery, we have taken over goodwill, stock, etc. 4 items we took. At what value we have taken over? I also told you when I computed the purchase consideration. So instead of writing, because you can shorten it down a wee bit, see here I have directly written identifiable asset taken over. Correct? You can directly write here 8,40,000, or you can write them separately. For example, here when I have done the amount of purchase consideration, see here, goodwill we are taking over at 1 lakh, we are taking over property at 1,80,000, we are taking over plant, we are taking over stocks. You can write them separately, or you can directly write assets account debit 8,40,000. Why to waste time? So 8,40,000. Similarly, 2 liabilities we have taken over. I have written directly 2,50,000. You can write separately. And then I will write 2 consideration. This time there is no difference, so that is why no goodwill or gain on bargain purchase. Now then you are going to make the payment for the consideration. 5,90,000 worth of consideration has been discharged by you through payment of cash and through what we call issuance of equity share capital. This is how you are going to actually pass the entry in this particular question. Is it clear to you or not? After finishing off, then we'll move over to this part, and let me tell you, this part is very vital from the examination point of view, because we have had lots of questions from this particular section, intrinsic value method of purchase consideration. Intrinsic value method of purchase consideration is nothing but it is just an extension of what we call net assets method, correct? So how we are going to compute the amount of purchase consideration under this particular method, and what will be the accounting intricacies and what will be the accounting pattern, we'll talk about it, but give us a time of 1 minute. After 1 minute break, and then we will. So now we are going to start intrinsic value method of purchase consideration. Intrinsic value of purchase consideration, it's a very practical concept in practical life. Whenever a company acquires the business of the other company, and then how it is decided at how much of purchase consideration should we issue to the other company, correct? Or for instance, suppose if I am the purchasing company and I am taking over the business of other companies, say other company is F1 Limited, and total number of shares issued by other company is 10,000. If suppose I am taking over the business of this particular company indirectly, it means actually we will have to issue the shares to the shareholders of this particular company. But how many shares should I issue? Should I issue 10,000 shares or less than that or more than that? Correct? It depends upon the intrinsic value of shares. So how many shares will have to be issued by the purchasing unit to the vendor unit, especially to the shareholders of the vendor unit? Correct? In practical life, that is actually done through calculation of intrinsic value of share of each company, and on that basis it will be decided that how many shares will have to be issued and actually how much of consideration will have to be delivered. Correct? So in order to understand this, just have a look over this particular question first of all. Correct? Let me actually rub it out. So here you can see actually there are the balance sheet of two companies. The following are the balance sheet of K Limited and J Limited on 30th of what we call September 2026, and you can see this is K Limited. We will see later on that K Limited is taking over J Limited, correct? And this is the first question wherein the balance sheet of both the companies are given to us. And especially if the question will be of intrinsic value method, the balance sheet of both the companies will be given to you. K Limited is the purchasing unit, the acquirer entity, and J Limited is the vendor entity or acquiring entity. Now, equity share capital of both the companies is given to you, and one share is of rupees 10 each, 1,80,000. Besides that, general reserve is there, profit and loss account is there. And then as far as debentures are concerned, debentures only in the column of K Limited are there. In the column of J Limited, debenture liability is not there. However, creditors 2 lakh and 1 lakh is given. And besides that, bills payable 50 and 40,000 is also given to you. Then we are being given fixed assets 7 lakh, 3 lakh, and investment only in the column of K Limited, that is purchasing company, but there are no investment in the column of what we call J Limited. Then current assets 6 lakh and 2 lakh. Further, it is given to you, further in this particular question, it is given to you that the board of directors of K Limited approved to take over J Limited on the aforementioned date. And further it is given, find out the ratio of exchange of shares on the basis of the book value. Ratio of exchange. Actually, the demand of the question is only to find out ratio of exchange. However, ratio of exchange is to be found out on the basis of book value, on the basis of the book value. So whenever the question would say that you have to compute ratio of exchange, correct? Ratio of exchange, or whenever question would state that purchase consideration will be delivered on the basis of ratio of exchange, indirectly it means this question demands calculation of intrinsic value of shares. Is it clear to you? So even though the demand of this particular question is to find out ratio of exchange, but I will give you solution in a full-fledged manner. And in order to understand that, first of all, we need to comprehend how the intrinsic value is arrived at. So in order to find out how the intrinsic value of the company is found out, your first step obviously under such a scenario should be to compute intrinsic value of the share. Board of directors of K Limited have decided to take over J Limited. So K Limited, I have already told you, is the purchasing unit or the acquirer entity, and J Limited is the vendor entity. In order to compute the what we call intrinsic value of share, we will note down all the assets, and in case if there are revised value, I will consider the revised value also, although revised values are not given in this particular question. So we will simply write property, plant and equipment or fixed asset of both the companies 7 lakh and 3 lakh. I have already told you investment is there, but only in the column of K Limited. So in the J Limited, I have put up a dash. Then current asset 6 lakh and 2 lakh. Then I will total the asset. Total asset is equal to 18 lakh and 5 lakh. Now from here on, I am going to subtract the liabilities. There are 3 liability, but 3 liability with respect to K Limited and only 2 liability with respect to what we call J Limited. Now if you are going to have a look over the K Limited column, you will find that there are liability in the form of what we call debentures, in the form of creditors and bills payable, whereas this entity is having only 2 liability. So after subtracting the total of the liability from the total of the assets, we get net assets. Net assets. So net assets you have arrived at. And whenever we say net asset also means assets available for shareholders. Because after subtracting liability from the asset side, whatever assets are there, those assets belong to the shareholders. So net asset also means net assets for shareholders. So net asset 12 lakh with respect to J Limited and 3,60,000 with respect to K Limited. Correct? Once we have determined the amount of the net assets, now I am going to subtract preference share capital if there is any. If there would have been preference share capital, I would have had subtracted the same. But in this question, preference share capital is not there. But anyway, after subtracting the preference share capital, we will get assets available for equity shareholders. So assets available for equity shareholder, as you can see, is equal to 12 lakh and 3,60,000. In order to compute the intrinsic value of the share, first of all, you need to compute the net assets. And in case if there is preference share capital, you have to subtract the same. And then finally, you need to find out assets available for equity shares. Once you have determined the amount of assets available for equity share, the next step is you simply divide it by the total number of shares. Total number of shares. So if I am going to divide net assets by number of equity share, I will get intrinsic value of the share. Intrinsic value of the share is 30 and intrinsic value of share of this company is 20. Actually, what does intrinsic value of the shares suggest? Intrinsic value of the shares suggests that in case if this company undergoes a liquidation, then shareholders, how safe they are. For example, in this particular case, we can say that position of the company is quite strong because the face value of the share is 10 and intrinsic value is 30. It means in case if this particular company undergoes into liquidation, then company has got what we call 30 worth of asset to what we call meet the liability of face value of 10. So position is very strong. Similarly, the position of even J Limited is very strong because if the intrinsic value would exceed the face value, indirectly it means that investors are on the safer side. So generally, such people who make very heavy investment in a company, they prefer to compute intrinsic value of share to know regarding the what we call safety of their investment. And it is known as intrinsic value. Intrinsic means inside value because generally intrinsic value of share is not publicized. So that is why it is also known as intrinsic value of the share. Anyway, you have determined the intrinsic value of the share. This is your first step. Remember one thing. Your J Limited is the vendor entity and you have already computed the net assets of vendor company. Net assets of vendor company you have computed here, that is equal to 3,60,000. Correct? Now, once you have determined the intrinsic value of the share, your next step will be to know the amount of consideration. And what is consideration? That is net assets. And we have already computed the net asset that is equal to 3,60,000. So net assets, that is nothing but your consideration, 3,60,000. Now the next question is, next point is number of shares to be issued by K Limited. K Limited is purchasing unit to discharge the amount of purchase consideration. How many shares purchasing company will have to issue to discharge the purchase consideration? For that, you need to note down the amount of consideration and divide it by intrinsic value of the share. As you can see, amount of consideration is 3,60,000. Now you divide it by intrinsic value of share of purchasing company. So you can see here that purchasing company now will find out that it will have to issue 12,000 shares of 10 each, but at the rate of 30. So this is the benefit which is accruing to the purchasing company when it is making the payment on the basis of intrinsic value of share. Because otherwise, in order to discharge 3,60,000 worth of payment, correct, purchasing company would have issued what we call 36,000 shares. If I would have had divided it by the face value of the share, in that case, I would have had to issue what we call 36,000 shares. But because we are making the payment on the basis of intrinsic value of the share, so we need to issue only what we call 12,000 shares, of course, of 10 each, but at a premium of 30. That means we are making the payment by issuing the shares at a premium of rupees 20. Number one. Number two. The next point is ratio of exchange. How to determine the ratio of exchange? First you write K Limited and then J Limited. And we know that total number of shares of J Limited is 18,000. As you can look into the balance sheet, you can easily find that they have share capital of 1,80,000 divided by 10. So total number of shares of J Limited is 18,000. And now we have just found out that how many shares J Limited will have to issue. J Limited is issuing only 12,000 shares. We are taking over the business of J Limited. They have 18,000 shares, but we are not issuing 18,000 shares. Indirectly, it means we are issuing only 12,000 shares to make the payment to the shareholders of J Limited. So that means the ratio of exchange is 2:3. What does it mean? It means purchasing company will issue only 2 shares for 3 shares of vendor company. You are the purchasing entity. If you are the shareholders, let us say if you are the shareholder of vendor company, correct, we will issue you only 2 shares. Why? The reason is that because the value of our 2 share, because intrinsic value of our company is 30, so our 2 share will command a value of 60 and intrinsic value of your share is only 20. So that is the reason actually for your 3 share we will have to issue only 2 shares. Is it clear to you or not? So that is the reason why we are giving only 12,000 shares against 18,000 shares. Total purchase consideration no doubt will remain 3,60,000. Is it clear to you or not? Generally, when question will be of intrinsic value of share, question will never ever ask you to what we call prepare account in the books of acquiring company. Correct? Because it is very easy. See here. I will, as usual, first of all, I will prepare acquirer company account, then I will prepare realization account, and then I am going to prepare shareholders account. I haven't prepared cash account. You might be wondering why. Because I feel that in this particular case, I may not require cash account. The reason being is that because we are receiving the entire amount in cash, in shares only. Under intrinsic value of share, we will receive the entire amount of purchase consideration in shares. So in case if the need would arise, I will still prepare cash account, but if need will not be there, I need not require. Now, in this question, as far as vendor company is concerned, on the asset side, we have 2 items only, property, plant and equipment. There is no investment with respect to vendor company and current asset. I will post all the asset to the debit side. As far as asset side is concerned, only 2 items are there. On the liability side, there was share capital of 1,80,000. There was general reserve of 1,00,000, and there was profit or loss account 80,000. So all these 3 items will find place over here, and then all the liability, 2 liabilities are there, creditors and bills payable. So this is how the liability side and asset side will get close. Now I will write here by acquirer company. This is your purchase consideration 3,60,000, correct? Then I will cross it to the debit side of the acquirer company account. I will write here to realization 360. Then we will receive the payment. Entire payment will be received by us by way of shares, 12,000 share at the rate of 30, 3,60,000. So entire payment will be posted to the debit side of shareholders account because we are not receiving any cash. Shares in acquirer company account debit, correct? Now, after having posted the purchase consideration, I have so often said earlier that now we need to know whether out of these liability, is there any liability which hasn't been taken over? In this particular question, all the liabilities have been taken over because we are taking over the business and nothing else is mentioned in the question. So it means all the assets and liabilities have been taken over. So I need not require to pay off any liability. Also, there are no what we call expenses given in this particular question. So I will have to tally it out. But when I'm going to tally it out, I find that both the sides are getting tallied automatically. But that doesn't mean that in case of what we call intrinsic value of share in the books of vendor company, there will be no loss or profit. No, it is just a coincidence that in this case, both these sides are tallying of its own. After that, I will have to what we call tally cash account, but cash account is not needed in this question. Then I will tally shareholder account. It is getting tallied of its own. That is the reason actually, whenever you are going to have intrinsic value sort of question will simply ask you to find out intrinsic value of share and pass, at the most they may ask you to pass entries in the books of acquirer company. Now in the books of acquirer company, as usual, we have taken over 2 assets, property, plant and equipment and current assets, correct? So I will write these 2 assets. We have taken over 2 liability, creditors and bills payable. And then I will write here 2 consideration payable account. Again, there is no difference. So no goodwill or gain on bargain purchase. Both these debit side and credit side is equal. And then I will make the payment for consideration payable. Consideration payable account debit to share capital. Here I will write 12,000 share into 10, that is 1,20,000, and then 12 security premium, 12,000 shares at the rate of 20, that is equal to 2,40,000. Is it clear to you or not? So this way around, you should be now in a position to get hold of what we call this particular concept. Now we move over to this particular question, that is 11.2. Now just pay attention. Now in this particular question, it is stated that F1 Limited agreed to take over F2 Limited on 1/10/2026. Further, it is also mentioned that summarized balance sheet of F1 and F2 Limited on 31st of 3/2026 is also given to you. F1 Limited is taking over F2 Limited on 1/10/2026, correct? 1/10, 1st of October. And here it is given the balance sheet is on 31st of 3/2026. You must have noted this, that balance sheet is given to us on 31st of 3/2026, correct? And business is being taken over on 1/10/2026. That means almost 6 months later after the date of the balance sheet, 1st of October. This is the date on which business was taken over, and this is the date of the balance sheet. That means in this particular question, the date of taking over the business is falling later on, 6 months later on after the date of the balance sheet. Now in this particular question, as far as F1 Limited is concerned, one share is of 10 each, total share capital is 20 lakh, then F2 15 lakh. We are also given reserves and surplus. Under it we have reserves 3,90,000 and 3,40,000, then profit and loss account 3,30,000 and 1,60,000. Then we are also being given creditors 85,000 and 75,000. Coming over to the what we call asset side, we have property, plant and equipment 15 lakh and 12,60,000. Then we have current asset in the form of stock. Then we have debtors, and then we have bank, and besides that we are also having preliminary expenses, correct? Now below it is given to you that additional information is available. Additional information for the 6 months period from 1st of April 2026. From 1st April 2026, see here, this is the end date of 31st/3/2026. That means next year will start from 1/4/2026. So from 1/4/2026 till the date of taking over the business, indirectly question is talking about this. For the 6 months period from 1st April 2026, it is given that F1 Limited, what is happening? F1 Limited and F2 Limited made a profit of 5,40,000 and 3,60,000 respectively after writing off depreciation at the rate of 10% on their fixed assets. After writing off, see, this is the what we call value of the fixed asset of both the companies, correct? And question says that in between 1/4/2026, that means the start of the next year, and till the date of the taking over of business, during this particular period, it is stated that both these companies have made profits to the extent of 540 and 360, but after charging 6 months depreciation, correct? This period is of 6 months. After charging 6 months depreciation on their fixed asset, 15,50,000 fixed asset, 12,60,000 worth of fixed asset, after charging a depreciation, they have made a profit of what we call 540 and 360 respectively. Also, it is given that both the companies paid on 1st of August 2026 equity dividend of 10%. Also here given in the question, dividend tax at 15% was paid by each of them on such payment. What does it mean? And what will be the impact of this? Don't worry about that. Looks tough. And it's a tough question, no doubt about that, but I will explain each and everything. Further, it is given that goodwill of F2 Limited was valued at 1,68,900 on the date of taken over. If you will look into the balance sheet, you find that as far as F2 Limited is concerned, correct, on the asset side, there is no goodwill. But because we are taking over the business of the other company, sometime it is a policy to value the goodwill. So we might have valued the goodwill of F2 Limited at 1,68,900. Is it clear to you? Also, it is given that stock of F2 Limited was subject to an abnormal item of 8,500 to be written off. and would be appreciated by 20% for the purpose of the taking over. What does it mean? You will find that stock of F2 Limited is 3,81,500. First of all, it is given to you. Stock is 3,81,500. Now question states that this stock is having an abnormal item worth rupees 8,500. So we will subtract 8,500. Now whatever balance will be there, now question says that would be appreciated by 20%. So whatever balance will be there, you simply add 20% of that figure to it. So at this value, stock will be considered as taken over. Is it clear to you or not? Also, it is given to you F1 Limited will issue to F2 Limited shareholders fully paid equity shares of 10 each on the basis of comparative intrinsic value of the share on the date of takeover. So again, this question is of intrinsic value of the shares, and here the demand of the question is that you have to calculate the consideration transfer to F1 Limited, and another question is calculate the number of shares to be issued by F1 Limited to F2 Limited, and another question is there, ascertain the closing balance which will appear in the balance sheet of F1 Limited. So question is asking that after taking over the business of F2 Limited, what will be the cash balance? Indirectly, this is the question. So in order to make you understand this question, correct, I have given you every question in a solved manner, but at the same time, I would love you to pay attention here. In this particular question, the very first line is quite important and vital to understand it, correct? This is your step number 1. Under step number 1, don't care about the heading at this particular moment. Simply look here, there are two columns F1 and F2, and over there I have written 5,40,000 and 3,60,000 because it is given to us that when the current year commenced on 1/4/2026 until the date of the takeover on 1/10/2026, both these companies made profit of 540, 360 respectively. But this profit was after depreciation, Now suppose if I compute the amount of depreciation for the 6 months, I will take into account the what we call F1's fixed asset or property, plant and equipment 15,50,000. Rate of depreciation is given to us 10%, and 6 months depreciation will come to 77,500. And likewise, your property, plant and equipment of F2 Limited is 12,60,000. 10% depreciation for 6 months will come to 63. Now, because it is this net profit is after depreciation, I'm adding back the depreciation because depreciation is a non-cash item. By adding back the depreciation to the net profit, what does it mean? Because increase in profit indirectly means increase in cash. Increase in profit in accounts means increase in cash. I really want to know what was my cash profit. So in order to know the increase in profit means I want to know what was my cash profit. That is why I'm adding back this non-cash item. So now I can say that my profit during the 6 months must be equal to 6,17,500 and 4,23,000 for this particular company F2 Limited. Once I have determined this is your basically cash profit. Once you have determined the cash profit, now you have to simply note down the cash balance which is given in the balance sheet, 2,40,000. As you can see, the balances are given in the balance sheet, 2,40,000 and 1,80,000. Is it clear to you or not? I will show you in the balance sheet. Just have a look over here. The bank balance was given to us here, correct? So once the bank balance which you have noted down, the next step is bank balance is 340. Actually, I have written 240. Sorry. Bank balance is 340 and 1,80,000. Anyway, so I have noted down the opening balances. Now you add this cash profit 6,17,500 and 4,23,000. So it will tell you what exactly your cash is now. Your cash after this increase in profit is 9,57,500 and 6,03,000. Is it clear to you? Further, it is given that both the companies have paid dividend in these 6 months. In the month of August, both the companies have paid dividend. And it is given in the question that dividend has been paid at the rate of 10%. Now, we take the case of F1. As you know better than I, that dividend is always computed on the amount of the share capital, and the amount of share capital of F1 Limited is 20 lakh. So 10% is the rate of dividend. So 2 lakh will be the amount of dividend. So when we will make the payment for dividend, obviously my cash will decrease, correct? Besides that, in this question, it is also given that along with dividend, we have paid dividend tax. That's a different matter nowadays. Dividend tax is not there, but because it is given in the question, we have to consider it. Dividend tax is computed on the amount of dividend. Your amount of dividend is 2 lakh and dividend tax rate is 15%. So 2 lakh into 15%, 30,000 dividend tax you have paid. So total cash will decrease by 230. And similarly, you will compute the dividend with respect to F2 Limited because both the companies have paid the dividend. Total share capital of F2 Limited is 15 lakh. You compute 10%, total amount of dividend will be equal to 1,50,000. Then you will have to compute the dividend tax. Amount of dividend is 150. So 15% of 1,50,000 will be 22,500. Now by subtracting the payment, now you come to know that on the date, that means on 1st of October, this 7,22,500 is the balance in the books of F2 Limited on the date of what we call acquisition of the business, and similarly 4,30,500 is the balance. And if you are going to add these two, you can also get the total amount of bank balance, because this is one of the demand, especially question number 3. Correct? After taking over the business, now we can say total cash balance is 7,22,500 and 4,30,500. This point was important for us to compute the intrinsic value of the share, because intrinsic value of the share will have to be computed on the day on which we are taking over the business. Now the cash balance, because I will have to write the cash balance 7,22,500 and 4,30,500, because this is the position of the cash on the date of takeover. Likewise, when you are going to write here property, plant and equipment, whatever balance is given in the balance sheet, from there on you subtract the amount of depreciation. Is it clear to you? So your net value will be 14,72,500 and 11,97,000. That is property, plant and equipment less depreciation. Then you will write what we call debtors, correct? Same value, but stock with respect to F2 Limited, no problem, 5,35,500. But I told you here with respect to what we call F2 Limited, first of all, whatever figure is given of stock, you subtract 8,500. Whatever balance you get, you add 20% to it, you will get 4,47,600. Correct? And another important point, in this question it was given that when you took over the business of F2 Limited, you valued the goodwill of F2 Limited as 1,68,600. So you will consider that also. So total assets of F1 will be equal to 30,85,000. Total assets of F2 Limited will be equal to 24,75,000. From there on, you will have to subtract only one liability is there, creditors. So ultimately, you will find that net asset is equal to, as you can see, 30 lakh and 24 lakh. From the net assets, as I told you earlier, you will have to subtract preference share capital in case if there will be. So in this case, no preference share capital is given. So you get assets available for equity shareholders. Once you have determined the assets available for equity shareholder, you have to simply now divide it by number of equity shares. So now you ultimately get the intrinsic value of the share. Correct? This was your first question. What is the amount? What is the intrinsic value of the share? Second question, amount of consideration. So amount of consideration, I have already told you, because F2 Limited is the vendor company. So net assets of vendor company is equal to 24 lakh. So amount of consideration is 24 lakh. Second question was, how many shares will have to be discharged? How many shares will have to be issued to discharge the purchase consideration? So whatever amount of purchase consideration is there, you divide it by the intrinsic value of share of purchasing company, which happens to be 15. Correct? So now you get 1,60,000. So 1,60,000 shares you will have to issue. Third question was, what is the balance now in the bank after taking over the business? You simply combine both these two balance to get the answer to that. So this is how you will have to do this particular question. It's a pretty important one. Remember one thing. After this particular case, now we move over to the next part, and this is known as net payment method. This is known as net payment method of purchase consideration. What exactly net payment method of purchase consideration is there? We'll take 1 minute of break. Now, in this particular session, we are going to pick up what we call section 12, and that deals with net payment method of purchase consideration. Obviously, when purchase consideration is not given, you have already seen actually we can compute the purchase consideration through net assets method. Is it clear to you? Under net assets method, we simply take what we call the assets taken over, of course at revised value in case if there is any, and then we are going to subtract the what we call values of liabilities taken over, and we can easily get the amount of purchase consideration, isn't it? Then there was intrinsic value method. Under intrinsic value of method, it is specified in the question itself that we have to adopt intrinsic value of shares method, and it is not a very difficult task. It's a mere extension of what we call net assets method. And there is yet another method that is known as net payment method. Under net payment method, how we are going to compute the amount of purchase consideration under net payment method, correct? Under this method, you will be given that purchasing company, it will be given that purchasing company is giving what we call payment to the various parties of the vendor company. Various parties of the vendor company means, let us say there are equity shareholders, there are preference shareholders, there are debenture holders, and let us say there are other creditors. So more often than not, you will be given that purchasing company is giving some particular payment to equity shares, then to preference shareholders, then to debenture holders, then to creditors, etc. So whatever payment is being delivered by the purchasing company to the various parties, that will constitute the amount of purchase consideration. That will constitute the amount of purchase consideration under net payment method. But besides that, there are some what we call tricky rules in it, and we will discuss all those rules in detail through this particular question. Let's have a look over this particular question 12.1, and here you will see that the following is the balance sheet of Early Limited as on 31st of 3, 2026, wherein it's a small balance sheet. We have a property, plant and equipment, 7 lakh, current asset and cash, and then we have several parties. For example, equity share capital, there are 5,000 shares of rupees 100 each, number 1. And besides that, we have 10%, 4,000 preference shares of 100 each, 4 lakh. And then we have debentures also to the extent of rupees 2 lakh. Besides, there are creditors. Remember one thing, your creditors, staff provident fund, and debentures, creditors and staff provident fund. These 3 items are basically of liability. And then we have reserve fund. Of course, reserve fund is free reserve. Correct? We have in this case share capital. And this is the first question wherein we are getting what we call preference share capital in the books of the vendor company. Hitherto, not a single question was there wherein preference share capital of vendor company was there. Now, in this particular question, we have what we call preference share capital of vendor company. That is to the extent of 4 lakh, 4,000 shares. And then 3 liabilities, debentures, creditors, and staff provident fund, and 1 free reserve is also given to you. This is the balance sheet of Early Limited. And ironically, in this case, it is given that Late Limited agrees to take over the assets excluding cash. Now, it is clearly given in this particular question that Late Limited is taking over only assets. And even in case of assets, we are taking over only what we call property, plant and equipment and current asset. And you must have noticed actually we are not taking over in this particular case cash. And all liabilities. We are also taking over all liabilities except debentures of Early Limited. Except debentures of Early Limited. I've already told you in this particular question there are 3 liabilities. Debentures, creditors and staff provident fund. Out of these 3 liabilities, debentures are not being taken over. Is it clear to you? And rest of the 2 liabilities have been taken over. Now, it is also given that as per the terms of the agreement, acquirer company shall discharge the amount of purchase consideration through. Now, in this particular question, it is given that as per the agreement between the acquirer company and the acquiring company, the acquirer company is going to discharge the amount of purchase consideration in this manner. It will issue 15 equity shares of 10 each at par. 15 equity shares of rupees 10 each at par for each equity shareholders of acquiring company. In this case, it is given number 1 that purchasing company is going to issue 15 equity shares of rupees 10 each at par. Of rupees 10 each at par means share of 10 will be issued at the rate of 10, then you have to pay attention for each equity shareholders of the acquiring company. At least after having gone through this particular sentence, you should be in a position to infer, you should be in a position to conclude that this payment is being given to the equity shareholders of the what we call vendor company. Is it clear to you? At least you can make it out this way around. Is it clear to you or not? Now, just have a look over here. If this point is not yet clear to you, kindly pay attention towards here. Later on, when I will tell you that we have to compute the purchase consideration, in order to compute the amount of purchase consideration, what I will have to do. In case of net payment method, first of all, you have to note down very carefully which is the party of the vendor company which is receiving the payment, number one, correct? For example, after having gone through this particular sentence, we can infer very easily that purchasing company is making the payment to the equity shareholders of the vendor company. Correct? Once you have determined that which party is receiving the payment, now simply note down the number of shares of the equity shareholders. Now total number of shares, because it is given in the question that equity share capital is 5 lakh and one share is of rupees 100 each. So we can safely say that total number of share of vendor company is equal to 5,000 and one share is of 100 each. After having noticed that, now you need to go through the sentence once again very carefully. Now it is very clearly given that purchasing company is going to issue equity shares of 10 each at par for each equity shareholders of vendor company. For each equity shareholders of vendor company, this is the line which would demand your attention. Now see here, total number of shares of vendor company is equal to 5,000, correct? Total number of shares of vendor company is equal to 5,000. For each shareholder, purchasing company is giving 15 shares. For each shareholder, purchasing company is giving 15 shares. Is it clear to you? For each share of vendor company, purchasing company is giving 15 shares. It is clearly given. Number one, if I am going to compute it, it will be equal to 75,000. Each shareholder of vendor company will receive 15 shares. So that means purchasing company will offer 75,000 shares. And 75,000 shares will be issued at the rate of 10, because it is clearly given that each share of 10 will be issued at par. So that means after having noted down that which party is receiving the payment, now you will have to find out the total amount of payment which is being received by that particular party. So that particular party will receive a payment of 7,50,000. And this payment, that means which party is receiving the payment, question number one. Question number two, how much is the amount of payment? And question number three, in what form? Because it is clearly given in the question that purchasing company will issue equity share. So you have to trace out the answers to these three questions. Which party is receiving the payment? What is the worth of the payment? And in what form the payment is being delivered? Is it clear to you or not? Okay, if this is the point, then we will move over to the next part of the question. Now under point number 2, it is given, as per the agreement, purchasing company will issue 30 equity shares of 10 each. 30 equity shares of 10 each, but this time it is written at 20% premium. One share of 10, this time is not being issued at par. Here it is written that purchasing company is going to issue actually 30 equity shares of 10 each at 20% premium, means 20% of 10 is equal to 2. So that means equity shares will be issued at the rate of 12. In the last sentence, it was written for each equity shareholder. This time it is written for every 4 preference shareholders of acquiring company. At least after having gone through this particular sentence, you should be in a position to conclude which party of vendor company is receiving the payment. Obviously, in this case, preference shareholder of the vendor company is receiving the payment. Point number 1. Once again, go through the sentence. Try to find out actually the ratio. The ratio, for instance, in the last case, it was given that each equity shareholder of vendor company will receive 15 shares. It was given in the last sentence. Now this time it is given that purchasing company is going to offer 30 equity shares for every 4 preference shareholder. For every 4 preference shareholder, 30 equity shares will be issued. So how we are going to compute it, just have a look over here, then you will be able to understand better. In this case, first of all, note down what we call preference shareholders of vendor company. Total number of shares of vendor company is equal to 4,000, correct? Because total share capital, preference share capital is 4 lakh. Point number one. Point number two, now you have to take into account the ratio. 4,000 preference shareholders of vendor company are there, no doubt about that. For every 4 share divided by 4, they are going to receive 30 shares this time. Every 4 preference shareholder will receive 30 equity share. Now, if I will solve it, it means indirectly that purchasing company will offer 30,000 equity shares to the preference shareholder because the payment is being given by way of equity share. Preference shareholders of vendor company are receiving the payment in the form of equity shares. And purchasing company will issue 30,000 share. And because this time it is given that purchasing company is going to issue the share at a premium of what we call 20%, 10 plus 2, that is 12. So 30,000 into 12 will make it 3,60,000. So this is the amount of payment which is going towards the what we call preference shareholders. Is it clear to you or not? And again, the form of payment is equity shareholders. Is it clear to you? The form of payment is equity shareholders. This is one point. Just a moment ago when I started this particular session, I told you actually that under net payment method, we have to simply take into account which party is receiving the payment, what is the amount of payment and what is the form of the payment. But here, you have to exercise a bit of caution because the complete rule is that under net payment method, word only is of paramount importance. In all these notes I have written in your solution, don't worry about that. Only payment going towards equity shareholders and preference shareholder will constitute the amount of purchase consideration. So now we have already seen how much payment is going towards equity shareholders and how much payment is going towards preference shareholders. So their total will become 11,10,000. So this will be considered as the amount of purchase consideration. Indirectly, it means if under net payment, if any payment will move to a party which is not a shareholder, so any payment received by parties other than the shareholder will not be taken into consideration for the computation of the purchase consideration, but still you are going to compute how much payment those parties are receiving due to some or other reason. For instance, in this particular question, further, it is also given under point number 3 here you can see that issue of such an amount of 15% debenture at par. Issue of such an amount of debenture, and we are not being given what is the amount of debenture. It is given that issue of such an amount of debenture at par so that 10% debentures of acquiring company could be discharged at 20% premium. We have already seen that in the balance sheet there is a liability by the name of debenture, 10% debenture of worth rupees 2 lakh. Now here, as per the agreement, it is decided that purchasing company will issue such an amount of 15% debenture. 15% debenture we will offer. But what exactly will be the amount? It is not given. It is given that purchasing company will issue 15% debenture to the debenture holders of vendor company. Correct? Number 1. In such a manner so that 10% debentures of vendor company or acquiring company could be discharged at 20% premium. What does it mean? For instance, in order to comprehend this particular point, just pay attention over here. Now you can see here I have written below 10% debenture. This is also a party of the vendor company, but it is a party other than the shareholder. So that is why it will not be taken into account for computing the amount of purchase consideration. Under net payment method, only payment going towards equity shareholders and preference shareholder will constitute the amount of purchase consideration. I have told you that, correct? But still we are going to find out what exactly is the amount of payment which is being received by the debenture holder. Now you can see that amount of debenture given in the balance sheet of vendor company, 10% debenture is 2 lakh. Now vendor company might be interested in paying them off at 20% premium. So plus 20% premium becomes 2,40,000. So as per the agreement, debentures need to be paid off at 2,40,000. And it is given in the question that purchasing company will issue such an amount of 15% debentures so that debenture holders of vendor company could be paid off at 2,40,000. Indirectly, it means purchasing company will offer 15% debenture worth rupees 2,40,000 so that debentures 10% debentures of vendor company could be paid off at 20% premium. Is it clear to you? So purchasing company obviously will issue 2,40,000 worth of debentures so that debentures of vendor company could be paid off or redeemed at what we call 20% premium. And if you want to know the number of debenture which will be issued by purchasing company, 2,40,000 is the amount. Correct, 2,40,000 worth of debenture purchasing company will have to offer divided by 100. So you can easily find that purchasing company will issue 2,400 debentures of 100 each to pay off what we call 10% debentures. Is it clear to you or not? I just told you a moment ago that under net payment method, it is of paramount importance to understand that only payment received by shareholders will be taken into account for the computation of the purchase consideration, number one. Then what about the payment which is being received by the other party? For example, in this particular question, debentures are receiving some payment. So besides shareholders, if any other party will receive the payment, for instance, in this particular case, debenture holders are receiving the payment, obviously you will not take them into account for the purpose of purchase consideration. Such parties other than shareholders, correct, receiving payment from the purchasing company will not be taken into account for purchase consideration, number one. Now point number two, what will be the then treatment? Now it will be presumed, actually before I explain it, let me also clarify one important point. Actually in practical life, what happens? In practical life, when purchasing company decides to make the payment to the vendor company on the basis of what we call net assets method. So first of all, purchasing company will compute the total amount of purchase consideration, which in this case is 11,10,000. Now this amount will be delivered to the vendor company. In practical life, purchasing company, after having computed the amount which it will deliver to vendor company, correct, now it will deliver to the vendor company. Okay, you keep this amount and now pay off your equity shareholder. Now it is the duty of vendor company to pay off their equity shareholders and preference shareholders after receiving the payment. No doubt about that. But if a party other than debenture holders shareholders like debentures, creditor, bills payable, it could be any party. If such party would receive the payment, I just told you it will not be considered as part of purchase consideration. And just a moment ago, I also told you that total amount of purchase consideration will be delivered by purchasing company. And you know that total amount of purchase consideration is inclusive of payments towards equity shareholders and preference shareholders only. So only this much of amount will be given to vendor company, and vendor company will pay off then their equity shareholders and preference shareholders. However, in this particular case, payment is also being given to debenture holders. But point is that it is not made part of the purchase consideration. Indirectly, it means this amount is not delivered by purchasing company to the vendor company. 2,40,000 worth of payment which is supposed to be made to the debenture holders, because it is not a part of purchase consideration, indirectly it means this amount hasn't been delivered to the vendor company. And indirectly, it means this amount is still in the pocket of the purchasing company. So now you will understand it better. I was talking about this particular fact that if a party other than shareholder will receive any payment, then number one, now you are going to assume as if this party has been taken over by purchasing company. This party has been taken over by purchasing company, and in the books of purchasing company will make the payment, because this payment hasn't been delivered to the what we call vendor company. Because now it is the duty of the purchasing company to make the payment to the debenture holders directly. So, and purchasing company can make the payment to debenture holders directly only when it will first of all take over the debenture holder and then make the payment. Is it clear to you? For instance, in this particular question, I told you there are three liabilities. One is debenture holder, then staff provident fund, and besides that there are creditors. And we know that creditors and staff provident fund have been taken over, so no problem with respect to that. And in the question, it is very specifically mentioned that debenture holders haven't been taken over. But point is that debentures are not taken over, no doubt about that, and it is clearly given in the question. But the point is that because now debenture holders are receiving the payment, Debenture holders are now receiving the payments. So even you will have to presume that debenture holders have been taken over. That means in this question, vendor company will not pay off this liability because purchasing company will pay off this liability. Is it clear to you or not? So complete rule is that under net payment method, payments received by shareholders only will constitute the amount of purchase consideration number one. Is it clear to you? Number one. Number two, if a party other than shareholder will receive any payment, then such party will not be considered for the computation of the purchase consideration, and further it will be assumed that such party or parties have been taken over by the purchasing company, and purchasing company will pay them off in their own books. Is it clear to you or not? Is it clear to you or not? So this is how actually you are going to do this particular question. And in order to make you understand better, let me actually have a look over here. See here, in this particular question, we will start off with asset side. As usual in the books of acquiring company, I have already told you how the purchase consideration will be computed. Moreover, here I have given in what we call clear terms. And now in the books of acquiring company, we will make acquirer company account. We'll make what we call, in this question, preference share capital is also existing in the balance sheet, correct? If preference share capital of the vendor company is also there, you will have to prepare preference shareholders account also. If in the books of acquiring company or vendor company there are preference share capital, then you will have to prepare preference shareholder account, and my advice is to prepare it after what we call acquirer company's account. And then you prepare your realization account, and as usual your cash account, and then finally your shareholder account. Shareholder account always means equity shareholder account. Is it clear to you? Now in this question, first we start off with what we call asset side. On the asset side, only three items were there in this particular question. Property, plant and equipment 7 lakh, I will post it to the debit side of realization account. Then there are current asset 4 lakh. Besides that there is cash, but cash is not taken over. So I will simply write on the debit side of the cash account 2 balance brought down, as you can see, because, and in bracket I have written not taken over. It is not necessary to write not taken over. This is just for your reference. Not taken over, that is why we have brought down the balance here 3 lakh. Is it clear to you or not? Asset side is closed now. Now we'll move over to the liability side. In the liability side, the first item was equity share capital. Obviously, it will be posted to the equity shareholder account. Besides that, there are preference share capital. So we will have to open a preference shareholder account, which I have opened here, as you can see. Then in the preference shareholder account, I am going to write preference share capital to the extent of 4 lakh. Then after that, we come across, there are 3 liabilities in this particular question. And so many times I have been telling you, and I have already told you actually, that all the liability, irrespective of the fact whether those liability have been taken over or not, you are going to post them to the credit side of the realization account. We know that actually debentures haven't been taken over, but in spite of that, we are going to post all the 3 liability to the credit side of the realization account. Then there is reserve fund in this particular question. So reserve fund will be posted to the credit side of what we call reserve fund to the credit side of equity shareholder account, 1 lakh, sorry. Correct. So this is how you have closed your asset side and also your liability side. Afterwards, now you will have to do the entry for what we call purchase consideration. We computed the amount of purchase consideration is 11 lakh 10,000. So on the credit side of the realization account, I will write by acquirer company purchase consideration due 11 lakh 10,000. I will cross it to the debit side of acquirer company account, and over here I am going to write to realization account. Now I will receive the payment. In this particular question, we are not receiving any cash because amount of purchase consideration basically is the total of the payment which is being given to the equity shareholders and preference shareholder. And we have already seen that both the parties are receiving equity shares. That means the entire amount of 11 lakh 10,000 is being received, but is received by way of equity shares. So I'm going to write here equity shares in acquirer company account, that is 11 lakh 10,000. Now this time you have to be a little bit cautious in the sense, because out of 11 lakh 10,000, we have already seen that 7 lakh 50,000 worth of shares are being received by equity shareholders account, and 3 lakh 60,000 worth of shares are being received by preference shareholder account. Is it clear to you? So accordingly, in the preference shareholder account, I am going to write here 2 equity shares. Is it clear to you? 2 equity shares in acquirer company account 3,60,000. And then in equity share capital account, that is shareholder account, I will write 2 shares in acquirer company 7,50,000. Correct? Now here there is another important point. If you are preparing preference shareholder account, correct, the moment you incorporate the portion of the purchase consideration received by preference shareholder in the preference shareholders account, correct, afterwards you should immediately close it. Is it clear to you? For instance, in this case, the portion of the purchase consideration which is accruing towards preference shareholder is 3,60,000. The moment I am going to write 3,60,000 here, immediately I will close it. And if I will close it, there will be some balance. And this balance actually is gain to the acquiring company. I told you the total amount of purchase consideration will be given to the vendor company. Now, vendor company is actually paying their preference shareholder. And their preference shareholders were 4 lakh, but they are paying them off only 3,60,000. So technically it is a gain to the vendor company. So that is why whatever balance will be there, you will have to post it to the realization account. So you have written here to realization, and this realization must be posted here by preference shareholder account in the realization account also. Is it clear to you or not? Now, only the last question. Out of these liability, is there any liability which hasn't been taken over? The answer is yes. Debenture holders haven't been taken over. And if any liability is not taken over, I have been telling you that such liability must be paid off by the vendor company. But in this case, we are not going to pay it off. We are not going to pay it off because purchasing company will have to pay them. I have already told you, because it is debenture holders are receiving some payments from the purchasing company, and that amount purchasing company hasn't delivered to the vendor company. Is it clear to you? Any party other than shareholder, if that party will receive some payment, that payment will be withheld by the purchasing company with itself, and purchasing company will pay them off in their own books. So that is the reason in this particular question, you are not going to pay off debenture holder, because now it is a duty of the preference shareholders to pay them off. And these 2 liabilities have been taken over, no question of paying them off. Is it clear to you? So now I will close realization account, and if I will close it, the balancing figure, shareholders account, remember one thing, our acquirer company account and preference shareholder account is already closed. And now to shareholder account, this profit will be transferred to equity shareholders account. And afterwards, the balance in cash account is 3 lakh. It will be posted to shareholders account. And finally, your shareholders account will get closed. Everything I have written, all the notes which I have told you, correct? The movement preference shareholders are going to receive their portion of purchase consideration. Then preference shareholder account must be closed and balance must be transferred to realization account. And regarding net payment method, I have already given a detailed view, and everything I have written in these notes also. And if you want to put up entries in the books of the acquirer company, as usual, acquirer company is taking over property, plant and equipment, current asset, and they are taking over. Now, in this question, another important point, they are taking over creditors and staff provident fund, and because they are making the payment to the debenture holders themselves, so it will be presumed that even debenture holders are being taken over. This is the point I was talking about earlier. Is it clear to you? If a party other than shareholder will receive a payment, number one, it will not be made a part of what we call purchase consideration, and now it will be presumed that even such liability has been taken over by the purchasing company. So that is the reason why I have written here 10% debenture. Is it clear to you? Now, another important point. Because debenture holders are being given a payment of 2,40,000, so indirectly it means you are taking over debentures at 2,40,000. This is another important point. Is it clear to you? Then to creditors, to staff provident fund, then you will write to consideration. Obviously, the difference will be debited to goodwill. And then you will pay off the consideration 11,10,000, because total number of shares have been issued by you to the equity shareholder. I told you earlier 75,000 shares at the rate of 10 were issued, and to preference shareholder total 30,000 shares at the rate of 12 were issued. Equity shares have been issued at the rate of 10, correct? Whereas preference shareholders have been issued at the rate of 12. That means out of 1,05,000 shares, total 1,05,000 equity shares which have been issued by purchasing company, we can say that only 30,000 shares have been issued at a premium of rupees 2. What I want to say actually is just pay attention. Equity share capital, I will write here 1,05,000, 75,000 plus 30,000 into 10,50,000. But out of these 1,05,000 shares, I will write here 2 security premium. 30,000 shares have been issued at a premium of 2. So 60,000 will be the premium amount. Is it clear to you? Now, because you are making the payment to the debenture holder, you will have to pass the entry for making the payment to the debenture holder. So 10% debenture, 2,40,000. You have to write the same value, the value which you have written over here under entry number 1. You have written over here 2,40,000, so you will write here 240. And then now you are going to write here 215% debenture account, that is equal to 2,40,000. Is it clear to you or not? So this is how you are going to do this particular question. Another important part of this particular chapter is intercompany holding. Correct? And to be very honest with you, last time a question from this particular topic has already struck in the examination. So don't actually ignore this particular topic. Intercompany holding, there is a difference between intercompany debts and intercompany holding. Intercompany holding means actually, for example, suppose if I am taking over the business of other company, correct? This is the acquirer company and this is the acquiring company, let us say A2. We are taking over the business of acquiring company, but acquiring company is already having some shares in our company, or we might be having already some shares in the other company. So such a scenario could unfold. If such a scenario unfolds, then it is known as a case of what we call intercompany holding. So under intercompany holding, there could be various situations, and two prominent one among them is, one is when acquirer company holds share in acquiring company. When acquirer company holds share in acquiring company. When acquirer company holds share in acquiring company. If acquirer company is already having some shares in acquiring company, correct? So what will be the scenario? Acquirer company holds shares in acquiring company. Balance sheet of X Limited and Y Limited on 31st of 3/2027 is given to you, and here it is clearly written that X Limited acquires Y Limited. So X Limited is acquiring Y Limited, correct? A small balance sheet. In case if you happen to receive a question like this in the examination, generally you will get a very small sort of question, correct? Tangible fixed assets are given and figures are in lakhs. So 22 lakhs and 10 lakhs. And then here you kindly pay attention, investment is given to you, 3,25,000 it is clearly written, and 5 lakh is also written under the column of Y Limited. Then we are being given current asset 8,05,000 and 65,000. Three items are there. On the opposite side, we find that one equity share is of rupees 10 each, and total share capital of X Limited is 5 lakh. Total share capital of Y Limited is 10 lakh. Besides that, we have general reserve in this particular case, and then there are two liabilities in the form of debentures and creditors, correct? Now, below it is mentioned that investment of X Limited represents 25,000 shares of Y Limited. Kindly pay attention towards this particular point. It is clearly given that investment, because it is written in the column of X Limited, that means total investment of X Limited is 3,25,000. Now below it is specified that this investment of X Limited, it is specified below actually is in 25,000 shares, of Y Limited, That means X Limited might have invested in what we call Y Limited already, and later on they are acquiring the business of what we call Y Limited. Is it clear to you? Because X Limited acquires Y Limited, it is written, and further it is given in the question that already they are having investments in Y Limited acquiring company, and they are already having 25,000 shares of Y Limited. Of course, you might say, sir, 25,000 into 10 is equal to 2,50,000. No doubt about that. But the point is that here it is written 3,25,000. It means in order to acquire 25,000 shares, X Limited must have paid an amount of rupees 3,25,000. Is it clear to you or not? So in this case, what you see actually that acquirer company is already having some shares. Acquirer company is already having when acquirer company holds shares in acquiring company. Is it clear to you? That means before taking over the business, acquirer company must have done some investments and now they are taking over the business. So that is why it has become a case when acquirer company is already having some shares in acquiring company, and it is a case of intercompany holdings. Is it clear to you? Number one. Number two, just to confuse you, it is also written here, investments of Y Limited are considered worth rupees 6 lakh. See, it is a normal policy of the what we call entities to invest some amount so as to have some what we call return. So even Y Limited has done some investments and they might have done investment elsewhere. We are not concerned where they have done the investment. Important point is that their investment is worth rupees 5 lakh, but now it is stated that actually their worth now is equal to 6 lakh. Is it clear? Generally, when you are going to receive such questions, you will be asked only this much. Prepare a statement showing the number of shares to be allotted by X Limited to Y Limited. Only this much of the question will be asked in the examination in case if we happen to receive a question. And remember one thing, we already have seen actually that such question has already been asked, and I will show you later on. So once you have a good look over this particular question, I will tell you in a detailed manner, because unless and until I will not tell you in a detailed manner, my heart will not accept the fact that I have done justice to you. Correct? It's a philosophical dialogue, but I hope you would a little bit agree with me. First of all, if I am going to solve the question in class, I will simply write this in this manner: acquirer company acquirer company and acquiring company. Acquirer company is X Limited and Y Limited is your acquiring company. Is it clear to you or not? Number one. Number two, we have already seen that total share capital of Y Limited is 10 lakh. Here I have written full value 10 lakh. And one share is of rupees 10 each. So that means total number of shares of Y Limited acquiring company is equal to 1 lakh. And further it is given that out of these 1 lakh shares, 25,000 shares are held by acquirer company. And in order to purchase 25,000 share, acquirer company has paid an amount of 3,25,000 because their investment is worth rupees 3,25,000. So in this case, acquirer company is already having 25,000 shares of acquiring company, and now they are taking over the business of acquiring company. Correct? Because here it is given, you have to show the statement, and through that statement, you will have to show how many number of shares you will have to issue to discharge the consideration. Indirectly, it means we will have to use the intrinsic value of the shares. Now see here. First of all, I will have to compute the intrinsic value of the share, and for that I will have to write calculation of intrinsic value of share. Now, so often I have already told you how intrinsic value of the shares is computed or arrived at. So first of all, I will write tangible fixed asset, because in this question tangible fixed asset is written 22 lakh and 10 lakh. Then I will write investments 3,75,000 and 6 lakh. Then current assets are given 8,05,000, 65,000. I will total them up. Total asset is equal to 33,80,000 and 16,65,000. So far till up to this particular point, there should not be any problem. There should be a problem because you did not ask actually how I have written this 3,75,000. Actually, if you will look into the balance sheet, you must have noted that in the balance sheet, or should I tell you from here itself, the investment amount is 3,25,000. But when I was reading the question, it means you are not paying off the attention. You are not paying the required attention. Try to understand the difference between the questions which we have done earlier and the question which we are doing now is, first of all, I will write tangible fixed asset. I will write the tangible fixed asset. Then I will write the investment of Y Limited because its revised value is given. But problem is that I am not having this particular value at this moment. You might be wondering, sir, value 3,25,000 is given in the balance sheet. Of course, this is the balance sheet value. But there is every probability that this value might have changed. So I will have to wait for a while. What I want to say is that, let me actually erase it out for a while so that you understand better. At this moment, I am not having this value. So I will have to wait. That means I cannot total it up at this particular moment. So you have to presume that I have written investment in the column of X, it is blank, and current asset I have written, so but I am not in a position to total it right now. Is it clear to you? Although I am in a position to make a total of what we call Y limited, because all the assets are available, 16,65,000. Then I will subtract the amount of liabilities, 2,20,000 debentures, and then 1,60,000 creditor. Total it will be equal to 3,80,000. And in this case, 1,10,000 and 55 total is equal to 165. At least now we are in a position to compute the net assets of Y Limited. From 16,65,000, I will subtract 1,65,000. I will get a figure of net assets. Because in this particular question, no preference share capital is given, net assets also means assets for equity shareholder if preference share capital is not given. Is it clear to you? So now we have got assets available for equity share at least of Y Limited. So now I will divide it by the number of shares of Y Limited, which is 1 lakh, and the intrinsic value per share of Y Limited is 15. So you can see in this case you have found out the intrinsic value of Y Limited, the company in which you have made the investment. Now, because intrinsic value per share is 15, now I am in a position to find out the value of the investment. Now I can say value of the investment, 25,000 shares at the rate of 15 will be equal to 3,75,000. So now I will write here 3,75,000. Is it clear to you or not? Is it clear to you? That is why I am telling you that in this particular case you will have to be a bit what we call cautious, in the sense that first of all you will have to compute the intrinsic value of the company in which you have made the investment. Is it clear to you? Because full-fledged figure will be available, and through that, once you have determined the intrinsic value of the shares, now you can find out the what we call value of the investments. And now you are in a position to actually find out the total of the asset, total of the liability, 3,80,000. So net asset will be equal to 30 lakh, and you divide it by number of share, and intrinsic value will be equal to 60. Once you have determined the intrinsic value, the next point is what is the amount of consideration payable, because ultimately you have to find out the number of shares to be discharged by the purchasing company or the acquirer company to the vendor company or acquiring company. Next point is consideration payable. In order to compute the amount of consideration payable, first of all, I will write here number of shares of Y Limited. What is the number of shares of Y Limited in this particular case? Total number of shares of Y Limited, 1 lakh. Total number of shares of Y Limited is equal to 1 lakh. Correct? Now see here what I am writing. Number of shares held by X Limited. Because out of these 1 lakh shares which have been issued by Y Limited, we means X Limited are already holding upon 25,000 shares. Out of these 1 lakh share which have been issued by Y Limited, we are already having 25,000 share. So indirectly it means number of shares held by outsiders. So these shares, 75,000, will be considered as outside shareholders. Is it clear to you? They are outside shareholders. We need not require to make any payment to the shares which we are already having. We need to make payment only to such shares which belong to outsiders. So we have computed now, because in case of intercompany holding, this is the point you need to take care of. So total number of shares held by outsiders is equal to 75,000. Once you have determined it, now you are going to multiply it with the intrinsic value of Y Limited, because total number of shares held by outsider, but these outside shareholders are of Y Limited. And we just computed the intrinsic value of Y Limited. So in order to know the value of these 75,000 shares, I will have to multiply it with what we call intrinsic value of Y Limited. So total value of these shareholder will become 11,25,000. That means this much of consideration we will have to pay. Is it clear to you? To 75,000 shareholder, we are supposed to make the payment. And in order to know the value of the 75,000 share, we have to multiply it by the intrinsic value of share of Y Limited. So total value is 11,25,000. So total amount of consideration payable will become 11,25,000. Is it clear to you or not? Now the next question is, you have determined the amount of consideration. Another question was there, how many shares you are going to issue? Number of shares to be issued to discharge the consideration. I have already told you. How you will have to compute it? 11,25,000 is the total amount of consideration and your own intrinsic value is 60. Obviously, you are going to make the payment on the basis of your own intrinsic value of share. So on that count, I may say that 18,750 shares of rupees 10 each will be issued at the rate of rupees 60. Correct? 18,750 share. Honestly speaking, only this much question can ask you in the examination, not more than that. But because I just want you to have complete thorough what we call understanding of the concept. Suppose if I would ask you to prepare the books of acquirer in this particular case, how you would have had prepare. The first very important point is, say here, the investment, your investment in acquiring company was worth rupees 3,25,000, but now its actual worth is 3,75,000 because of intrinsic value. That means there is a gain to you. The investment you have made in what we call acquiring company was worth rupees 3,25,000, but now its worth is 3,75,000. So there is a gain. So first of all, you are going to record this gain. And in order to record this gain, you will have to pass this entry, investment in Y Limited account debit 50,000 to profit and loss account. Is it clear to you? 50,000. Is it clear to you? Okay. Now the next part is, now we will pass the entry for the assets taken over. We are taking over what we call tangible fixed asset of vendor company, 10 lakh. Their investment we will take over, obviously 6 lakh. Their investment is their asset, obviously. We are taking it over and its value now is 6 lakh. And current asset also we will take over. We will take over 2 liabilities, debentures and creditors. Importantly now, the investment which we have made in this particular company, because this company's existence will come to an end, so I will have to cancel out my investment in this particular company. And my investment has now moved to 3,75,000. Remember one thing, 325 was already there. And because of this entry, your investment in the company in Y Limited is now worth 3,75,000. So in order to cancel it out, you will have to credit it. Investment in Y Limited, 3,75,000. And then you will write to consideration payable 11,25,000. If there is any difference, obviously that will be adjusted through goodwill or capital reserve, but unfortunately or fortunately there is no difference. Is it clear? Then you will write the entry consideration payable because you have to discharge the consideration. We have already seen that in order to discharge it, we are issuing 18,750 shares at the rate of 60, but the face value of our share is 10, so I will write 1,87,500. And then I will write security premium 18,750 into 50, 9,37,500. Is it clear to you? This is one scenario as far as intercompany holdings are concerned. Then there is another scenario. There is another scenario. And what exactly this another scenario is, in order, I've done everything for you here. Everything I have written. Don't worry about it. You need not require to write down anything. We will pick up one more scenario. And this is a situation wherein acquiring company is already having some shares in our company, wherein the case which we did just a moment ago was the one where acquirer company was having some share. Now in this case, acquiring company is having some shares in the acquirer company. Acquiring company is having some shares in acquirer company. And in order to comprehend that, correct, actually I wanted to take the rest, but I thought, okay, well, let me actually complete this one before. Or should I take, okay, you allow me to have 1 minute, I will not take more than that, correct, 1 minute of break and then I will move further. 1 minute. Now we'll move over to this particular part, that is the second scenario, correct, wherein we will see that acquiring company is already having some shares in the acquirer company. In the first case, we saw actually that acquirer company is having some shares in the acquiring company, but now the situation is opposite one. In this particular case, acquiring company is already having some shares in the acquirer company, correct? That is 13B.1. Acquiring company holds shares in acquiring company. Now this is the balance sheet of Y Limited and Z Limited. We will see later on that Y Limited is absorbing Z Limited. It means the Y Limited is taking over the business. The Y Limited happens to be the acquirer company. Is it clear to you? Further, in this particular case, we are being given sundry assets to the extent of 7,50,000 and 3,50,000. And now actually you need to pay attention over here. 1,000 shares in Y Limited. 1,000 shares in Y Limited, and it is written in the column of Z Limited. I've already told you in this particular case, Y Limited is the acquirer entity and Z Limited is the acquiree entity. And Z Limited has invested already in 1,000 shares of Y Limited. Is it clear to you? So that means Z Limited is already having some shares in Y Limited. So that is why it will become a case where acquiring company is already having some shares in Y Limited. However, later on we will see that Y Limited is taking over the business of Z Limited. Now, further in this particular question, it is given to you, especially towards the liability side, share capital 1 share is of 100 and total share capital 5 lakh, 3 lakh, and then reserves, and then only creditors are given to us in this particular question. Further, it is written Y Limited was to absorb Z Limited on the basis of intrinsic value of the share. So it is clearly given that Y Limited is absorbing Z Limited. Y Limited is the acquirer entity in this particular case. And further, you are being given in this particular question, purchase consideration was to be discharged in the form of fully paid shares, and show the computation of the purchase consideration. Generally, question will ask you only this much, but I will give you the full-fledged solution. As usual, to make you understand better, first of all, let me tell you in a diagrammatic manner. First of all, this is the acquirer company Y Limited. This is Z Limited acquiree company. I have already told you in this particular case, Z Limited has made investment, correct? Now, there are 5,000 shares of Y Limited. If you look into the balance sheet, 5 lakh and 1 share is of 100 and 3 lakh is total share capital of what we call Z Limited. And in Z Limited's books, it is clearly given that they have made some investments, and their investment is in 1,000 shares of rupees 100 of what we call Y Limited. So in this particular case, I would say that Z Limited has made some investments in what we call Y Limited. So acquiring company is having what we call already some investments. Now we will start the solution. As usual, we will have to first of all find out the what we call intrinsic value of the share. But you will have to find the intrinsic value of that company in which the investment has been made. In this particular case, investment has been made by Z Limited in Y Limited. So first of all, I am going to compute the intrinsic value of Y Limited. Is it clear to you or not? So in order to compute the intrinsic value of Y Limited, I will take down the sundry assets of Y Limited, no investments of Y Limited. Then I will subtract liability, that is creditors. So total assets for equity shareholder, because this is the net assets and no preference share capital is there in the question, quite obviously. So 6 lakh basically here means, just let me actually put it this way around. Okay, now, so 6 lakh is the total amount, and 6 lakh, these are net assets and also assets for equity shareholder. I will divide it by number of shares, so I can get the intrinsic value of the share, which is 120. Now we know the intrinsic value of Y Limited. So now I am in a position to compute the intrinsic value of Z Limited. Z Limited sundry asset is 3,50,000 and their investment was in 1,000 share. I will multiply it with 120 because they have made this investment in Y Limited, and intrinsic value per share of Y Limited is 120. So 1,000 into 120 will give you 1,20,000. So now you are able to find out the exact value of the investment. Then I will subtract the creditors. I will subtract the creditors 95,000. I will get assets available for shareholders, and then I will divide it by number of share. We will also get the intrinsic value of share of acquiring company, that is 125. Now coming over to the next part, obviously the consideration part. And in order to derive the amount of the consideration, first of all, as usual, as we wrote in the last question, I'm going to write the total number of shares. In the last question, I wrote total number of shares in Y Limited because in the last question, Y Limited was the acquiring company. And in this particular question, total number of shares of acquiring company is Z Limited, 3,000. See here, I have written here held by acquirer company just to clarify it in a more clear manner. However, in this particular question, nothing has been held by acquirer entity. In the acquiring company, in this particular question, acquirer company is not having any share. Correct? So I will simply put up dash. That means all the shares which have been issued by acquiring company are to the outsiders. So I will write here held by outsiders 3000 shares. Held by outsiders. All these shares are outside shareholders. So now we are the purchasing company. We are supposed to make the payment to the outside shareholder. But how much payment we are supposed to make? In order to find out the total amount of purchase consideration, because these are the shareholders of acquiring company or the vendor company 3000, and intrinsic value of Z Limited, in this particular case acquiring company 125. So in order to derive the full value of 3000 share, I will multiply it by intrinsic value of share of Z Limited. Now we get actually 3,75,000. This happens to be your amount of consideration. This is the amount of consideration you have driven out in this particular question. Now see here, 3,75,000 is the amount of consideration. Obviously, number of share to be issued by, of course, Y Limited. Purchasing company. How many share purchasing company is now going to issue? Obviously, in order to know that figure, I will have to divide the purchase consideration by the intrinsic value of share of purchasing company. So by dividing it, I get 3125 shares. 3125 shares. So logically, I am supposed to issue 3125 shares. But in this particular question, these shares I am supposed to issue to Y Limited. Try to understand this point. It's a bit tricky point. We are the acquirer entity. We are the acquirer entity. Acquirer. And you are the acquiring entity, Z Limited. You are the acquiring entity. And I have already found that I'm supposed to give you 3125 shares. I'm supposed to give you 3125 shares. To whom actually I'm supposed to make the payment? Obviously to the shareholders of acquiring company. To the shareholders of acquiring company, I'm supposed to issue them 3125 shares. But point is that out of total shareholders of acquiring company, out of total shares of what we call this, total shares of acquiring company, we are supposed to issue 3125 shares. But acquiring company shareholders are already having 1000 shares in our company. Are you getting my point or not? So in this particular case, after deriving out this particular figure, 3125 total number of shares which we are supposed to issue. Now what I am going to do it, see here, shares already held by Z Limited. The acquiring company is already having 1000 shares. That means 1000 of the shareholders of acquiring company are already our shareholders. See, when we will issue the shares, the shareholders of acquiring company will become our shareholders. But 1000 are already our shareholders, so we need not require to issue any shares to them. That is the point you need to understand. So out of 3125 shares, 1000 shares are already held by the shareholders of the acquiring company. So number of shares to be issued now will become 2125. Is it clear to you? And intrinsic value of our share is 120. So logically, in this case, this is the amount of consideration which we computed earlier, no doubt 3,75,000. But we are supposed to make payment of only this much. So that is why consideration payable will become 2,55,000 in this particular case. Is it clear to you or not? So till up to this point you are supposed to solve, but still if suppose question asks the entry in the books of acquiring entity, then what you need to do in this particular case, in the books of acquiring entity, in the column of acquiring entity, there are sundry assets. Obviously, you are going to take over sundry assets. And only one liability is there. You will take over what we call creditors also. And you just found out that you are supposed to make a payment of only 2,55,000. So consideration payable is 255. So difference will be debited to Goodwill. And then you will pass this entry, consideration payable account debit, 255. 2 share capital, 2125 shares into 100, 2,12,500, and then you will write 2 security premium, 42,500. Is it clear to you or not? Exactly on same lines, a question is struck in the examination and you move over to section 14, wherein I have almost now completed. We have completed till up to 4 questions, and now see here question number 5. Question number 5, REQ5. This is the question from December 23 examination. REQ5, December 23, new scheme, correct? Vendor company or acquiring company hold share in purchasing company. This is the scene which we just did a moment ago. We did scenario 2 wherein acquiring company is having the share, and this question also we will see that acquiring company is already having some share in the purchasing company or acquirer company, correct? Following are the extracts of the balance sheet of the two companies, Beta Limited and Delta Limited. This is your Beta Limited and this is your Delta Limited. We will see later on that Beta Limited is taking over the business of Delta Limited. Beta Limited is your purchasing company, Delta Limited is your acquiring or vendor company. Now we are being given in this case non-current asset, and non-current assets are given in the form of property, plant and equipment 10 lakh and 5 lakh. Then we are being given financial asset, and over here it is written 20,000 shares in Beta Limited. The question just we did a minute ago, it was written in the column of the acquiring company 1,000 shares, correct, in acquirer company. Similar is the situation here. In the column of Delta Limited it is written, that means Delta Limited, acquiring company or vendor company, has already made some investment in the what we call Beta Limited, and 20,000 shares they are having. Is it clear to you? And then under the current asset we have got only inventory 2 lakh and 1 lakh. Besides that, under current asset, financial asset again given, trade receivable 3 lakh in the form of trade receivable, that is 3 lakh and 1 lakh. This is the total 15 lakh and 9 lakh. Further on the equity and liability side, equity share capital 10 lakh and 6 lakh, one share is of rupees 10 each. Then other equity, under the other equity we are being given reserves, that is 2 lakh and 1 lakh 10,000. Then under current liability we are given trade payable 3 lakh and 1 lakh 90. This is the scenario of this particular question. Further, it is stated in the question, Beta Limited was to absorb Delta Limited. You can see this question is struck in the examination, and only in our book this question was available, correct? Almost this sort of question. So Beta Limited was to absorb Delta Limited on the basis of intrinsic value of the share. Further, it is written that purchase consideration was to be discharged in the form of fully paid shares. Besides that, in this particular question, some additional lines are given, but honestly speaking, these lines will have replications only in the books of acquirer company. I will read those lines later on, but till up to this particular point of time, what we see actually, this question is exactly on the similar lines, the question just we did a minute ago, correct? Suppose if I, till up to this particular point, if suppose I am going to solve this particular question, in the last question, first of all, what we did, we immediately started with computing the what we call intrinsic value of the share. So same methodology and procedural aspects we are going to apply even in this particular question. So this is your Beta Limited. What you are doing, you are trying to find out the intrinsic value of the share. In order to find out intrinsic value of the share, you have to keep one important point in your mind, especially when there is a case of intercompany holding. You need to find out what we call intrinsic value of that company first in which you have made the investment. The investment has been made in what we call Beta Limited. So it is better to first of all find intrinsic value of Beta Limited. So 10 lakh is the property, plant and equipment of Beta Limited. Of course, 5 lakh is the what we call value of Delta Limited. And then no investment, then inventory 2 lakh here, 1 lakh here, 3 lakh, 1 lakh. Then I will subtract what we call all liability, only one liability, trade payable is there. After subtracting, we will be able to get net asset, and net asset here stands for assets available for equity shareholder, no preference share capital is there. So I am going to divide it by the number of shares. I can easily get what we call intrinsic value of the share, which happens to be 12 in this particular case. And because now we have the intrinsic value of Beta Limited, now I am in a position to find out the value of the investment. The value of the investment, that is 20,000 share, which Delta Limited has invested in. 20,000 into 12. 12 is the intrinsic value. So 20,000 into 12. Now you can say that intrinsic value, total value of investment is actually 2 lakh 40. Then inventory 1 lakh, trade receivable 1 lakh, less creditors. So you will get net asset equal to this much. You can easily manage this question. And then you will divide it by 60,000 total number of shares. You will get in this case 12.50 as the what we call intrinsic value of the shares. So once you have determined the intrinsic value of the share, now the next part is number of share to be issued by acquirer company to the acquiring company to discharge the purchase consideration. So for that, first of all, I need to know the total number of share of the acquiring company, that is Delta Limited, that is 60,000. Then intensely, I have written here held by acquirer company, nothing, because in this question acquirer company is not having any shares of Delta Limited. So all these shareholders it means are held by outsiders. So total value of these shares, if you want to know, you will have to multiply it by the intrinsic value of the acquiring company, 12.50. Because these are the shares which have been issued by the acquiring company. In order to know their true value, I will have to multiply it with what we call intrinsic value. So total value is 750. So that will deliver me the amount of consideration. Now the next question is 7,50,000 I will divide it by 12. So it will tell me how many shares the purchasing company must issue. So 62,500 shares logically I should issue. But as I told you earlier, we are supposed to issue 62,000 shareholder to the acquiring company so that shareholders of acquiring company will become our shareholders. But problem is that acquiring company is already having our 20,000 shares. So we need not require to issue to those shareholders any shares because they are already our shareholders. Correct? So that is the reason I will subtract from here less shares already held by acquiring company 20,000 shares. So ultimately I will have to issue only 42,500 share, and intrinsic value of purchasing company is 12. So consideration payable will be 42,500 sorry into 12, that is equal to 5,10,000. So 5,10,000 will become the amount of consideration payable. Now, in this particular question, actually, we will see later on, it was asked of us to prepare the consolidated balance sheet also. Now, in order to prepare the consolidated balance sheet, you may have to compute the amount of calculation of goodwill or gain on bargain purchase. How will you compute? In order to compute, because this is a case of intercompany holding, so you have to be a little bit careful here. Total net assets on the date of acquisition, no doubt, is equal to 7,50,000. Total net assets. But out of these net assets, because the value of the investment made by acquiring company, correct? These are the net assets 7,50,000 of acquiring company, no doubt. But in this 7,50,000, you can say because 20,000 shares are already held by acquiring company. 20,000 shares are already held by the acquiring company. So what you are going to do, you are going to subtract the share of acquiring company 20,000 into 12, that becomes equal to 2,40,000. Indirectly, whenever we compute goodwill, we try to find out the portion of the net assets, of the what we call acquiring company which belong to outsiders. So we may say that portion of the net asset which belong to outside shareholder actually is 5,10,000. This is what we call 5,10,000 means the net assets of the acquiring company which belong to outside shareholders. Is it clear to you? Now you will have to compare it with the amount of consideration, and in this particular case, we saw that purchase consideration is also 5,10,000, and that is the reason in this particular case you cannot have any goodwill or gain on bargain purchase. Now we have to prepare. Now we have to pass the entry. Now first entry will be property, plant and equipment, inventory, correct? Of course, we will look into the column of the acquiring company. In the column of acquiring company, property, plant and equipment is 5 lakh. No revised values are given separately. Similarly, inventory, trade payable. And then as far as liabilities are concerned, 1,90,000, you will write 2 consideration payable. You can also check it from here that no goodwill is arising. Correct? Now you will have to deliver the consideration. In order to pay 5,10,000, we are offering 42,000 shares. 42,500 shares of 10 each, but we are offering them at the rate of 12. So 42,500 into 2 will become premium. Is it clear to you? Now 2 more entries I will have to write. Why these 2 entries? Because in this particular question, it is also given a sum of 40,000 is owed by Beta Limited to Delta Limited. We have already done such sort of what we call adjustment so many times. It is a case of intercompany debts. 40,000 is owed by Beta Limited to Delta Limited. Correct? To Delta Limited. Indirectly, it means creditors of Beta Limited include 40,000 amount which they are supposed to pay to Delta Limited, and put it in a reverse manner. We may also say that Delta Limited's debtors are there. Out of those debtors, 40,000 they are supposed to take from what we call Beta Limited. In this case, it is given that Beta Limited is supposed to pay 40,000 to Data Limited. That means creditors of Beta Limited include 40,000 amount payable to Delta Limited. Indirectly, it means debtors of Delta Limited will include a figure of 40,000 which they are supposed to receive from Beta Limited. So this is a case of intercompany debts. All we have to do is to cancel out intercompany debts, correct? And in order to cancel out the intercompany debts, I will have to reduce the amount of trade creditors and I will have to reduce the amount of what we call trade receivable also. That is why this entry we will have to pass. Is it clear to you? Why we have to pass this entry? I told you it will have effect only in the books of acquirer company. Another point given in this particular question, also included in the stock of Beta Limited 60,000 goods supplied by Delta Limited at cost plus 20%. Question says that in the books of Beta Limited, also included in the books of Beta Limited, in fact it is written also included in the stock of Beta Limited. In Beta Limited books there is a stock or inventory, and in that stock 60,000 worth of goods are there which have been supplied by Delta Limited. And Delta Limited has supplied these goods at a margin of 20% on cost. At a margin of 20% on cost. At a margin of 20% on cost means if cost is 100, margin will be 20, that will become 120. So selling price will be, rate of profit on selling price will be 20 by 120. We will presume that this is the amount of sale. Is it clear to you? Because Delta Limited has sold goods to us. So they might have sold some goods, but out of those goods, 60,000 worth of stock is lying with Beta Limited. So what we are supposed to do now, because this stock is at selling price, I will have to pluck out the margin which is included in it. The amount of margin you will compute it by applying the rate of profit on sales. That is 1 by 6. So margin will be equal to 10,000. It is also known as unrealized profit. Now, in order to extract the unrealized profit, the entry which you are going to pass is reserves account debit to inventory account. We will have to reduce the amount of inventory which is lying at 60,000 because it is the selling price and it includes unrealized profit of 10,000. So we will have to reduce it to cost price. So in order to reduce the stock of 60,000 to actual cost price of 50,000, I will have to credit inventory by 10,000 and also the profit margin or reserves will decrease. Is it clear to you? After having passed down these entries, now you are in a position to prepare the consolidated balance sheet. When you prepare the consolidated balance sheet, for your simplification, see here how I have prepared. I have made intentionally 2 columns, otherwise you can directly use this column. Correct? Anyway, plant and machinery or equipment is 10 lakh of Beta Limited and 5 lakh of Delta Limited. I will combine it, 15 lakh. As far as financial assets are concerned, in the column of Beta Limited was nil, and this 2,40,000 will not be written over here because it is a case of intercompany transaction. Is it clear to you or not? So intercompany holdings will never find place in the what we call consolidated balance sheet. You need to take care of this particular fact. Is it clear to you or not? Moreover, you have already seen that in the entries, nowhere you have written investment. When you pass the entries, these are the entries. These are the entries which you have passed. And according to the entry, you are taking over only plant and machinery, you are taking over inventory, you are taking over trade receivable, and you are taking over trade payables. So whatever items which you are picking up, you are going to include that in the consolidation. Similarly, your inventory is 2 lakh and you have taken over the inventory 1 lakh. But just a moment ago, we wrote an entry where inventory is credited. Unrealized profit will have to be subtracted from the total inventory. 2 lakh plus 1 lakh, 3 lakh minus 10,000. So ultimately, inventory will find place in the balance sheet at a figure of 2,90,000. Likewise, trade receivable 3 lakh plus 1 lakh, and there were intercompany transaction to the extent of 40,000. So you will write here 3,60,000. So total will be equal to this much. Coming over to the liability side, in the consolidated balance sheet, we know that we write only equity share capital of acquirer company. Now, equity share capital of acquirer company is 10 lakh. but they have issued 42,500 share at a nominal value of 10 each. So total share capital now of acquired company is 14,25,000. Similarly, I will also write here security premium 42,500 because we have issued 42,500 share at a premium of rupees 2, that is 85,000. Actually, these two items you can write under the heading of other equity, correct? Security premium and reserves. Now in this particular question, remember one thing, so many times I have told you that when we prepare the consolidated balance sheet, we never write what we call other equity items and share capital of the acquiring entity. So when I will write reserve, I will simply take the what we call balance of the acquirer entity. And in this reserve, because we wrote an entry earlier, correct, for unrealized profit reserves account debit to inventory account, so 10,000 will be subtracted, 1,90,000. And then trade payable, you will simply combine and subtract the intercompany transaction, and this is how you will get this particular figure. So this is how we have completed this particular chapter. Is it clear to you? I hope that it will stand you in a very good stead, and you must have driven a bit of confidence to tackle any sort of question which may strike in the examination, correct? So we take pride in giving you the most widest of the coverage, and I hope so that you would agree to it, at least to some extent. Anyway, looking forward to have your views on it. Shall meet you in the next session with something new, correct? So with that, we conclude this particular chapter.